Guys, just need a quick update. How's the audio? Is the audio, am I audible, guys? Is the audio good? Just if you could like send something in the chat box. Perfect, perfect, perfect. Guys, we start in 5 minutes. All right. We start in 5 minutes. Hello, hello, hello. Hi, guys. Good morning. Just a quick update quickly on my audio and video. I hope I'm audible. I hope you all can hear me as well. Good morning. Hi, Sneha. Good morning. Hi, guys. I can see a few names. Samruddhi. Hi, Malishka. Hi, Krusha. Hi, Shreya. Hi. Fun facts. Real ID से आओ भाई. Music दिल से. Okay. Hi. Pleasure. Perfect. Perfect. All right. Okay, guys. So let us quickly get started. Let me just quickly do the expectation setting of what we're going to do today. All right. Guys, we will try and revise maximum, how much ever we can. We'll try and revise maximum portfolio management today. All right. Jitta bhi time hai. If not today, if just hold on for a second, I don't know what's the issue. All right. Now I think it should be sorted. Yes, guys. The intention today is to revise maximum portfolio management. I hope you guys are aware it is 8 to 12% of your exam. Now, this makes this subject a very, very important subject. That's the first thing. Second, you guys must have seen that this subject, except for two chapters, is pretty much easy. What are those two chapters? Portfolio Risk and Return Part 1 and Portfolio Risk and Return Part 2. Except for these two chapters, pretty much the subject is very, very simple, right? Now, these two chapters remain a challenge, and we will try and make sure that we cover it up very well, right? Apart from that, guys, this is very, very important. Now, I am expecting that you guys would have done this subject once, or you guys would have studied this in your class or whatever, but this is going to be a revision. I am not going to start things from the scratch, right? It is very important for you guys to understand this, that I am not going to try and cover, so this is the basic topic, this is what it is. No, this is not a regular class. This is a revision lecture. So I'm going to make sure that things are covered fast in a manner which is detailed, but not that detailed which is required in a regular class. All right. So this is very important to understand that this is a revision lecture. Here, the idea is to make you guys understand how do you revise a subject, how do you go about things, how do you read things, how do you sort of quickly flip pages if at all is required to before the exam, 2 or 3 days before the exam and stuff like that. All right, so that is what it is, right? Now, what we'll make sure is we will try and cover up the entire chapter, and then I'll give you guys a 2 or 3 minutes break after the chapter, right? And we'll take a big lunch break, and then we'll cover things post that. So around 1:30 or 2, I'll give you guys a big lunch break, like half an hour, and then after that we'll continue. But until then, let's try and cover maximum how much ever we can. All right. The first thing that we're going to start with is we are going to go on with the first small. What we're going to start with is we'll go on with the first four chapters that are there. The normal basic four chapters that are there, apart from the risk and return part 1 and part 2. And at the end, we'll cover portfolio risk and return and portfolio risk and return part 1 and part 2. That's what we'll do. All right, let's get started with our first reading for the day, which is going to be portfolio management and overview, right? A very, very simple, very straightforward, very introductory reading. All right. What do you mean by portfolio perspective, guys? Portfolio perspective is what looking at a security, that how this security would fit in into an overall portfolio. A security in isolation would be great, would be giving you great returns, would be giving you great would be having lower standard deviation, whatever that may be. But you have to make sure that you consider this security from a portfolio perspective. How does it fit in into everything? Right, like for example, a person, a player, let's we talk about cricket. A player would be great individually, is a great bowler, is a great batsman, is a great fielder, but he doesn't contribute a lot when it comes to a team environment. He's not great. He doesn't fit in with people. He doesn't gel. He has a jealousy factor. All of those things are there. So he doesn't fit in very well in the team, right? Exactly like that. A security might be great in isolation, but would not fit in with the overall portfolio perspective. That is what this is, right? So this is what it is. Portfolio perspective refers. Now I'm not going to read everything, right? I have made a few notes for you guys, but I'm definitely not going to read everything. I'm going to try and cover up whatever important points are there, right? So it is very important that we look at the investment. How does that investment affect the overall portfolio's performance, right? Rather than thinking that it is a good investment on its own, right? This is very, very important. Now, why does the portfolio perspective matter, guys? So that investor who's putting all their wealth into one stock, they understand that, diversification is very, very important. Otherwise, you're facing a lot of risk. Right? This is very important to understand. So this is what makes it very, very important that you sort of diversify, you sort of put into different securities so that overall risk comes down. Right. And when you evaluate those different securities, you're supposed to evaluate that security from a portfolio perspective and not individually. And modern portfolio theory also confirms that your diversification can reduce the risk, right? And holding just one security doesn't make any sense. You have to make sure that you keep diversifying. This is how do I quantify this, sir? What is the benefit that I'm getting when I'm putting into multiple securities, when I'm trying to invest in multiple, when I'm buying, let's say, stocks, when I'm buying bonds, when I'm buying a bit of real estate, when I'm buying a bit of crypto, when I'm buying a bit of alternative investment, sir, how exactly do I measure the benefit that I'm getting? What is the benefit that I'm getting when I'm investing in multiple sort of securities? How do I quantify it? There are different ways to quantify it, but a rough way, what a rough way to quantify it is a diversification ratio. Right. It is the quantitative measure of the diversification benefit that you get. So let's say, for example, I have five securities and I have created an equally weighted portfolio of five securities. What? I have created an equally weighted portfolio of five securities. Okay, sir. That means, sir, the five securities that you have put your money in, those five securities overall would create some diversification benefit and the overall risk of the portfolio would go down. So let's say, for example, the overall risk of the portfolio. What portfolio of five securities? Sir, the overall risk of the portfolio is 15%. Okay. Let us pick a random security out of those five securities. Let us pick a random securities out of those five securities, and that random security, which is basically the random single stock, sir, the risk of that is 20%. All right, sir, fair enough. So what are you trying to get at? What are we trying to calculate? I'll again repeat. I have created an equally weighted portfolio. Okay, sir, you have created an equally weighted portfolio. That equally weighted portfolio is, let's say, made up of five stocks. The overall risk of the portfolio is, sir, 15%. Okay. You pick out one random security out of that portfolio. The risk of that random security is 20%. Sir, what is my diversification ratio? My diversification ratio simply will be how much? It will simply be 15% divided by 20%, which is risk of the portfolio divided by the risk of a single security, and it is 0.75. Sir, what does 0.75 mean? Sir, how do we interpret this? Whenever my diversification ratio is less than 1, that means I have reduced my risk of the portfolio via diversification. If the diversification ratio is equal to 1, that means there is no diversification benefit. Sir, what do you mean by that? Let's say, for example, rather than investing in all five stocks, I invested only in this stock. So my portfolio is made up of only this stock. The portfolio standard deviation is 20%, right? Sir, the risk of that stock, single security, is 20%. Sir, what is my risk diversification ratio? Sir, 1. Sir, have I diversified anything? Have I reduced my risk? No. The point being, when my security is made up, when my portfolio is made up of one single security, the diversification ratio of portfolio is going to be what? Sir, the portfolio standard deviation is going to be equal to the security standard deviation. So 20%. Sir, when I pick out the random, in the denominator, I was picking out a random security in the portfolio and writing down the standard deviation of that. Essentially, there is no random thing here. There is just one security. So, sir, 20% is what I have to write here. Sir, the overall diversification ratio is 1. That means I have not diversified anything. That means essentially I have invested only in one share. That is what this is trying to talk about. Right. Now, guys, less than 1 indicates a diversification benefit. How come? Because when I select a random security in the example that we took, when I select a random security, so 20% was the standard deviation of that, 15% is the standard deviation of portfolio. My overall standard deviation, sir, declines. Sir, it goes less than 1. That means there's a benefit that I'm getting. Okay, so less than 1 is benefit. How come? The risk of the portfolio is less than the risk of the security. That means I have achieved diversification in portfolio. Right. Sir, how come the risk of the portfolio is going down and it is below the risk of that single security? All of that discussion we will have when we discuss portfolio risk and return part 1. But because of correlation, because of the what do you call, let's say negative correlation, if I take an example, because of negative correlation between securities, so overall risk of the portfolio goes down. Because of negative correlation, when one security is going down, other security is going up. So loss here is made up by profit here. So I mean the profit here sort of compensates for the loss here, if I were to put it in the other way as well. So overall risk sort of reduces. Right. So that is what this is. That is what diversification ratio is. Now, an equally weighted portfolio is not necessarily always going to minimize your risk. Here, we simply invested in five stocks and we assigned equal weightage to it. It is not necessary that an equally weighted portfolio is going to reduce that risk. So, how do you find out an optimal portfolio? Where the weights are properly assigned so that the risk is overall reduced. You can use computer optimization to assign that. And obviously, sir, diversification is not effective in the times of financial crisis. Like let's say, for example, 2008 or COVID, times like these, which are, extreme events. In these kind of times, overall, market goes down. So diversification ratio and, correlation and all of those things goes for a toss. And ultimately, you sort of end up losing a lot of money, right? In everything. So diversification doesn't really work in these stressful times, right? Everyone understanding, is the pace good? Am I going too fast? Am I going too slow? Guys, quickly in the chat box, tell me. Also, this is new for me. I'm doing it for the first time. To kind of, you know, get hold of the chat as well and sort of speak, it is going to take a little time for me to get used to that reflex. So, in the chat box, guys, quickly, are you guys understanding? Is the pace good? All right, perfect, 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 perfect. Thank you so much, guys. Thank you so much. All right, now, one more thing. Now, which I did not mention at the start. I remember this right now, guys. Whatever your notes are, whatever you have highlighted, whatever book you are referring to, open that book and sit beside that, sit with that book. All right. So whenever I'm going through the concept, you quickly go over that as well. Do that. All right. Very important. Okay, guys. Now, next thing. Let us quickly go over the steps in portfolio management process. How exactly do you manage a portfolio? What are the steps that would be there in a portfolio management process? All right, let's quickly get started. Let us quickly take an example right here. Let us take an example of Rajat, who's a 35-year-old professional, which is based in Mumbai. Now, whenever you manage a portfolio, there are three steps to managing that portfolio. What are those three steps? Three steps. First is planning. Second is execution. Third is feedback. That is with everything you do in life, right? You have to plan, then you have to execute, and then you have to take the feedback. That's everything to do. That's everything. Whatever you do in life, that's how it is going to be, right? So first step is always planning, right? Let's take an example of 35-year-old professional, Mr. Rajat from Mumbai. He wants to retire at the age of 60 and he wants 5 crore rupees when he retires. Right now, he can invest 75,000 per month from his salary. His risk tolerance is moderate. It is not that high. It is not that low. He may need 10 lakh rupees in 3 years from a for a home down payment. So there's a liquidity requirement that 3 years down the line, he might need 10 lakh rupees for one of the down payments that he's going to make for his house. Right? And he prefers ethical investing where he does not invest in tobacco stocks or alcohol stocks. Right? Doodh ka dula types. That is what it is. Right? Perfect. So this is what it looks like for him. Now, there's a summary, right? You make an IPS summary. IPS, I hope you guys remember, investment policy statement. That is what it is. So you make a sort of a summary where the risk tolerance is moderate, the return objective is 10 to 12%. He wants 5 crore rupees. He's able to save 75,000. So on an average, he would need a return of 10 to 12%. That is the calculation that has been made. Time horizon is 25 years because he's 35. Until 60 years, 25 liquidity needs is 10 lakh rupees. Constraints, ethical investing, and what is the benchmark? How do you want to compare the performance of the manager? How do you want to rate the performance of a manager? How well is performing? He's not performing well. If he's not performing good, whatever that may be, how do you want to compare that performance basically via a benchmark which is Nifty 50? All right, that is what this is. The benchmark has been defined. All of this forms a part of what planning as a step. Okay, so if I were to quickly go back and take you guys to theory, not go back actually, if I were to take you guys to theory, what exactly is planning step? You understand the needs of the investor. What are the constraints of the investor? What are the goals of the investors? Right. example, I mean, what all example that we have already taken, what all is included? So risk tolerance, moderate, return objective 10 to 12% in case of Rajat, time horizon, liquidity needs, he might need 10 lakh rupees. I hope you guys understand the difference between income need and liquidity need. This is something that I've seen students being very confused about. What do you mean by liquidity need? Liquidity need is something that you would require as a one time, money out of the portfolio. So let's say, for example, in his case, he needs 10 lakh rupees 3 years later. So he needs that just for one time, right? That is a liquidity need. You need it just for one time, just for that one occasion. You might have to pay for your children's college education, let's say 50 lakh rupees. You might have to pay for their marriage, whatever that may be. All of that is a liquidity need. That's one time that is required out of your portfolio. What is income need? Income need is something that is regularly required out of the portfolio. Let's say, for example, I am creating a portfolio right now that is going to support my regular expenses. So that is the income that I'm going to need on a regular basis out of my portfolio. Right? So that is what the difference is. Income is more regular, liquidity is one time. That is the difference. All right. Legal and tax considerations. What are the legal considerations? Tax consideration, unique preferences. He doesn't want to invest in alcohol or tobacco, and benchmark, which is Nifty 50 in our case. Remember, IPS forms the foundation, and you have just made IPS in the planning step, which is investment policy statement, which is ultimately going to be a document which is going to be, what do you call, guiding however you're going to do. I mean, what are you going to do for this investor? All right. What is execution step? In execution step, what do you do? Before we start execution step, let me quickly discuss what do you do in execution step. We will go back to the theory bit of it. In execution steps, you sort of filter down what is the asset allocation going to look like. What are the major asset classes that you want to invest in, right? You can use a top-down approach or a bottom-up approach for that. What is top-down? What is bottom-up? I will take you guys back to the example. We'll discuss that. So basically, you're trying to construct a portfolio here. And to construct a portfolio, you obviously have to look at the risk and return characteristic of individual security so that you create a diversified portfolio. Right here, you can also apply different valuation models like DCF or relative valuation, whatever that may be. All right. So that is what this is. Okay. Now let us quickly go back to our example. So whatever we could understand about Rajat, the at the planning step that he's 35-year-old, he has 25 years to retirement, 75,000 he can save, 5 crore, what 5 crore is what he needs. All of that, okay, you've decided all of that. Perfect. On the basis of that, what are you going to do in execution? This is what you have come down to. Right, you have to invest 60% in domestic equity, you have to invest 20% in fixed income mutual fund, 10% in REITs, 10% to gold ETFs, whatever that may be. Right? For this, you can either use a top down approach or you can use a bottom approach. What is top down approach? You sort of, only you are restricted to, you sort of start at a higher level. So let's say, for example, in this case, you might overweight mid cap stocks due to strong earning projections. So you think that in mid cap and small cap, the earnings projection is going to be very, 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 very strong. So you sort of overweight that. That is taking a top down approach. That is sort of, looking at things from a bigger perspective, right? From a larger scheme of things. You don't go into an individual security that in mid cap I'm going to buy this. No, no. You want to overweight mid cap. That is what top down is. You're looking at larger scheme of things. What is bottom up? Bottom up is something where you sort of look at an individual security. So let's say, for example, there's an undervalued stock. Okay. How do you find out that the stock is undervalued? You can use a PE ratio or a PE to G ratio, like a PEG ratio. So PE to G ratio. So you can use anything of that sort to understand that an individual security is undervalued. So, sir, what is top down? Top down, I look at things from a larger scheme, larger scheme. I look at the security or not security, to be honest. I look at a particular segment of the market from a larger scheme of things. So, what is bottom up? Bottom up is when I find out a single security and I see that whether it is undervalued, overvalued, and I sort of take a position on the basis of that. And that is what top down or bottom up is. And you can sort of, depends upon whatever sort of execution you want to get, you can, sort of go for that. Right. And the next step is your feedback step, which is very simple, that after 12 months, you sort of would want to see that, where is your portfolio? What has happened to your portfolio? Are you on your target weight? So let's say, for example, for Rajat, you had to invest in 60%, you had to invest 60% in domestic equities. But after 12 months, the prices of equities have gone up. So now that has become 70% of your portfolio because of the market rally in equity. What do you do? So you'll have to liquidate a little. You will have to sell equities a little so that ultimately you can bring back your weight of equity to your target weight. Right. So here you have to rebalance. That is called as rebalancing. Right. So you sell 1.5 lakhs of equity and reinvest in fixed income and gold to restore the target weights. You can also, feedback step, it also involves that whether Rajat's circumstances have changed, whether his job has changed, whether his family need has changed. All of that you also evaluate. So that is what feedback step essentially is. So these are the three steps that are there with respect to your, what do you call, portfolio management process. So first is planning, second is execution, third is feedback, right? And feedback, this is what the theory looks like. You evaluate the performance. You sort of also evaluate the performance, that what's happening, or where are you with respect to benchmark. Benchmark has done 12%. How much have you done for the portfolio, right? Whether rebalancing is required or not, whether revision is required or not with respect to, whether his objectives has changed, his needs has changed, whatever that may be. That is what it looks like. All right. Perfect. That is what your portfolio management process is. All right, guys. Okay. Is everyone with me so far? Is everyone with me so far, guys? Understanding everything. Also, there's a bit of latency. So the time I talk and you guys can hear it, I think there's a good gap of 15, 20, 30 seconds. So yeah. Yes. Perfect. All right, guys. Now, whenever I am whenever I am employed at a particular place, this is my employer and I am the employee. Obviously, the employer gives me a certain type of retirement benefit, right? That retirement benefit can be of two types. First, defined contribution plan. Defined contribution plan. And the other one is defined benefit plan. Sir, what is defined contribution plan? What is defined benefit plan? It is in the name itself. Here, the contribution of the employer to the retirement fund is fixed. Apart from that, he has no other liability. So, what is defined contribution plan? A retirement plan where the employer contributes a fixed amount to the employee's retirement account regularly. He just has to deposit the fixed amount, nothing else, nothing more. इतना करना है बस, उससे ज्यादा कुछ भी नहीं. So his liability is fixed to the amount of contribution that is there with respect to the employee's retirement benefit. Right. So this contribution can be based on years of service. He might be there with you for 20 years, 25 years, whatever that may be. It might be depending on that. Employee salary. What is his current salary? What does his future salary looks like? A percentage of employees contribution. Whatever employee is contributing, we'll contribute in the exact same amount. Employees contribution that is there. Again, and this is not very, very relevant for you guys, just trying to sort of point out these points. Firm profitability, etc. Depending upon the profitability of the firm, also whatever they want to contribute, they usually contribute. But the point is that your liability will be fixed to what? Your liability will be fixed to what? The amount that you're contributing. This is very, very important to understand. But in defined benefit plan, you sort of promise the benefit to the employee, right? You tell them that, listen, whenever you retire, I will pay you this amount every month. So let's say, for example, whenever you retire let's say you retire at the age of 60, I will keep on paying you $40,000 every year. This is the example you can see, right? The final salary of the employee was 1 lakh. The years of service that he has done with you was 20 years. The retirement benefit that you're willing to give that employer is going to be 40,000 per year for the time till the time he's alive. So all of this is done usually by actuaries, right? What sort of how do you come up with this amount, like 40,000. What should the metrics be to come up to this amount? So usually these are the metrics, final salary, years of service, stuff like that. The point is that, again, not to get into the specifics, you will understand this very well in your level 2. Not to get into the specifics, what matters to you here is that the employer has promised a fixed benefit to the employee, unlike the defined contribution plan where his liability was just the contribution, the fixed amount that he was supposed to contribute, right, to the fund. Here he's guaranteeing the benefit that you are getting. So sir, okay, so it's still confusing. Both the cases, there are amounts, right? Sir, this confusion still remains. So let's say, for example, we are talking about a defined contribution plan, right? Here the employer contributes a fixed amount to a particular fund, which is employees retirement fund, right? Now whatever happens with that fund, whatever happens with that amount is completely the risk of the employee, because the employer's job was just to contribute to that fund. After that, the employer is done. He doesn't care what happens with that amount. He just has to contribute that amount to the right place. Now, the moment the contribution happens, the risk of the employee starts. Employee is now liable for whatever happens with that money, not the employer. But sir, in case of defined benefit plan, what is happening? The employer is guaranteeing to the employee that listen, every month after you retire or every year after you retire, I will pay you a fixed amount. Okay. So sir, when the employee is going to retire, we have to pay a fixed amount to the employee. For that, we need to start contributing from today itself. So employer will do what? Make a fund, start contributing money into that fund. And we'll try to achieve returns with that fund in such a way that tomorrow, whenever this fund matures or whatever, that not mature literally, that fund is an ongoing cycle. But tomorrow with this fund, I can pay off the fixed monthly or fixed yearly thing that I've guaranteed. So whatever the benefit is, that benefit is guaranteed here. So with respect to the employer faces the risk with whatever happens with that money. Tomorrow, employer contributed this amount, so that in the future he can pay the benefit. And he with this money, he invested this money in some sort of security, let's say stock market. And tomorrow stock market went down and he suffered a lot of losses. Okay, can employer go to employee and say that, listen, I'm so sorry, I contributed the money, but the benefit that I guaranteed you, I sort of, promised you I cannot pay you anymore because the money, the place that I put the money in, sort of, I made losses. No, he can't. He will have to make up for those losses by contributing more money, right? So the investment risk remains with whom? The investment risk remains with the employer, unlike defined contribution plan. And that is what the difference is. And that is your defined contribution plan and defined benefit plan. Right. In defined contribution plan, investment risk is of the employee. Employer's liability is only the contribution. In defined benefit plan, investment risk is going to be of the employer because he guarantees the benefit. And that is what the difference is. And that is what is relevant to you guys from level 1 standpoint. Right. Now, what are the different participants that are there with respect to, capital markets? So what are the different participants that are there? There is individual investor, there is these pension plans. Obviously, guys, these pension plans are also market participants. How come? Because the employer has guaranteed a benefit to the employee. He is going to contribute certain money from today itself into a particular fund so that tomorrow he can pay the fixed benefit to the employee from this fund. Obviously, he's not going to keep that money idle. He's going to invest that money somewhere. So defined benefit pension plans also become what? One of the participant in the market. Then there is your endowment and foundation. Endowment is a university fund. Harvard University has a big fund, $2.5 billion. I'm forgetting the AUM, but they also have a big fund, and that's an endowment fund. It's a university fund. Where does money come from? Where does money come into that fund, sir? Alumni would have contributed. You would have heard Bill Gates contributed this amount to this endowment fund of this university, right? So all of these places, that's where the fund comes from, and then eventually the university, sort of collates all of that money and makes a fund out of it, and ultimately invests in the market in anything. It can be bonds, it can be stocks, it can be anything. Right. It depends upon whether they're allowed stocks or not, depends upon regulations depends upon regulations of every country. But the point is that is what endowment fund is. Foundation, what exactly is foundation fund? Foundation fund is a fund that is set up for a specific purpose, for a specific cause. For example, Reliance Foundation Fund. Reliance Foundation Fund is set up for multiple charitable activities. Example, children education, example, healthcare, all of those things. Right. So it is set up for a charitable purpose or any disease related cause. It can be cancer or cancer related fund or whatever that may be. Right. So that is the difference between endowment. Endowment fund is a university fund. Right. Foundation is set up for a specific cause. That is what the difference is. The next type of investors are your banks. Banks also invest in capital markets. There are your insurance companies. They also invest in your capital markets. Then there are your investment companies. They also come and invest in capital markets. Then there are your sovereign wealth funds. They also come and invest in capital markets. Right. Okay, sir. Fair enough. We understand. Sir, can we understand every investor from different aspects? What are the different aspects? Sir, let's say, for example, we talk about individual investor. What is the time horizon that is there with individual investor? Sir, it depends. I am young right now. I might have 33 years to retirement. Somebody who's 50 years old only has 10 years to retirement. So time horizon varies by individual. The kind of risk tolerance, I can take more risk because I have more time. But the person who's 50 years old does not have a lot of time. So it depends, right? Risk tolerance is very different. Income needs. I might not need any income because I have a lot of salary that's coming in, or I have, business profits that are coming in. Right, a 50-year-old possibly is going to retire in the next 3 4 years and would regularly might need income, or possibly needs income from now on, because he might have been kicked out of the job or whatever that may be. But the point is that the income need might vary from individual to individual. Liquidity need again varies, and I hope you guys understand the difference between income and liquidity need. Now, defined benefit pension plan. Defined benefit pension plan, I just explained, they sort of contribute an amount to a fund, and that fund will fund the retirement of the individual of their employee. Right. The time horizon is typically long term. Why? Because typically a lot of companies, whenever their employee sort of comes in and they start making these funds for them and sort of contribute, they usually have a lot of time, 10 15 20 years 25 years, because retirement usually is a lot of time, right? So yeah, they typically have a long term horizon. Not necessarily, but typically, right? Risk tolerance, guys, is very, very high, right? Why the risk tolerance is high? Sir, because they have a lot of time in their hands, right? And when you have a lot of time, your risk tolerance increases. Why? Because tomorrow, if you suffer losses, you can make up for those losses. How come? Because you have time in your hand, right? That is what this is. That's why it is said that markets in the longer term will always reward you. Why? Because all of those cycles of up and down, up and down, up and down, up and down will eventually average out and you will earn money, right? And that is what risk tolerance is. The next is income needs. Guys, obviously, if it's a benefit plan, obviously this fund would regularly pay to the employees who have retired. Now, to the employees who have retired, if you have to regularly pay, you would need what? Regular income, right? So if your defined benefit pension plan, the fund that you have made is mature, basically there are a lot of retirees, so you would need income regularly. But if your plan is at a very early stage, you have just started your company, and in your retirement plan, you have given a defined benefit pension plan, and a lot of your population, a lot of your workforce is very young. They have a lot of time to retire. That means your plan doesn't need to pay out to any retire to any employee right now, because no one has retired. So your plan is sort of a growing plan, and your income need is not that much. And liquidity needs will depend upon the maturity of the plan. Liquidity need is like one-time withdrawal and stuff like that. It would depend upon the plan. Right. Endowment and foundation. Now, endowment, sir. Endowment is a fund that is set up by university. Right. Sir, where does the money come from? Come from to that university? Let's say, for example, if I talk about Harvard, sir, it comes from, let's say, one of the sources can be, alumni contributing, charitable contributions and stuff like that. Right. Sir, endowment fund. Okay, sir, the money has come. The fund is made. Sir, endowment fund will invest in the market. Yes. Okay, sir, fair enough. Sir, okay, that is what it is. Sir, what purpose is this fund trying to achieve? What are we trying to do out of this fund? Okay, whatever the spending of the university is, we are going to fund that out of this particular fund. So basically, Harvard University has an endowment fund. So whatever salaries are going to be paid to the teachers of that university, example, is going to be paid out of this endowment fund. So that can be an income need for them. Liquidity need can be what, sir? Liquidity need can be what? Sir, they might need to set up a lab. For, let's say, Harvard thinks now they want to start researching on cancer. They want to set up a complete lab for it. It is going to require a lot of big infrastructure, hiring different scientists, different equipment, stuff like that. Right. So liquidity need might be there, but these kind of liquidity needs are not a lot for university. This is like once in 5 years, 6 years, 7 years. So, sir, from an income needs perspective, endowment fund will typically need that income to meet their spending goals. What were the spending goals? Sir, funding the salaries of their employees, basically teachers. Sir, liquidity need, it is generally low. Within 5 years, 6 years, once in, like 5 6 years, 7 years, you might need to set up that kind of lab. Sir, time horizon usually with these endowment funds are very long. They are typically long term, right? Because you don't need money apart from income or liquidity. You don't need a lot of money, to be honest. What is the expense that Harvard University is going to have? Right. Risk tolerance, again, with a long time horizon, you will have a high risk tolerance. Right. So foundation, which I have set up for a particular charitable purpose. Reliance Foundation set up for children education, for healthcare, for stuff like that. Sir, what is the time horizon they have? Again, long term, and again, the risk tolerance is high because of that. And income need typically, what sort of income do you need? You need to fund these expenses for the people you're trying to do charitable cause, for the people you are trying to, do charity for. You need sort of money for that. That is what you need your income for. So you want to meet your spending needs. And liquidity need is generally not there. It's very low for a foundation. But the point is that you need to preserve capital for the endowment and foundations are sort of made with the perspective that we need to make sure that we preserve capital, right? And that is what this is. Now, from a bank's perspective, sir, how does a bank work? A bank accepts deposits from people and ultimately lends out these deposits to people, right? In the form of loans, different types of loans. It can be home loan, it can be, loan against property, it can be, etc., whatever that may be, right? So, what is bank's agenda? What does a bank want to do? Sir, a bank has a lot of fund coming in from deposits. It uses that funds to ultimately lend to people. Okay. But does it utilize all of the fund to lend to people? No, sir. It doesn't utilize all of the funds. So if the bank is getting 100 crores, it might lend out 50 crores. So what about the rest of the 50 crores? What to do with that? Obviously, you can't keep that money idle. What are you going to do with that? You will try to invest it. Obviously, you cannot invest it in the stock market. There are restrictions that are imposed by RBI in our case. But the point is, you will try to invest that somewhere. Okay. Let's say, for example, treasury bills, government bonds, stuff like that. So the time horizon that you have is very short. Why? Because the money that you have invested, let's say 50 crores, the rest of it that you've invested in treasury bills and stuff like that, etc., whatever that you must have invested in. Okay, sir, you might need tomorrow whatever money that you've invested. If a withdrawal comes in from the depositors, you might need to pay them. So you need to invest in securities that are short term. So you cannot invest in treasury bills that are 10 years. You have to invest in treasury bills that are 1 year, or sort of commercial papers that are for a shorter duration. Because withdrawals, basically the depositors can withdraw the money anytime. Right? That's why you can't invest in for a longer term. So when you have a shorter term horizon, you can't take a lot of risk. And obviously with this money, too, you can't even take a lot of risk because of the restrictions that have been imposed. Obviously you can't do that with this money. Right? And income needs are very, very high. Why? Because you need to keep paying interest to the depositors. You sort of need to fund your operations as a bank, and yeah. And liquidity needs, if can be very high if the withdrawals, if the depositors decide to withdraw their money. Right. So, sir, as a bank, I don't have a lot of time with respect to the investments that I make. That's the first thing. Why? Because tomorrow liquidity withdrawal need can come in. Also, there are restrictions by RBI. So from a liquidity need perspective, sir, it is very low. Why? Because anytime depositor can withdraw. That's the first thing. Sir, income need, I will need to pay interest regularly to the depositors. All right. And that is what banks are. That's what, from a bank's perspective, these four aspects kick in. Right. The next is your insurance companies. There are two types. First is the life insurance company, and the other one is property and casual insurers. Life insurance companies obviously have a long time horizon. Why? Because typically people who buy life insurance, let's say for example, if I talk about term insurance, the policies that if you have to keep paying premium till the age of 60, if you die before the age of 60, you will get, let's say, 1 crore rupees. Right. So typically the people buy this insurance in the age of 30, 40 also, but the time horizon is 10, 15, 20 years. That's long term. Risk, you cannot take a lot of risk. Why is that so? For first starters, of course, there are regulation rules that are there, right? Second, tomorrow, what if claim comes? And a lot of people sort of, scenario like, let's say, for example, COVID kicks in and a lot of people die before the age of 60. You might have to fund a lot of claims. Where are you going to get the money from if you took a lot of risk and invested in the markets, like stock markets, example, right? So your risk tolerance is not a lot. Income needs typically low. You don't have to regularly keep on paying to your policy holders. You don't have to pay like how bank has to pay interest to the depositor, so they need income regularly from their portfolio. These people don't have to do that, right? Just hold on for a second, guys. Let me connect the charger. Yes. So these people typically don't have to do that. But so liquidity need is is also not that much. Why? Uh, because, sir, out of 1,000 people that I have sent sold the policy to, unless and until a COVID-like event kicks in, probably 5-10% people would die. I'm taking premium from 1,000 people and I have to pay claims only to 50-60 people at the tops. So I don't need a lot of money. So liquidity needs are low. But I cannot take a lot of risk. Why? Because tomorrow, if the claims come and if they come in large numbers, if I take a lot of risk with my investments, I'll be screwed, right? And with property and casualty insurers, basically, car insurance and stuff like that, the time horizon is short. Why? Because the life of the things that you're insuring, that is short itself. So car life would be 5-10 years, right? Risk tolerance, again, very, very low because your time horizon is very low. Income needs no income need. Why? Because you don't have to pay anything to your policy holders. Liquidity need is high. Why? Because claims arise unexpectedly. There is no sort of a guarantee that, out of 1,000 people that I have sold the policy to, only 5 or 10% claims would come. It can be very high as well. Uh, okay, sir. Because of the element of unpredictability, right? With respect to life, unpredictability is high, but I can see that out of 1,000 people, on an average, 5-10% people would sort of die before the age of 60. Not with different, not with cars and different types of insurance other than life. That is what this is. So that's what property, casualty insurers are. From their perspective, these 4 points look like. Right. Investment companies. What are investment companies? Example, HDFC AMC, asset management company, right? Pool money of the investors and ultimately invested in the market, right? That is what it is. Time horizon depends upon the fund, right? If I have a what do you call a growth fund, which is a small cap growth fund, obviously the time horizon is very, very high because the returns in this kind of fund is going to come after a very long, it's going to take time before the returns come and you get, rewarded for whatever risk that you've taken. But with respect to your what do you call large cap fund, the time horizon, okay, it's usually a safer bet and it's typically low. Risk tolerance again depends upon the fund. Small cap growth, a lot of risk. Large cap, not a lot of risk. Income needs depends upon the fund. I have a fixed income fund which is going to pay regularly the interest, right? So on that, I have to pay the income. But I have a growth fund. I don't need to pay anything on that. And liquidity needs are high. Because why? HDFC AMC, with whatever mutual fund schemes they have, they would constantly keep on having people redeeming their amount, right? So your liquidity need is extremely high. So mutual fund always has to make sure that some portion of their money is sort of available with them so that tomorrow when redemptions keep on coming, we don't have to liquidate our holdings and pay to the investor, right? And sovereign wealth fund, these are state-owned funds, right? So example, a fund of government of India, a fund of Abu Dhabi government. That is what it is, right? So these are state-owned funds. Wherever a nation has a surplus, they sort of invest it. They time horizon and all of those things sort of vary by fund to fund. So it may be long term, whatever that may be. So depends upon the fund, right? Guys, these were the different types of investor. Is everyone so far with me? Is everyone so far with me? Come on, guys. I know we have started with theory. The point and the reason for starting with theory was so that you guys would be fresh and we sort of cover up the whole thing very fast. All right. Guys, what are the different aspects of asset management industry? What are the different aspects of asset management industry? An asset management industry might have a buy side firm or a sell side firm. What are buy side firms? They are typically the ones that buy the securities. Example, mutual funds. They buy the securities. So they are buy side funds. Right. So what are sell side firms? Sell side firms that are involved in selling the securities. Example, investment banks. They come out with an IPO. What is IPO? IPO is where the company sells its shares for the first time to the public. That is selling. So investment bank is a sell side firm. Right. A broker. who's sort of facilitating a sale is a sell side firm, is a sell side broker. Basically, whatever the brokerage firm is becomes a sell side brokerage firm, right? That's what buy side and sell side is, right? What are the different types of asset managers, guys? There's a full service asset manager, there's a specialized asset manager, there's a multi boutique firm as well. Sir, what is a full service asset manager? They provide range of asset classes and styles. Example, I'm providing, in equity, I'm providing large cap growth, large cap, what do you call, uh, income. There's small cap growth, small cap income, and stuff like that. Right. So there are multiple categories and across different asset classes also. The fixed income, I might offer a commercial paper fund, which, short-term fund basically, a long-term fund, a purely government-oriented treasury bill fund, etc., etc. So I can also follow, I sort of also can, create a real estate fund and stuff like that. So basically across asset classes, I have variety of investments, right? That is what this is. Specialized asset managers, they only focus on a specific asset class or a specific style of that asset class. So let's say, for example, I have a fund which is purely a defense fund. Now, what is a defense fund? First, I'm investing in equity shares of companies that are manufacturing, defense equipments, right? Are involved in some or the other ways in defense, right? So that is what this is. And what is a multi-boutique firm? Multi-boutique firm is a firm that provides or basically has different specialized asset managers only under within one roof only. So I have a defense fund, I have a fund that is dedicated to IT, I have a fund that is dedicated to what do you call metals, I have a fund that is dedicated to let's say for example banks. So I have multiple funds, and each fund is specialized in its own, but all of these funds are available in one boutique itself, in one, within the umbrella of one firm itself, and that's what makes it a multi-boutique firm, right? What do you mean by active management? What do you mean by passive management? Guys, active management is something where I'm actively putting in my brains to select a security. I'm trying to do my own research, find my own model, not own model actually. I'm trying to use different models to sort of, do my and use my own research and try to find out what the intrinsic value using that model is of that particular stock. Invest in that stock, because it is undervalued, and then ultimately trying to generate that extra returns. That is what I'm doing. I'm trying to actively talk to the management. I'm trying to understand the business model. I'm trying to do all of that. That is what active management is, whereby my target, my mission is to outperform the market, right? So outperform the benchmark. I can use either fundamental or technical analysis. Obviously, guys, when I'm putting in more effort, my fees is going to be higher as compared to passive, where I'm simply replicating the benchmark. So what is passive? Let's say, for example, Nifty 50 is what I'm replicating. So simply whatever are the contents, whatever are the stocks within Nifty 50 portfolio, I simply buy those stocks in that exact same weight. I don't put in extra brains. I don't overweight one stock, underweight any stock. I don't do any of that. I'm simply doing what? I'm simply copying whatever Nifty is doing. So I'm copying the benchmark's performance, nothing else. That's what replication is, right? I'm tracking that particular index. Obviously, when I'm not putting in a lot of brains, why would the investor give me extra, what do you call, fees? He would say that, okay, you're simply copying, you're not putting in any brains, so your fees are lower, right? So, example can be how can you do active management by stock picking, by sector rotation. Passive management can be by index funds, ETF, smart beta strategy, etc., etc. Right. Sir, what is smart beta approach? What is exactly smart beta strategy? Where you use a passive approach and you only get exposed to one aspect of the index, one risk factor of the index. So let's say, for example, Nifty 50 is driven by multiple risk factors. Let's say, for example, value, size, volatility. These are the multiple risk factors that impact size, large cap, small cap, mid cap. Volatility, standard deviation. If it is extremely high, it's a high risk. Low, it is low risk. Right. So, you pick out any risk factor that you want exposure to and you only take exposure to that. That is what smart beta approach is. Sir, how do you do that? You go long in one, short in one. There's a different permutation combination that you do and, sort of reach that strategy. But the point is, what is smart beta? Only taking exposure to that one risk factor of that index. That's also a passive strategy. Why? Because you're not putting in any active brains. You're simply replicating the index, and that too in the index, you're only taking exposure to one risk factor. And why by strategy, what is the kind of classification that you can make? So there is traditional, there is alternative. Traditional, there are equities, there are fixed income. These are traditional investments. As you've already studied in alternative investment, there are two types. There is traditional and there is alternative. Traditional means equity, fixed income. Alternative means private equity, hedge funds, real estate, commodities. All of these are alternative investments, right? Obviously, alternative investment requires more effort. Sir, why, sir? Let's say, for example, I could talk about a small cap manager, or let me just not take a small cap manager, a mid cap equity manager, right? He's trying to analyze an equity, a stock of a company which is currently mid cap, right? Okay, sir, he has to analyze the stock. That means he has to predict what the stock price should be currently. For that, he might use a model. Okay, um, but he might have a lot of examples in the past which he can use to form a base and start working on valuing this stock. Sir, meaning, let's say, for example, this mid cap stock is of a hospital. Now, there are a lot of hospital stocks that are listed. You simply have to see how they have been valued in the past. There are a lot of metrics that are already available on how to value these stocks. Example, revenue per bed, one of the metrics that can be used to sort of value this stock. So all of these things are available in order to be able to value this stock of hospital. So as a manager who's valuing this, I have a metric, I have a base that is sorted. Okay, sir. But when I talk about somebody else, let's say, for example, or let's when I talk about somebody else, what do I mean by somebody else? I'm talking about a private equity manager. Let's say, for example, I'm trying to value Zomato 10 years back. Now, I don't have any yardstick. I don't have any benchmark like how this mid-cap manager had with respect to hospital, with respect to valuation of a hospital stock. I don't have anything of that sort. Why? Because there was no business that existed like this before. There is nothing. There's no sort of benchmark that I have. How do I value this? Sir, I might have to predict what are the number of users who are going to use internet. What is the income? These are the people who are going to be beyond this income level who are going to use Zomato 10 years later. This is what do you call people who are going to be in urban areas are primarily going to be the population who's going to be using this. There's so many factors that I have to sort of look at and try to predict so that I can value this particular company. Obviously, when I'm doing all of that work, which requires extra effort, I'm going to ask for more fees. Right. That's why in alternative investments, you sort of get more fees. And there are a few trends that are there in asset management industry. Passive management is sort of increasing, where passive investing is increasing. People are preferring more passive investment as opposed to, active management. Why? Because the fees is lower. Active managers have not been able to consistently, beat the benchmarks. A lot of data and tech driven decisions are also coming in into investing. Analytics and all of those things are kicking. That's why to put it as, it's very simple and straightforward. Robo advisors are coming in. What are robo advisors? Let's say, for example, if I take chat gpt, so you sort of plug in the data into chat gpt that this is what your current circumstances are, this is what it looks like, this is the kind of income that you are currently making, this is what your goals are, so it can sort of advise you, right? So for a small investor, is very cost effective. Right. Obviously, ChatGPT and all of these AI tools would never give you exactly right investment, or probably even they might give you something that's very off than where you are currently. But the point is that for a small investor, is very cost effective, right? They at least get a direction. It's very popular with younger investors, and there are very low barriers to industry with respect to this, right? That's what robo advisor is. So that is what it is, right? Okay, now let's go to our next topic, which is mutual fund. How much are we left with this? Acha, not a lot. Now, very, very simple. Right. Guys, what exactly is a mutual fund? In mutual fund, a lot of people pool their money, and this mutual fund then against this issues units, and this mutual fund invests the money in the market. Right. That is what it is. Okay. Sir, there are two types of mutual fund, right? There is open-ended fund and there is closed-ended fund. Sir, what is open-ended fund? A fund which never stops accepting the money from public at large, right? So every day it will accept money from people. Every day it will issue units to the people. So let's say, for example, if I'm talking about 1st August, and if you want to buy units of this fund, which fund, sir? Which is an open-ended fund. If you want to buy the units of this fund, at what price can you buy the units of this fund? Sir, first things first, it is an open-ended fund. So it will keep on accepting money from people. Okay, sir. What is the rate at which I can buy the unit? Net asset value, NAV. Sir, what is NAV, sir? NAV means NAV is net asset value of that fund. So how much is one unit going to be traded at? How much you can invest, how much you can buy one unit at? That's what NAV is, net asset value. Okay, sir. So it is total value of the fund asset. So wherever the fund has invested the money, minus the liabilities of the fund, if it owes some money, whatever that may be, divided by number of outstanding shares or number of outstanding units of that fund. So let's say, for example, today I have to invest on 1st August, I have to invest in the units of this particular fund, which open-ended fund I have to invest. At what price I will get, this unit at the NAV. So let's say the NAV is rupees 30. So I will get units at rupees 30. Sir, how do you calculate this NAV? Sir, we take the total assets of the fund minus liability of the fund divided by number of units of the fund. Now, again, this is something that will not be tested in terms of formula and stuff. This is something that you need to know, right? So open-ended funds, the shares are issued continuously because they keep on accepting the money. Okay, sir, if they keep on accepting the money, do they redeem the money as well? Yes, obviously, whenever an investor needs money, it will simply go to the fund and listen and tell the fund that, listen, these are my units, please give me money against this unit. So it will give the units to the fund and fund will issue the money against it. Obviously, that will be on the NAV of that date. So let's say, for example, I want to sort of redeem my units that I have with this fund today. I will sort of give the units to the fund and I will get back, NAV into the number of units. So whatever the NAV of the day is into number of units, right? So redemption is also at an NAV. Trading with the fund, not with an exchange, right? So trading meaning if you have to buy the units of this fund, sell the units of the fund, you typically trade, you typically deal with the fund itself. So a large cap fund, which is sort of what do you call an open-ended fund, if I have to buy and sell, I will deal with the fund itself. Fees, whatever the management fees is, and there is a possible load fees as well. So what do you mean by load fees? What do you mean by load fees? Load fees is something that is levied at the time of redemption and at the time of buying the funds units. Sir, meaning not all the funds levy this. First of all, let's say, for example, if I have to, there's an open-ended fund. Okay, sir, there's an open-ended fund. If I have to buy the units of this fund, I have to give NAV plus 5%. So if NAV is 30 rupees, I have to give 30 plus 1.5, 31.5 to buy one unit of this fund. So this extra 1.5, why am I paying? This is a load fees that I'm paying. Why? Because typically funds, sort of levy it so that not a lot of ad hoc money comes into the fund and not a lot of money is redeemed. Because when you levy a fees, people will think twice before redeeming or, buying the units. All right. Sir, okay. Sir, uh, at the time of buying, we understand at the sell time of selling, how does it work? So this is 5%. Let's say 30 rupees was the NAV today. So 30 minus 5%, that is 30 minus 1.5, 28.5. And you want to tomorrow redeem the units of this fund, you will get 28.5 rupees against one unit because there's a load fees that has been levied by this fund at the time of redemption. So let's say, for example, you're going to redeem today, the NAV is 30 rupees. You're supposed to get, for one unit 30 rupees, but there's a load fees. So 5% will be deducted. So 1.5 rupees will be deducted and you will get 28.5. And that is what load fees are, right? And obviously you will always get this fund at NAV, whether you want to redeem or whether you want to sort of invest, you will always be dealing with respect to NAV in this fund. Okay, sir. Close-ended funds, what are they? These are the funds that do not accept money continuously. So let's say, for example, as a mutual fund, my target was to raise 1000 crore. So I have raised 1000 crore. And against this 1000 crore, I have issued what? 100 units in the market. Now, only these 100 units will be there in the market. I will not issue any new units. Okay, sir, you will not issue any new units. So if a new investor wants to invest, how can he invest? He will buy from the existing investor. So an existing investor can sell the units of this fund, which fund? Close-ended fund on an exchange. So they are exchange traded exactly like shares, right? So company issues shares for the first time in an IPO. You can buy and sell the shares of that company on an exchange exactly like that. Close-ended funds issues the units only, fixed number of units. And tomorrow, if you want to buy and sell this units, you can deal with the unit, you can deal with this on an exchange, right? That is what a close-ended fund is. So the number of shares that are there are fixed. They're traded usually in secondary market. There is no redemption from the fund, right? That is what this is. So if you want to tomorrow liquidate your holdings in this mutual fund, like a open-ended mutual fund, you went to the mutual fund. Here you don't go to the mutual fund. You simply go on an exchange and you sort of sell your units. And if there's somebody wants to buy, he will buy. These are exactly like stock on an exchange. What is the fees that you bear with these funds? Whatever the ongoing management fees is, you have to bear that. And obviously, they can be traded at a premium and discount to the NAV. Obviously, sir, close-ended fund would also have an NAV. Why? Because their funds, the assets that they've invested, that will also keep on changing. That will keep on fluctuating. The value of the assets that they have invested in. Obviously, so NAV will change. Okay. But sir, is the unit of that mutual fund going to be traded at NAV? Not necessarily. Why? Because, sir, it is going to be traded on an exchange. So if something is traded on an exchange, the market demand for that particular unit, the market supply for that particular unit of mutual fund will determine the price of that unit. So if the demand is too high, that particular unit might be traded at a premium to the NAV. If it is too low, if the supply is too high of that particular mutual fund unit, then it might be traded at a discount to the NAV. So that is what a closed-ended mutual fund does, right? Load fund, no load fund. I have sort of explained that. Not all of the mutual funds have these load fees, but this is what it is. What are the different types of mutual fund, guys? There is money market funds, which typically invest in, shorter term debt securities, like commercial papers and stuff. What are bond funds that invest in fixed income securities? Government bonds, bonds that have a high yield. Probably you can also invest globally. Stock funds, what are stock funds? You can invest in equities. It can be active or passive. Index fund, these are typically passive. Let's say, for example, SBI Nifty 50 ETF. So this is something that is simply replicating the index, right? So you can replicate S&P 500 or Nifty 50, whatever that may be. Actively managed fund, we understand that your aim is to outperform the market, obviously higher fees, and obviously the turnover is going to be a lot. Why? Because you typically will constantly buy and sell to uh, uh, land at the right security, unlike a passive fund which is simply replicating the index. So if a security is removed out of index and included, then that's the only time you will sell the security. Otherwise, you're simply replicating. And securities are removed out of index rarely, not a lot of times. Right? Exchange traded funds, what are they? The units of these funds are exchange traded. Right? That is what exchange traded fund are. So a fund whose units are exchange traded, that's what makes it exchange traded. Like they trade like stocks. You don't redeem, guys. This is exactly like closed-ended funds. Closed-ended funds are typically exchange traded. So exactly the same logic is flowing. That's why I'm trying to cover this fast, right? So redemption is typically not with the fund directly. Fees again lower than mutual funds, typically because exchange traded funds are passive funds. Tax efficiency higher than open-ended funds. Why tax efficiency is higher than open-ended funds? Because open-ended funds are usually actively managed. So when they are actively managed, the buying and selling happens a lot. So if buying and selling happens a lot, capital gains come in and your tax efficiency reduces. But with respect to ETFs, which are usually passively managed, what happens? Buying and selling doesn't happen that often. And when buying and selling doesn't happen that often, your capital gains doesn't arrive that much, and your tax efficiency typically is more because you're not paying a lot of taxes. Right? They're typically passively managed, and special provisions, arbitrage mechanisms keeps ETF price closer to NAV. You will typically see that, you know, because of arbitrage in the market. And again, what do you call, with whenever market has an ETF, typically the liquidity is a lot. So when liquidity is very healthy, a lot of investors are there, to typically the prices are closer to NAV. There is no sparkling difference between demand and supply. Right, that is what this is. A separately managed account is something that is like, let's say, for example, there's a big investor, let's say somebody like Rakesh Junjunwala walks up to Motilal Oswal and says that I'm going to invest 1,000 crore, but I want my account to be separately managed. That is what a separately managed account is. So a portfolio that is managed typically just for one investor. It is tailored obviously to individuals' preferences and tax situation. So if Rakesh Jhunjhunwala falls in a particular tax bracket, obviously you will try to manage that particular fund via that particular tax situation that the investor has, right? And no shares are issued, obviously, because it's a separately managed account. Hedge funds, guys, we understand hedge funds. Hedge fund is typically, as my teacher used to say, is Amiro ka mutual fund, right? So a mutual fund where a lot of risk is taken. I mean, not mutual fund, a fund where a lot of risk is taken. So you sort of typically employ short selling strategy, you use derivatives, you use merger arbitrage, you use all of that, right? They're not very heavily regulated. Why? Because people with a lot of capital invest here. So when a lot of people with a lot of capital invest, regulation is typically low. Why? Because they don't need to be regulated. Small investors need to be regulated, not these people. Right? This is only typically for qualified investors. The minimum investment is very high, 2 to 8 crores. Can use leverage, derivative shorting, often aim for absolute returns. They don't have sort of comparison that we are trying to beat this or that. No, they're trying to aim for absolute returns. Private equity, venture capital, we understand typically invest in private companies. So it can be at an early stage, it can be at a later stage. When it is at an early stage, you sort of call it a venture capital fund. If it is in a later stage, we call it private equity. They invest in private firms and you go for IPO for sale. Lock-in periods are very long. Managers take active roles in guiding company strategies. And only few of them will sort of deliver the returns. So out of 10 investments you make, the one that is going to be there is going to give you like a huge amount of return. 500x, 400x, 300x, right? You will see a lot of funds. You pick out a lot of different funds. They will obviously have only one or two success stories. So let's say, for example, if I talk about Sauce VC, It's a popular venture capital fund and has a lot of investments. Like if you must have heard of the brands XYXS, or you it's a clothing brand. You must have heard of the brand, let's say Mokobara, sorry, if you would have heard of this brand, these kind of brands they've invested in. So, only one or two, three or four success stories is what they have, right? So this is what your chapter looks like. You're done with this chapter. I hope you guys have understood everything and we have been effectively able to revise everything in and out in a detailed manner, yet summarizing everything that was required from an exam point of view. Guys, I hope you guys have understood everything in the chat box. Quickly tell me how you guys liking the revision. Are you guys understanding everything? Is the pace good? Is everything going very well for you guys? Hi, Anna. Perfect, 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 perfect. Thank you so much, guys. All right, let's move forward now. Let's move forward now. Let's go to our next reading, guys. है ना थोड़ा दम करते हैं ना? अगला रीडिंग भी करते हैं ना, गाइस? नहीं सर, थक गए। चले आगे चले कि नहीं? एक तो आई एम वेरी यूज्ड to you me asking and you sort of responding very quickly, but I have realized ki there's a lag, there's latency that's there, so can't have quick replies. Anyway, और बताओ क्या चल रहा है? Let's talk for like 1 or 2 minutes. थोड़ी फट रही है? How's it going, guys? चलो, let's go to the next one, guys. वैसे भी मैं तुम्हारे लिए बस ओपिनियन लेना नहीं चाहता, मतलब ऐसे ही पूछ रहा था बस। एनीवे मैं पढ़ाने ही वाला हूँ, आई एम नॉट गोइंग टू। यार अनफॉर्चुनेटली गाइज, आई बी ऑनेस्ट विथ यू, वी डोंट हैव दैट मच टाइम टू do the questions. I'll be very honest. Uh, I'm expecting that you guys have solved questions as well. All right. If you want at the end, एक 15-20 मिनट में, आफ्टर वी आर डन विद दीज फर्स्ट 4 रीडिंग्स, मैं आपको सारे क्वेश्चंस एक बार ऊपर ऊपर से देखो, मतलब आई एम नॉट गोइंग टू, सारे क्वेश्चंस तो नहीं हो पाएंगे ऑनेस्टली, बट वी कैन डू क्वेश्चंस ऊपर ऊपर से एक बार कि यार ऐसे करते हैं, ऐसे सोचते हैं। आई कैन सॉर्ट ऑफ do that with you guys. Okay. Anyway, chalo, let's start with the next chapter, guys. Basics of portfolio planning and construction. All right. Okay. Let's go now. Guys, we understand what an IPS is. IPS is a written document about the investor, right? What are the objectives of that investor? What are the constraints? What are the guidelines with respect to that investor? We understand all of that, sir. We understand that basic, that what do you mean by IPS? Formal document where objectives are there of that client, constraints of that client are there, preferences of that client are there, the guidelines with respect to that client is there. Sir, let us quickly take an example of an IPS, sir. Let us quickly take an example of an IPS. Let us talk about Mr. Rajat, again, 35-year-old who's a Mumbai-based professional. Guys, this is what his IPS looks like, right? What is the description of the client? His age is 35. He's a CA. His income is 20 lakhs. काफी कम है. CAs की इतनी कम नहीं होती at the age of 35 years, honestly. Anyway, so 20 lakh annually, 25-year is the horizon that he typically has till retirement, right? So this is what the description is. What is the purpose of this IPS? What is the purpose of this investor investing in the market? Sir, it is long-term investing. And the goal is that we want to proceed for his retirement. We are investing with respect to his retirement. What are the duties and responsibilities of different parties here? The person who has prepared this IPS, the advisor, His responsibility is selecting the investments. Custodian, holding the funds. So whatever, let's say for example, your NSDSL, NSDL, CDSL, all of these people are custodians. They hold the shares. Exactly like that. There's a custodian. Right now, there's not a lot of relevance of this, but anyway, हाँ. What is the responsibility of client? अरे approvals दो भाई, यहाँ invest करे नहीं करे. Right. When do we update the IPS? Sir, either review it annually or after a major life event. Rajat lost his job, a major life event. Update the IPS. Right. What are the objectives? Return of 11 to 12%. Risk, moderate. Constraints, he'll need 10 lakh in 3 years. Why? Remember the down payment of home. That's what he wanted to do. Right. He avoids tobacco and alcohol. Stocks, stocks. Personally, I don't know. But stocks. Yes? Guidelines 60% equity, 30% debt, 10% gold. Right. This is what the investment guideline looks like. No leverage. He doesn't want to invest or he doesn't want to have any leverage and he needs semi-annual rebalancing. Remember, our equity weight went up to 70%. Right? We had to rebalance and bring it back to 60% in the previous example of Rajat we took. All of that rebalancing should be done semi-annually in this case. How do you evaluate the performance? You compare again Nifty. Like anyway, this part I sort of want to ignore, not touch upon this here. An appendix, what do you mean by appendix? This is an asset allocation table. That this is what our asset allocation looks like. 60% equity, 30% debt, 20% fixed income, 10% REIT, 10% something else. And the deviation is also given that, obviously you can't stick to your plans exactly. That's not possible ever in life. You need some sort of room so that, you can, what do you call, exist. Basically, sir, what do you mean by that? You can't go exactly as planned. You need some room for spontaneity. So here, yeah, the deviation that is allowed is plus 5%, minus 5%. That means equities weight can be 65 or 55%. But this is the range that we want to typically be in. Right? You can't exactly have that weight. It's not possible. That's why this is what this is what an appendix tells us, that these are our weights and this is the fluctuation that is allowed. So the first thing that we saw in an IPS was the description of the client, which describes his age, employment, family status, income and wealth level, financial goals. The second is a statement of purpose, right? It is a guiding document for managing the portfolio in line with client's objectives and constraints. Baba, retirement हमारा goal है. That is what it is. Duties of responsibilities, statement of duties and responsibilities. What is the duty of investment manager, of the custodian, of the client? Right. The next is procedure to update the IPS. In our case, it was semi-annually. Right. So you define when and how the IPS should be revised. If there's a life event that is a life altering event, losing the job, divorce, आपने मम्मी के नाम पे सब कुछ नहीं किया, गया 50%, गया 60%. Hardik Pandya was smart. Anyway, so the point is that these are life event and that's important. These are life altering event and that's important that you accommodate it. Right. What is the kind of, how often do you need to rebalance? Every 6 months. What are the objectives? 11 to 12% is the kind of return that you would need. Depends. Sir, how do you arrive at this 11 to 10%? This depends upon the risk and return preference of that particular client. What are the constraints of that client? 35 years. So he's 35, he's going to retire at 60. So 25 years is the time horizon. Liquidity needs 10 lakh rupees in 3 years. Legal restrictions, there might be some legal restrictions. Let's say he's a chartered accountant and he's working in a big four firm. And in one of the firms, he's auditing one of the companies. And as an auditor, he's not allowed to buy the share of that company. So let's say he's auditing Tata Motors. So he's not allowed to buy the share of Tata Motors. Ethical preferences, alcohol and tobacco stock. Tax considerations, what are his tax considerations? What sort of bracket he's falling in, XYZ, all of those things. Right. Investment guidelines, asset classes that are allowed, right? Equity, fixed income, whatever. Whether you can use leverage or not. What are the triggers for rebalancing, right? If the weight goes off, like let's say beyond 65%, then for equity, that's a trigger, right? What are the restriction on sectors and instruments? Might not want to enter in derivatives. All of this is repetition again and again, guys. Same thing. Evaluation of performance. What is the benchmark, right? How often do you want to evaluate? If you want to replace because the manager is not performing well, at what point do you replace? What is the criteria for it? Right? An appendix is basically what is my asset allocation. right? And what do you mean by strategic? What do you mean by tactical? What is rebalancing procedure? All of this rebalancing procedure. So I hope you guys understand. Like buy, sell equity and buy fixed income. These two things are not yet. You have not understood this very well. We have not yet discussed this. So I'll keep that on hold. Don't worry. This is what your IPS typically looks like. All right. And the first page talks about the same thing. The purpose, it has to be clear. Your risk and return objectives have to be defined. Your goal setting has to be realistic. You don't have to be ambiguous. You have to make sure that there's a legal and ethical record as well. A lot of things. Again, very simple. I think you can quickly, if you want, take a look and read this. All right. All right. Now, an IPS typically would have different elements. Let us discuss different elements of IPS. The biggest point of confusion in this chapter is, sir, ये तो introduce कर दिया आपने. बाकी आगे क्या है chapter में? What is there in this chapter? IPS typically has different what aspects to it. Let us start to discuss the first aspect, which is the risk and return objective. What is the risk objective of that individual? So, what is risk objective, sir? It defines the acceptable level of uncertainty that the client is willing to tolerate. Right. Sir, what do you mean by that? Okay, let us take an example. Let's say, for example, the client is saying that I would not want a loss of more than $20,000 in the next 12-month period. That means he has defined the acceptable level of uncertainty he is willing to bear. How has he defined that? By saying that I am not willing to take more than 20,000 rupees of loss or $20,000 of loss in the next 12-month period. Now, sir, how do we express the risk objective? How are risk objectives expressed? There are two ways it is expressed. First, in an absolute manner, absolute risk objective. Second, relative manner. Sir, what is absolute? What we just saw. There are different types of absolute objectives. There's percentage based, dollar based, probability based, asset backed, low risk objective. Example, sir, what is percentage based? Not more than 2% decline in portfolio value over the next 12-month period. That means if my portfolio is rupees 10 lakhs, I don't want my portfolio to decline by more than 2% in the next 12-month period. This is a probability based, percentage based risk objective, absolute risk objective. Sir, dollar based risk objective, what we just saw. You have defined the amount that this is the maximum you are willing to lose. Percentage based, you have defined the maximum percentage you are willing to lose. Probability based, not greater than 5% chance of falling below 5% in the next 12 months. Right? Not more than 5% chance. I don't want the probability that my portfolio falls below 5% in the next 12 months to be more than 5%. I hope you guys are understanding. I'm trying to just active passive do that thing with this. Right. An asset based low risk objective. What is that? That listen, we are going to only invest in treasury bills. Right. This is usually used when capital preservation is your thing, that you want to preserve capital. You don't want to take a lot of risk with your capital. This can be, you have a lot of retirees in your fund currently, and you want to make sure that you don't screw up whatever the investments that that you have made, and so that you have to make sure that your risk is typically low with that. So that's why you invest in T-bills. Right. What are relative risk objectives? So the first part is absolute. What is relative? Absolute was defining the risk exactly. Relative, it will define that risk with respect to something. So meaning, let's say for example, we talk about a benchmark based relative risk objective. Return should not be more than 4% below the MSCI World Index annually. So if the MSCI index is earning 12%, the maximum that you can earn, maximum you have to, I mean, not maximum you have to earn, let me just put it this way, you have to at least earn 8%. If you earn below 8%, it is not good. So you can maximum be 4% below the benchmark. Benchmark is 12, maximum you can be at is 8, not below 8. Not maximum, minimum you have to be it as 8. Sorry, my bad, guys, my bad. I'll again repeat. My bad, guys. I'll again repeat. What do you mean by a benchmark based relative risk objective? Here, your return should not be more than 4% below the MSCI World Index annually. If the MSCI World Index is earning 12%, the minimum return that you have to earn is 8%. That means the maximum you can afford to be below the MSCI World Index is 4%, not more than that. That is what it is. What is yield based? Return should exceed LIBOR by at least 1.5% per year. So if LIBOR is 10%, you should at least earn 11.5%. These are relative risk objectives. You are trying to define your risk relative to something, right? Peer group based. Be in the top quartile of university endowments, right? Top quartile. So basically, let's say for example, you have to be in the top 10% of all the different endowment funds. So this is your top decile, right? So for you guys to pass, you have to be in the 40%. Right. So that is what peer group based is. So you're trying to compare via the peer group. So first objective was, sir. So what are we trying to understand, sir? Different aspects of IPS. Sir, the first aspect of IPS that we are trying to understand is what? Sir, it is my risk objective. Sir, risk objective is of two types. It is relative, it is absolute. Okay, sir, we understand. Sir, what is the next part? Sir, next part is return objective. Return objective is what? This is the return that I want to achieve. Right. It can also be absolute, it can also be relative. But this is the desired growth or income that you wish to have from the portfolio. Absolute risk objective, we want 6% annual return, or we want return of 3% above inflation. This is absolute. Right? Relative, exceed the S&P 500 by 2% annually or beat Nifty 50 by at least 1.5%. 150 basis point is 1.5%. Acha, one thing guys, how much is 1 basis point in percentage? How much is 1 basis point, guys? Perfect. 0.01%. True. All right. One more thing, again, there's a lag, so I'll not be able to interact a lot with you guys on chat because बहुत ज़्यादा lag आएगा, बहुत ज़्यादा waiting time होगा, तो आपको उसके बाद में लगेगा कि मैं 1 मिनट तक wait ही कर रहा हूँ. तो that's why I'll keep on continuing, I'll keep on talking. ठीक है, जब break लेंगे जब हम लोग बात करेंगे. Alright, guys. Guys, what are the key considerations whenever I'm setting up the objective? Guys, my risk and return must be compatible. ऐसा नहीं है कि भाई मेरा return objective है 15%, but my risk tolerance is very low. Now, if your risk tolerance is low, how can you achieve that kind of return? So it is very important that your risk and return objective are based on the goals of the client, the time horizon that he has. Now he only has 5 years to retirement and he has come to you that, listen, please manage my portfolio. Now there is not a lot of time, right? What is the risk capacity? What is the tolerance? What are the market conditions currently looking like? All of those define what sort of risk and return you can take, right? So this was to do with return, risk objective and return objective, right? Now let us try to understand the concept of ability to bear risk and willingness to bear risk. What is ability to bear risk and what is willingness to bear risk? Ability is based on your current circumstances. You are 35 years to retire. There are more 35 years for you to retire. Okay. That is your circumstance. And because you have 35 years to retire, that means your risk-taking capacity is high. Your ability is high. You have a lot of inherited money. Your parents left you a lot of money, big estate, a lot of money, a company, house, everything. That means your ability to take risk is high because it is driven by your circumstance, right? So ability is what? This is to do with the circumstance of the investor, the risk capacity of an investor. Longer time horizon, higher ability. High net worth, higher ability. Stable secure income, higher ability. Lower liabilities, higher ability. More insurance coverage, higher ability. Right? Ability is your strength, your financial strength, that tomorrow if you suffer losses, will you be able to absorb them or not? Because I have 35 years to retire, that means tomorrow, even if I suffer losses, I have enough time to make up for those losses and make profits ultimately. Right? That is what this is. What is willingness? Willingness comes from your attitude. Your ability might be very high. You have a lot of net worth that is coming. You have a lot of inheritance that comes from your parents. You have a lot of time to retire. But as a human being, you don't like to take risk. Your attitude is not somebody you attitude is not somebody who's a risk taker. You're not willing to take risk. Right? That is what your willingness is. That is the attitude that you have. This is a psychological comfort that you have with uncertainty. And not a lot of us have that psychological comfort with uncertainty. And we all want certainty in our heads. None of us are going to be okay when things are uncertain and are going to be fine. No, none of us are. Very few people are. So what is willingness? Your comfort, your psychological comfort with uncertainty and volatility. It is very subjective. It is driven majorly by emotions, past experiences, etc., etc. So often, how do you assess this, sir? You have a risk tolerance questionnaire. You sort of ask a set series of questions. This is what happened. This is what. So you sort of try to assess that whether the willingness of the person is there to take risk or not. It can be influenced by the past investing experiences. That if he has suffered a lot of losses in the past, today he would not be very keen on taking a lot of risk because he's had, you know, losses, a lot of losses previously. You will see a lot of our parents' generation would always talk negatively about stock market. Why? Because their past experiences, they've seen a lot of scams happening. They've seen 1992, they have seen your Satyam, they have seen so many things and they have sort of lost confidence on the stock market. They did, and now slowly it's coming back. But the point is that their experiences were not good. What sort of financial literacy do people have? What are the personality traits that they have? अभी कोई laid back आदमी है जिसको ज्यादा रिस्क नहीं लेना है तो वो क्यों not? What is the market risk currently that is there? So willingness is the emotional comfort, but it is very important that the ability to take risk and willingness to take risk is in line. Meaning, my ability to take risk is very low, but my willingness is very high. What? My ability is very low, but my willingness is very high. Can I take a lot of risk? No, bhai, you cannot. Attitude से कुछ नहीं होता. Circumstance भी देखना पड़ता है. My willingness is I want to take a lot of risk. I want to take a lot of risk, but I have 5 dependents on me. Can I take a lot of risk? No, sir. So ultimately, my risk tolerance would be what? Low only. So if my ability is low and my willingness is high, my overall risk tolerance is going to be what? Low only, sir. If both of them are high, obviously, sir, my risk tolerance is going to be high. And obviously, I will invest in securities that are high return. Basically, more risk. Both are low. Obviously, sir, it is low. So I will obviously take lower risk. Sir, if my ability is high, but my willingness is low. My ability is high, but my willingness is low. बहुत सारा पैसा है फैमिली से आया हुआ स्टेबल जॉब है लॉट ऑफ टाइम टू रिटायर ऑल ऑफ दोस थिंग्स आर देयर बट द प्रॉब्लम विद दिस पर्सन करंटली इज हिज विलिंगनेस इज नॉट देयर टू टेक अ लॉट ऑफ रिस्क. Sir, what to do in this circumstance? Educate the person, educate the investor. Talk to him that listen, your ability is very high. Why do you have lower willingness? Please invest, take more risk because you have so much comfort that is there. You have so much, ability to absorb the loss, not comfort, ability to absorb the loss. Why aren't you taking that risk? You try to educate the investor. Obviously, after that, even if he says no, you don't lose the client. You do what the client says. But you have to educate the client and let him know that is what this is. So that's how you reconcile your ability and willingness. So if the willingness is too low, but the ability is high, educate the client. And if the ability is low, but willingness is high, you avoid the risk exposure and you protect the capital of the client. And that is what your ability and willingness to take risk is. Right. So you are understanding different aspects. The first aspect that we have understood is risk and return objective. We have understood risk and return object from an absolute and a relative perspective. We understood what are the different types, what are the different aspects of risk, willingness and ability and all of those things. Right? What are the different other constraints that are there or elements of an IPS? What elements of an IPS? Sir, what do you mean by elements? I'm typically talking about constraints, right? Every IPS will have certain amount of constraints. Obviously, risk and return is not exactly a constraint, but yes, it is also part of it. So, sir, RRTTLLU is the checklist. That is what you say. R, risk objective, return objective. L is your liquidity. T is your time horizon. Other T is tax. L is your, what do you call, legal and regulatory. And unique circumstances is U. So RRTT LLU, that is what your typical IPS analogy is. So whenever you talk about IPS, the first thing that should come to mind is RRTT right? Risk and return, we are done with. These are the different other constraints that are there with respect to an IPS. Sir, what are the different constraints? First is liquidity constraint, right? What is liquidity? Sir, we understand liquidity, sir. Ability to convert into cash quickly without major loss in the fair value, right? Liquidity is the one-time need that you have from the portfolio. It can be paying for the college tuition, emergency medical expense. You can be, down payment. You saw in case of Rajat, or any living cost that is there, right? So obviously, a person who has all of this should avoid investing in illiquid assets. What are illiquid assets? Sir, hedge funds, private equity, real estate. You should have more matured bonds, money market instruments, ETFs that are liquid. You should invest there. So this was one of the restrictions, one of the constraint that is usually there in an IPS. The second one is your time horizon, right? What is the time that you have for the investment that you're making? For Rajat, it was 35 years, right? So if your time horizon is short, you need stability and liquidity. Why? Because you cannot take a lot of risk because you don't have a lot of time. But if it is long, then you can take more risk. You can, have more volatility. And obviously, when you have more volatility, you can be exposed to more equity. So a 2-year horizon will obviously have a conservative portfolio, but a 20-year horizon will obviously have equity focused portfolio. That is what your time horizon is. The other one is tax consideration. For that investor, how would how would what how would their incomes, gains, whatever they withdraw will be taxed matters. So if that investor is an endowment or a foundation, they would have a different tax rule. But that investor is individual, might have different tax rules applicable to them. So you have to make sure that you invest the money according to the tax situation of that particular investor. Right? How taxes will impact the incomes, gains, and withdrawals. If the tax bracket is high, then the client may prefer municipal bonds, capital gain versus, they would prefer capital gains as opposed to having interest income, because capital gains typically are taxed at a lower rate as opposed to interest income. So a client which you have has a higher tax bracket. What do? You typically invest in tax-free bonds so that they can protect, they can protect their taxes. Uh, Basically end up paying lower taxes. They may prefer more capital gains as opposed to interest income. Basically more equity as opposed to bonds. Reason because capital gains are taxed at a lower rate. You can have tax advantaged accounts. You know there are different types. Tax exempt account, tax deferred account. Tax deferred, you can defer the tax when you withdraw. Tax exempt, tax is altogether exempt. Basically a lot of different retirement accounts and stuff. But the point is that you invest or you focus on after tax returns, right? That is what your ultimate focus is. What are legal and regulatory factors, guys? What are legal and regulatory factors? That's another constraint that is there. you know Example, in our case, Rajat was auditing a particular company called Tata Motors. So obviously you cannot buy the stock of that particular company. That's a legal restriction that is there, right? The company that I work for, I might be refrained from trading in the stock of that company because I'm at a higher level, right? So corporate officers might have this, trusts may have guidelines on asset types. So particular trust that has been created, that trust would have a guideline that you can only invest here and there, in these particular types. There might be legal limits on foreign investment exposure. How much foreign exposure that you can have, there can be legal limit to that as well. So the portfolio manager is supposed to make sure that there is full compliance with this. That's very important. All right. And the last restriction that is there is unique circumstance. Not the last actually. We're done with everything, I guess. Yeah, we're done with everything. The last restriction that is there is a unique circumstance of an individual. you know what is the ethical viewpoint of that particular investor, religious, personal preferences, doesn't want to invest in tobacco or firearms, wants to go for ESG investing. He's a founder of a tech startup, so doesn't want to invest in other tech startups, doesn't want leverage, doesn't want to invest in derivatives, all of those things. So these are unique circumstances. Guys, are you guys so far with me understanding this chapter is comparatively simpler? That's why I'm going much fast. I'm going more faster. Are you guys with me so far? Yes or no? रिवाइज हो रहा है, बराबर हो रहा है, अच्छे से हो रहा है? आई होप आपने श्वेजर खोला हुआ है. All right, perfect, guys. Again, one of the examples of Mr. Arvind Mehra, 40-year-old entrepreneur, has a renewable energy company in Mumbai. Value of his current portfolio is 3.5 crores. He needs extra 1.5 crores, which is preserved by him for his business. He wants to retire at the age of 60 and wants to fund his daughter's education in 5 years. Constraint क्या है? एक तो liquidity है, 50 लाख चाहिए 5 साल में. क्यों भाई? डॉटर के MBA के लिए. 5 lakh every year he needs for business backup. Time horizon medium term. Why? Because he has only 12 years to retirement, right? Beyond that, obviously long term because till the time he's going to be alive. Tax bracket 30%. That's why he wants to invest in tax efficient equity mutual fund and prefers capital gains. Legal regulatory cannot invest in fossil fuel companies. क्यों? क्योंकि बोर्ड पोजीशन ली है उसने एक एनजीओ में, जो कि एक एनवायरमेंटल सोशल गवर्नेंस मतलब बेसिकली एक ईएसजी एनजीओ है, जहाँ पे उसने एक बोर्ड पोजीशन ली हुई है एज अ बोर्ड पोजीशन इन दैट, एंड दैट्स व्हाट एंड बिकॉज ऑफ द वर्च्यू ऑफ दैट बोर्ड पोजीशन ही कैनॉट इन्वेस्ट इन fossil fuel companies, right? Because not environmental friendly. Unique circumstances, of course. You will see this repetitively. Tobacco, alcohol, arms manufacturer doesn't want to invest there, and derivatives का use allowed नहीं, right? Now the main part of the chapter comes in, guys. Now this is where I think this is where the chapter gets a bit tricky to understand. A few points here. I think students are usually confused, and I want to address them very well. All right, let's go ahead, guys. Let's start with the first one. What do you mean by strategic asset allocation? What is strategic asset allocation? Guys, remember for Rajat, we decided 60% in equity, 20% in fixed income, 10% in, let's say, real estate, and the other 10% in alternative investments other than real estate. This is what is called as the strategic asset allocation, which is after defining the IPS, strategic asset allocation is there to build the fund, to build the portfolio. Basically, you want to allocate the funds in this particular way. So if you have 100 rupees, it will go 60 in 60 will go here, 20 will go here, 10 will go here, 10 will go here. Right? Asset classes can be equities, fixed income, you want some cash, real estate, alternative investment. But obviously, what is the goal here, guys? Whenever you select asset classes, what is the goal? The correlation has to be low between the asset classes. You're investing in equity, you're investing in fixed income, you're investing in alternative investment, real estate. You want the correlation between the asset classes to be low so that the overall diversification improves. Because tomorrow, if equity is going down, uh, and the correlation between equity and fixed income is negative, so fixed income is going up. So the losses here are made up by, the profits here compensate for the losses here, or the losses here are made up by the profits here, right? Actually, I was saying that right, but yeah. So that is what this is. So you need to make sure that the correlation is very, very less, right? So criteria for asset class selection, it should be mutually exclusive. That means correlation should be low. But within the asset class, the correlation is going to be high now. If you invest in equity tomorrow, obviously, if you invest in different types of equity, large cap, small cap, mid cap, obviously the correlation is going to be high. Obviously, not a lot. Like large cap, mid cap, small cap would not be correlated, you know, the correlation would not be that high. But obviously, you would want some correlation. Why? Because they belong to the same asset class. So if equity tomorrow is going down, everything goes down. Yeah? They represent investable segments, large cap, mid cap, small cap. They are able to capture market risk premiums, right? Obviously, if you want to invest in an asset class, you want to make sure that you are compensated for the risk that you're taking. That is what this is. But within these are subdivisions of the asset class. It's very simple. Equities, bonds, alternative hedge funds, commodities, private equity, real estate, your equities, domestic, foreign, all of those things are there. It's pretty simple and easy, straightforward. Right. But once the asset class is collected, you are decided to invest in equity. Now, what shares to buy? Obviously, what shares to buy, the decision depends upon the kind of returns that stock has given, the kind of standard deviation that stock has, the kind of correlation that stock has with other stocks in your portfolio and with other asset classes. So you can use a computer-based model, right, and draw an efficient frontier where you can come up with portfolios that offer the maximum return for a given risk. And this point, I don't expect you guys to understand very well here, but I expect you guys to understand this when we discuss portfolio risk and return part one. But the chosen portfolio should be the one that best meets the IPS objectives, right? And active versus passive deviation. Now, what is this? Guys, we understood what SAA is, strategic asset allocation, right? This is what you ideally would want to invest in terms of the portfolio, depending upon the circumstances of that individual or any type of investor. Then, sir, what is tactical asset allocation? Tactical asset allocation are the deviations from the strategic asset allocation to exploit opportunities. Sir, meaning currently I see that alternative investments are very overvalued, actually undervalued. Let me just put it this way, are undervalued. Let's say, for example, private equity. I invested in a fund. I feel that the fund's value, I mean, the fund is undervalued. Reason can be anything. Unavailability of funds, a brief period, large part of, a large period fall, basically a period which is, or let me just put it this way actually. So a private equity which is undervalued, currently the reasons can be the reason can be anything. It can be because, lack of funds are there. Apart from that, previously, for a long period of time, the valuations of, private equity, specifically that segment, was very high, and now market has corrected itself and the valuations have gone down a lot, and currently they're trading at a very low value. It can be anything. So basically the point is that the private equity is undervalued. Sir, what do you do in this circumstances, this situation? What do you do? You see an opportunity as a portfolio manager. You see that alternative investment, specifically private equity, is undervalued. My desired weightage was 10% and was 60 for equity, was 20 for fixed income, and was 10 for what do you call your real estate. But because private equity is undervalued, what I do is temporarily deviate my weight and put in 15% here, and I probably reduce 5% from somewhere else. Let's say I reduce 5% here, I go for 15% in fixed income. This is a temporary deviation from the strategic asset allocation that I have decided. Why? Because there's an opportunity that I see as a manager in private equity, which is currently undervalued. Right? And the second active strategy is security selection, which is what I deviate from index weight to overweight and underweight specific stocks. So what was tactical asset allocation? So tactical asset allocation was deviating from strategic asset allocation. So what is security selection? It is deviating from, it is what? It is deviating from whatever are the stock weightages assigned by the benchmark. So let's say, for example, Nifty 50 is what I'm replicating as a passive manager. Okay, Nifty 50 stocks have certain weights. But I feel that a certain stock X is overvalued and a certain stock Y is undervalued. The stock that is overvalued, I reduce the weight in that stock. The stock that is overvalued, sorry, the stock that is overvalued, I reduce the weight in that stock. The stock that is undervalued, I sort of buy that stock more. What happens? I'm able to outperform Nifty 50 as a result of it. Why? Because the stock that is overvalued, I have assigned lower weight to it. So tomorrow when it falls down in value, I will suffer lesser loss as opposed to Nifty 50. And the stock that is undervalued, I buy more of it. So tomorrow, if it goes up in value, I earn more profit than Nifty 50. So overall, I will be outperforming Nifty 50. And that is what security selection is. Whereby in a passive strategy where I'm replicating the index, I will fluctuate the weights for a shorter term, depending upon what? Depending upon overvalued, undervalued, whatever that may be. Right? That is what it is. Now, what do you mean by risk budgeting? Risk budgeting is you set limits, you budget that, listen, this is what my strategic asset allocation risk should be. These are the maximum tactical asset allocation I can take. This is the maximum security selection risk that I'm willing to take. Right. That is what it is. Sir, but why is budgeting important? Why is it even relevant? Let's say, for example, I am investing in two different managers. This is manager one, manager two. They both are following security selection. So this manager has overweighted a certain stock X, and this manager has sorry, and has underweighted, stock Y. So basically, stock X is undervalued, this is overvalued. Okay, sir, but this manager believes the other way around, and he has actually underweighted X and he has actually overweighted Y. By underweighted, overweight, I hope you guys understand why am I doing it, right? Okay, sir, I've invested in both of them. Actually, the exposures that they are taking is actually offsetting each other. Okay, fair enough, sir, it is offsetting. So for me as an investor, net I don't get any benefit out of security selection. Why? Because manager 1 and 2 have basically taken opposite positions, and when I combine the two, for me overall there is no net benefit that is coming out of it because they have offsetted the positions. That's why I need to make sure that I budget my risk. I set limits that okay, this is what the limit looks like, right? And the next is your core satellite approach. Now, what do you mean by core satellite approach? Core satellite approach is that majority portion of your portfolio, let's say 100 rupees is what you have, 80 rupees is something that you passively manage. You believe in passive management. And with the rest of the 20, you sort of do what? You take risk. You go in active management. That is what core satellite approach is, where your core majority, what? Your core majority is passively managed and satellite, which is a very small portion of it, is actively managed. Right. So ultimately, because of this, risk is balanced, your tax inefficiencies go away, and you sort of don't enter into overlapping trades. That is what this is. I hope you guys have one thing that this risk budgeting thing, I'll just quickly repeat. I think probably might be some confusion with respect to this. So in security selection, what do? I sort of deviate my weights from whatever the benchmark has currently given, depending upon my view of those particular stocks. So let's say, for example, Nifty 50, there are two stocks, stock X, stock Y. Stock X I feel is overvalued. Hence, I underweight this particular stock. Underweight meaning lesser weight than what the index is currently giving. But the stock Y is currently undervalued and I overweight this stock. Overweight meaning more than whatever index is assigned. Ultimately, tomorrow, if this stock which is overvalued is falling down in value, what happens? I have lesser loss as opposed to index. And tomorrow, if Y, which is an undervalued stock, goes up in value, I make more profit than what index is currently making and I outperform the index. Now, let's say, for example, as an individual investor, I have invested in two managers. I have invested in two managers with counter views. I've invested in two managers. This is manager number one, manager number two. This is stock X, stock Y, stock X, stock Y, both of them following security selection as a method. Okay, sir, this person has invested in stock X, this person has invested, X and Y, basically there are two stocks that we're talking about where they are playing in terms of security selection. Okay, sir, X has ultimately done what, sir? X has overweighted the stock in the index because this stock is undervalued. A stock not in the index in his portfolio, sorry. And why, sir, with respect to this stock, he has underweighted this stock. Why, sir? Because this stock is overvalued. Okay, sir, fair enough. But manager number two, on the other hand, has done the opposite. What has he done, sir? He has underweighted the stock because this stock is overvalued as per him, and he has overweighted the stock because this stock is undervalued as per him. Sir, but when I look at from individual investors' point of view, he's not getting any net benefit out of the risks that these people are taking. Why? Because they're offsetting each other's position. So, meaning here the benefit that I'm supposed to get from X overweighting this stock because this stock is undervalued is what is offsetted by this. Okay, sir, fair enough. So, I need to have and I need to make sure that I sort of budget the kind of risks that I'm willing to take. With that, what will happen? I will know what sort of managers I need to put my money with, right? And that is what risk budgeting is. And the last part is your ESG integration. What is ESG integration or what is integration of ESG in your investing style? ESG meaning that for an investor, you as an investor, to be honest, three factors become very important. ESG, environmental, social, and governance. What are environmental factors? That wherever you invest has to make sure that environment is their priority. What are social factors? Wherever you invest is a socially responsible company. Let's say, for example, a company that is following all the labor laws. Let's say, for example, it's a manufacturing company, and a manufacturing company, as per labor laws, have to make sure that on a floor where there are more than 30 employees, you have to have a dedicated washroom for men and for women. Okay, sir, fair enough. All right. And this company does have that. So this is a socially responsible company. Another law that requires that, they are paid for whatever overtime they do, they are paid an minimum amount. This company follows that. So this company is socially responsible. Governance factor. This company has their governance in place. What is governance? Governance essentially is company managing the interests of various stakeholders and making sure that every sort of stakeholder in that particular company, their interest is satisfied. So there can be your equity shareholder, that is one stakeholder, your debt holder, that's one of the stakeholders, your customer is one of the stakeholders, government is one of the stakeholders, society at large is one of the stakeholders. How the interest of all of them is managed, right? This is very important. Sir, for example, for an equity shareholder, what is the interest of equity shareholder? Sir, he is the owner of the company, right? Okay, sir, so he's supposed to benefit from the long-term actions of the company. Okay, sir, the CEO, CFO of the company are involved in the daily operations, but the equity shareholder who's the owner of the company is not involved in daily operation of the company. Okay, sir, fair enough. Sir, so the owner knows less than the CEO, CFO? Yes. The CEO, CFO, sir, their salaries, the kind of compensation they get is tied up directly with the short-term performance of the company. Example, tomorrow, if the company makes an X amount of profit, these people, get a particular cut out of that profit. Okay, sir, fair enough. So, sir, CEO, CFO are more fixated with the short-term profits and are not taking the long-term decisions that are good for the company in the longer term. They want to continue making profit because their bonuses are tied with profits. But the owner wants a long-term view. Now there's a conflict here. What do you do? Board of directors are appointed who keep a check on CEO, CFO. They are appointed by the owner of the company, which is shareholders. That's how the interest of particular stakeholder owner is managed, right? So whether these kind of governance methods have been employed by this particular company or not, that matters. Obviously, this is a statutory requirement having board of directors, but I hope you guys are understanding what I'm trying to tell you, right? Sir, what are the different approaches to ESG investing? Sir, we understand integration of ESG in our investing style, which is for me as an investor, I am, for me, environmental factors matter, social factors matters, governance factors matter. But how do I screen those companies? How do I figure out that this is the company that meets those criterias? One of the ways to figure out is negative screening. You keep excluding these stocks which don't meet the factors that matter to you, which are ESG. So, you can exclude stocks which are, into tobacco or firearms because you think that it is not socially responsible to be in these businesses. Positive screening. What is positive screening? You find out companies that meet these factors, make a pool of them, and ultimately invest in them. So, you sort of do ESG scoring, that on environmental factor, where does this company lie in terms of its score. Now there are different ways to score, that is none of your concern, but that's what I'm trying to make you guys understand. Negative screening, you keep on excluding. Positive screening, you keep including the one that meets the criteria on the basis of the ESG scores. What is thematic investing? Investing in ESG linked sectors, example, clean energy. Thematic, so you sort of invest in a particular theme. Clean energy is a theme that you have, right? Impact investing, your objective is just not seeking returns. Your objective is also to make a positive impact. So the company that you invest in, is that company making a positive impact that matters to you? That is impact investing. So this is one of the ways to identify the companies where you would want to invest. That is impact investing, where you think that not only your, what do you call, returns matter, but also whether the company is actually positively contributing something to the society or not. So let's say you invest in education sector, so you try to sort of invest in a company. Obviously that company will give you returns, but is that company making or doing larger good of in the education world as a whole? Is there some contribution that is there of that company with respect to tech involved, with respect to the raising the education standard, whatever that may be? Active ownership. This is not an integration approach, to be honest, but it has been given, so we are trying to discuss it. Where you become an active shareholder. So let's say you get 51% stake of the company. Now you get to say in the matters of the company, right? So you can use shareholders' votes to drive the ESG behavior. So tomorrow, what if you can active become an active owner of a company, like acquire 51%, and then as an active owner, then you sort of stress that, listen, I'm the owner of the company, I have majority stake. I would want to make sure that this company heads in a direction where it is environmentally, socially, and governance. All of these factors are basically met, right? And ESG integration, you include the criteria throughout your asset allocation, selection and allocation process. So whatever strategic asset allocation that you sort of decided, and whenever you sort of basically in execution step, you include this, and that is what ESG integration is, right? And I think that wraps up our, no, I think last part is left. Portfolio, what are the portfolio implications for ESG, right? If you, for you as an investor, ESG matters, then obviously the number of investments, the number of stocks, let's say, for example, you can invest in obviously reduces. Why? Because in our country, ESG as a factor is not, still not very, very important. Right? So you can limit the investable universe you have. It may reduce or increase the return depending up, it may reduce or increase the return depending upon the ESG factor performance. So you are invested specifically with respect to ESG as a factor. So environmental as a factor. Tomorrow, if the company does not doing very well, environment wise, so returns might decline, right? And benchmark must be aligned. Benchmarking must be aligned, right? You basically, if you are investing in an ESG responsible manner, then your performance needs to be compared with a benchmark that also considers those factors. You cannot compare yourself with Nifty if it is not in considering ESG factors, right? So it is very important that your benchmarking is aligned with your ESG as a strategy, right? And that wraps up our second reading as well. So within 2 hours, we have been able to wrap up two readings completely in and out, where we discussed every factor, everything that is there with respect to that reading that is relevant for you guys in the exam. I hope you guys are with me so far. Are you guys understanding? सब कुछ बढ़िया चल रहा है? आगे वाली रीडिंग पे चले? Shall we go ahead? तो guys, sorry I'm eating. थोड़ी भूख लग रही है. I want my breakfast. All right, let's move forward now. Let's go to our next reading, guys. अच्छा, ब्रेक चाहिए क्या? आई होप यू guys don't want a break. If you guys do, tell me. 5 मिनट का ब्रेक दे देता हूँ मैं. Also, guys, one more thing. Would really appreciate if you guys can subscribe to the channel. Uh, Chalo, let's continue. I think I have gotten few people that have said that, okay, let's continue. So we shall continue. All right, guys. The next chapter, which is your behavioral biases of the individual. Now, before just give me a second, I need to sort of connect the charger. Uh, just give me a second. All right, guys, let's get started. Let's go to our next chapter, which is behavioral biases of the individual. Right. Guys, it is very important to understand that whatever is assumed in theory, sir, what theory? Traditional finance theories that an investor is rational, he will always take decisions where he is not letting, he's not get, he's not, I mean, his emotions are not getting better of him. An investor who's very, what do you call, methodical, makes sure, always will make sure that, there's no bias, none of that, right? But so traditional finance is actually wrong. We all, as investors, will never be rational. We will always have our emotions influence our decisions. Our past experiences, our childhood, everything is going to ultimately impact the kind of decisions we take, right? So, traditional finance assumes that we are rational. We'll always maximize our utility, right? We'll always be logical, but that is not the case, right? Investors usually act irrationally. They are driven by their biases. Right? Now, this chapter tries to do what? This chapter tries to categorize those biases. Okay, these are the biases that an individual usually exhibits. That's what we are trying to understand. Right. So there are two main categories of biases. There are cognitive biases or cognitive errors, and there are emotional biases. What are cognitive biases? It is because of faulty reasoning, mental shortcuts. Your logic is flawed, right? They are aware of the process, but their logic is flawed. Let's say, for example, I am aware that I'm supposed to use this particular formula for finding a particular answer, but I have goofed up in what is going to be supposed to be there in numerator and what is supposed to be there in denominator. So let's say, for example, I'm trying to find out the forward rate. So forward rate is going to be spot rate into the price currency divided by base currency. But what I did was I sort of screwed it up and I did base currency divided by price currency. What do you mean by price currency, base currency? You take the interest rates. I hope you guys remember this, right? Can you correct this? Yes, sir. Via education and awareness. Usually it leads to what, sir? Miscalculation and overconfidence. I am right. Or miscalculation. What I have arrived at is wrong. Examples we are going to study, which are anchoring, overconfidence, hindsight bias. Sir, but what is this chapter about? What are we trying to understand? Can you please again sort of reiterate the whole thing? Traditional finance assumes that we are rational. We always take logical decisions. We are the people who will always try to maximize our utility. But is that the case in real world? No, sir. All of us are irrational in the real world. Why? Because we have our own emotions driving us. We have our own biases. All of that does matter, and that will influence our decision making. This chapter makes an effort to sort of summarize what are the different sort of emotional, what sort of different biases you face. Sir, there are biases can be emotional or can be cognitive. Sir, cognitive we understand can be faulty reasoning, can be because our logic is flawed. Sir, it can be corrected. Yes, sir. All of those things. Sir, what are emotional biases? This arises from feelings, intuitions, or impulses. This is something that a person feels, right? This is their intuition, right? So let's say, for example, one of the things can be, uh, uh, you know, let's say I'm married, let's say, for example, and my wife dies. And my wife, held a security in a company which was very, very close to her. She felt very strongly about it. The company is not that great. The investment is not that great. Tomorrow she died and I inherited that investment. Now, just because my it was very close to my wife and had a big sentimental value, I will hold that, right? But from a rational perspective, it doesn't make sense to hold that investment because it is not a great investment. It is very average and doesn't suit my circumstance. So the emotional, what do you call, uh, the feeling that I have towards holding that investment is very strong because of what it meant to my wife, my late wife, right? The point is that that this is an intuition, this is a feeling. This is not arrived from some sort of faulty logic. That's what emotional bias is. You're unaware of this usually. Your reactions are driven by emotions. And when something is driven by emotion, it is difficult to correct because cognitive error में तो आप समझा दोगे उसको that listen, the formula that you are using, price divided by base, it was base divided by price is actually wrong. It is price divided by base. But how do you correct that emotion? How are you going to educate that investor? Often you get tell him that listen, okay, and it did belong to your ex-wife and to your late wife, sorry, and it's emotional to you, but doesn't make sense rationally. How are you going to be able to correct that intuition? It's difficult, right? It leads to irrational persistence in behavior. Right? Examples are loss aversion, endowment, and regret aversion. But that's what the basic difference is between your cognitive and emotional bias. But the biases are of two types, right? Let us start discussing our first type of bias, which is cognitive errors, which is further of two types. So cognitive error is of two types. First is belief perseverance. First is what? Belief perseverance. And the second one is ये रहा आपका information processing bias. So there are two types of cognitive errors. First is belief perseverance, and second one is information processing error. Now, what there are different types of belief perseverances biases. There are different types of information processing errors. But when you divide your cognitive errors, it is typically of two types. First is belief, second is information. But at the end of the day, cognitive error arises from faulty reasoning, right? So let us start with our first subtype, which is belief perseverance. Where does it come from? It comes from person's irrational tendency to cling to prior beliefs. He's clinging to prior beliefs. He's very held on to past, even when he's presented with new or conflicting information. Right. Sir, what are the different types of these belief perseverance biases? First is conservatism bias. Sir, what is conservatism bias? My initial belief that I have formed is rational, but I fail to update that initial belief when new information becomes available. Sir, example can we take? Yes. Let us take an example of Priya Shah. Priya Shah, she's an advisor, investment advisor, who has seen over the last 15 years that consumer discretionary stocks tend to perform poorly during economic slowdowns. तो जब भी इकोनॉमी स्लो डाउन होती है डिस्क्रिशनरी स्टॉक्स डू नॉट परफॉर्म वेरी वेल दिस इज व्हाट शी हैज ऑब्जर्व्ड तो हर इनिशियल बिलीफ दैट tomorrow if economic slowdown comes I should not be investing in consumer discretionary stock is correct. So based on this historical insights she maintains a low allocation to these stocks in clients portfolio whenever economic slowdown kicks in. But नया macroeconomic data आया. This new macroeconomic data and central bank report has ultimately suggested that now consumer discretionary stocks have become resilient to what economic slowdowns, and in fact, during economic slowdown, they are stable and in fact, in some cases, even rise. Despite this new information, what did she do? She did not update her client portfolios and include consumer discretionary stock in them. Why? Because she's suffering from conservatism bias, where her initial opinion, which was that the stocks of consumer discretionary stocks basically are are not going to perform very well in economic slowdown. Her rational belief was right, but when the new information was presented, sort of came out, she did not update her initial opinion, and that is what conservatism is. So you overweight your prior beliefs and underreact to new, possible, more relevant data. मैं इसको बहुत प्यार से बोलता हूँ मेरी वाली अलग है बायस. This is what I do. I mean, yeah, this is how I used to remember. Anyway, सबको लगता है ऐसा initially. Oh no no no, and it's a rational opinion. That's what we form. But when the new facts come into light, you sort of don't see that. Anyway, just a joke, guys. Huh. But that is what this is. What are the implications of this? You hold on to outdated forecasts. What do you call, you don't revise your asset allocations that you have made, your strategies. Tomorrow, if there's an earning surprise or macroeconomic shift, you don't react very well to it. Your reaction is often an underreaction of sorts. Right? Tomorrow, if the market is changing, your reactions are more slow. Why? Because you have a conservatism bias, and that's what conservatism bias is. Right. Now, next one is confirmation bias. What confirmation bias? Now, what is this? Let us take an example again of Priya. What did Priya do? She heavily invested in new age EV battery startup. बहुत सारा इन्वेस्टमेंट किया. जो ईवीज आ रही थी वो कंपनीज में, ईवी कंपनीज में बहुत सारा इन्वेस्टमेंट किया. Why? Because she thinks that it will revolutionize the industry. EV is the new thing, is the new form of after petrol and diesel. She thinks that EV is the next thing and it's going to just go up. So okay, and she has invested on the basis of that. She routinely reads analyst reports and media stories that praise the company's innovation. Okay, sir. So basically, she's going over the news, she's reading analyst reports, and she's only looking at the things that are confirming her initial belief. Okay, fair enough. But she avoids reading the report that are highlighting the fact that EV companies have a higher burn rate, there are supply chain issues, there are insider share sales. All of these are problems with EVs. She's failing to look at that. What is this? Confirmation bias. Why? Because she's only looking at information that is confirming her belief that EVs are a success, and she's ignoring the red flags. Right? We all have, again, this can be very well related to this thing, that we all have red flags to see, but we fail to what? See them. We only see things that are sort of confirming our initial belief, or not, like the belief that we have, not initial, the belief that we have. Right? Sir, but we are confused between conservatism and confirmation. Sir, what is the difference? What is the difference between conservatism and confirmation? In conservatism, I formed an initial belief and I failed to look at the new data. Here, whatever my belief is, I'm looking at the new data, but only the one that is supporting my belief, and ignoring what? The one that is not supporting my belief. Right. So confirmation bias occurs when investors seek out or give more weight to information that confirms their existing beliefs while ignoring or minimizing information that contradicts them. Right. So this leads to distorted view of reality. You sort of think that, again, मेरी वाली अलग है, that's a distorted view. Right. No offense, I have a lot of girls around. Guys, I'm just kidding. All right. Just trying to fool around. It's been 2 hours that we've been studying continuously almost. Ha. And you reinforce your potentially flawed decision. Anyway, that's simple. Key characteristics: investors filter out conflicting point of views. They interpret new data in a way that aligns with their prior belief. It can result in your overconfidence and poor investment discipline. Right. Consequence for investors: overlooking risks due to selective attention. You sort of overlook the risk. EVs had a risk, but you overlooked that. Why? Because your the view that you formed that EVs are good sort of was very strong. Right. You have screening methods that are very, very biased. Why? Because you will have screening methods that support your point of view, support your thesis. And that will result in you holding poor investments. You would not sort of value contrarian analysis. Somebody who's trying to come out with a contrarian point of view, you would not sort of take a look at that. How can you reduce it, sir? Have a balanced input. Make sure that you get the opinion from both the worlds. Right. So you need to include the dissenting opinions. You challenge your thesis. Basically by taking a look at the alternative outcomes. You use the objective data rather than belief driven screening. So, you don't look at the belief driven screening only. Whatever is supporting your belief, the screening method that you have made, just don't look at that. Also look at the data, the numbers, right? A lot of times, a lot of people would say, let's say, for example, and a very recent thing that happened, and I sort of came across this, where Nikhil Kamath quoted that Makhana market is going to grow at 6x in the next 2, 3 years, whatever that may be, XYZ. Okay, fair enough. But when you look at the data, doesn't really support it. It was, and I don't know if you guys have seen or not, but like that's a very good example of this. Right. So that's what your confirmation bias is. Now, what do you mean by representativeness bias? What is representativeness bias? Let us take an example. An analyst has been following a mid-cap tech stock called as mid-cap tech stock called as AlphaSoft. This company has delivered strong earnings for the past 3 years. The earnings have been, the past 3 years have been very strong. And on the basis of this short streak, the analyst is sort of concluded that this company is a high growth company. And then he's expecting that the company will continue to outperform. So, sir, basically on the past 3 years of earning, he has formed a point of view that, a second, guys. Yeah. So on the basis of the past 3 years of earnings, he has found a point of view that the earnings are growing and the company is a very high growth company. Okay, but the quarterly reports that have been there has sort of shown that the industry revenue has sort of stagnated and the industry is moving towards a slowdown. Okay. Despite this, a lot of analysts have continued rating this particular stock as a strong buy on the basis of what? The growth characteristics that were shown to you. Okay. Sir, fair enough. So, what is the bias here? What's happening? Remember this example now. What example? Sir, this particular tech stock that is there in that with respect to that company, sir, this company has past 3 years, the sir earnings are growing. Okay, fair enough. On the basis of that, I'm saying that the stock is a growth stock. All right. Okay, sir, fair enough. But actually, the industry revenue is slowing down. Overall, sir, the industry is slowing down, if I were to put it in a very simple way. And currently, for this quarter also, sir, we can see that the company's earnings and basically profit or whatever that may be has sort of slowed down. In fact, there's a stagnation. Okay, all right, sir, fair enough. Now let us go and read representativeness bias. This occurs when individuals make decisions based on stereotypes or past classifications rather than full accurate analysis of current data. What did I do? I made a decision that that particular tech stock is what? Is a growth stock based on what? Past experience that I faced. What was that? Sir, 3 years constant rise of earnings. Did I look at the full accurate data? Did I look at the current quarter earnings? No, sir. Did I look at the industry data? No, sir. It leads to assumption that things with similar characteristics will have a similar outcome. As an analyst, it has been my experience that I have sort of seen that if a company's earnings grow for the past 2 or 3 years, the company is a growth stock. So I am sort of assuming that companies with similar characteristic will have a similar outcome. Okay. But I fail to look at the bigger picture and what the current data is showing me. Bigger picture, industry sort of going down. Current data, the company's current quarter revenues are going down. There are two types of representative bias. First, base rate neglect. Other one, sample size neglect. Where you ignore the actual statistical frequency of an event or trait in a population that makes it a base rate neglect. Sir, meaning if you look at the population, which is the population of tech stocks in that particular industry, sir, overall industry revenue is going down. That is an example of base rate neglect, where you ignore a trait of the population of tech stocks. That trait is the industry revenue going down. What is sample size neglect? When individuals make conclusions on a small unrepresentative samples. So, because this company's earnings are going for the past 3 years, and you think that this company is great, and you sort of maintain a buy rating for this company, you sort of also make an assumption about this particular industry. So, on the basis of that sample, you sort of think that the industry is good. So, this short-term trend that is there with 3 years, the past 3 years, the earnings rising, you sort of assume that this trend is there for that particular industry as well. It is reflecting. So the short-term trends reflect the long-term, sorry, the short-term patterns are reflecting the long-term trends. You sort of think that the industry is good. That's not the case, right? What are the consequences of this? You sort of ignore long-term average returns. You focus, your decisions are more short-term results based, short-term result based. You classify stock as a winner, but actually that is not the case. You sort of buy overvalued assets. You sort of might sell undervalued assets prematurely. These are all the consequences. Everything wrong you can do, you've done, right? The next is illusion of control bias. Now, what do you mean by illusion of control bias? You overestimate your ability to influence or control a particular outcome. Sir, what do you mean by that? Let us take an example. Rajiv is a portfolio manager who previously worked in the automotive sector for over a decade. So he was working in the automobile sector, but after working in the automobile sector for a decade, now he's working as a portfolio manager. He now manages a diversified equity fund. So he is managing an equity fund. He's the manager of that fund. And he consistently allocates 25% of the portfolio to auto stocks. Why? Because he believes that he understands the industry better than the market. How market understands automobile industry, he understands better than the market. Why? Because he has worked in automobile industry. And that's why he's allocating one fourth of his portfolio to automobile industry. Even after multiple quarters of poor performance in the sector, this sector is not performing very well because of supply chain disruption, regulatory changes. Rajiv continues to overweight his position. Why? Because he sort of think he's overestimating his ability to predict or control the outcome. Why? Because he thinks he knows more than the market. That is what illusion of control is. He is overestimating his ability to understand that particular industry very well. Right. That is what illusion of control bias is. His past experience has given him unjustified confidence that he's able to see through the noise. But actually, the objective data that you look at suggests otherwise, that the stock doesn't have a lot of, that the industry doesn't have a lot of probably future prospect in terms of the kind of returns that it can give. But because of his past experience, he sort of thinks that he can control the outcome. He thinks that he is sort of able to see through the market. Right. All of this control, illusion of controls comes from overconfidence. He's getting he has a overconfidence. What sort of overconfidence, sir? So the overconfidence is stemming from the fact that he is somebody who's worked, and that's why he knows better. Comes from knowledge, self attribution. It's मैं अपुन ही भगवान है types, right? That's what this is. So it comes from one has superior information or insight. You think that everything comes from your skill rather than, luck. Sort of over attribute to yourself. Apunish Bhagwan hai, sab maine ही किया. No, it has been given to you. It's luck. You've been there, right? It's the right time. It has just come to you. Okay. Don't over attribute yourself. Don't over credit yourself. Overconfidence, it also comes from that, right? Your predictions and whatever you do is always going to be correct, like that. What happens because of this? You either overtrade because you think that you are able to time the market. You either under diversify. This person has invested one fourth of his portfolio in what? In automobile as a sector. He had an opportunity to invest in multiple sectors. Probably invest 10% in automobile, 10% in something else, 5% in something else. Using that 25%, he could have diversified. But why? But because he knows that because he thinks that he knows better, he has put in majority of his money there. Right. So it also leads to under diversification. Neglecting risk controls or stop loss because investor believes their view will play out. You don't, then you don't look at the risk metrics. You don't try to control risk. You don't use a stop loss mechanism. You don't use stop loss because you think that, okay, I got this. I am controlling this. That's what illusion of control is as a bias. All right. The next one is hindsight bias. Now, what do you mean by hindsight bias? Let's say, for example, there's Meera. She's a retail investor. She did not have any clear opinion on what crude oil prices would be in early 2022. 2022 के start में she didn't have any clear opinion कि यार what will happen with these particular stocks. Not stocks actually, crude oil. Okay. But the moment prices surged, whatever geopolitical tensions were, because of that oil prices went up. You know what she comes and tells? I knew it all along. I knew that the oil prices would rise. What happens as a result of this? She will overweight her portfolio to energy stocks, assuming that her instincts were right. I knew it all along. मैंने तो बोला था, देखो बढ़ेगा, बढ़ गया. All of that gives you a false sense of what? That your false sense about this, that your instincts are going to be right all the time. That's not the case. You didn't even think about it. You keep telling yourself that story, you keep telling yourself again and again that I knew it all along, I knew it all along. That you sort of think that you actually predicted it and you sort of invest in it. But actually, you didn't have a point of view. Your point of view was just formed because it went up. And you kept telling yourself again and again that I knew it all along, I knew it all along, I knew it all along. And that gives you a false sense of having your instincts right. And then eventually you end up investing. So, what is she doing? She's revising her memory and she's trying to make her believe that she predicted the price surge, even though she made no such forecast. This overconfidence in her predictive ability could lead to making her unjustified investment risk in the future. That's what hindsight bias is, right? So, hindsight bias occurs when individuals believe after an event has occurred that the outcome was more predictable than it actually was. This is often because of I knew it all along mentality, where you overestimate your ability to predict the past outcomes. This is because of distorted memory. You don't remember your original forecast. You didn't even have an opinion. But because of distorted memory, you sort of think that you predicted it all along. Perception of inevitability. Events that are occurred, you sort of see that they are obvious or inevitable. Overconfidence in forecasting ability. You sort of have an overconfidence in that, because of all this, obviously you have an overconfidence in the forecasting ability. I think that's a very straightforward point, right? And that is what your hindsight bias is. And we are done with all the different types of belief, perseverance, cognitive errors. Which one, guys? Belief, perseverance, cognitive errors. Are you guys with me so far? Is everyone understanding everything? क्या आपको सब कुछ समझ में आ रहा है? Yes or no, guys? बाकी सारे, everyone else, there are only two people saying yes. Come on, guys. Are you guys with me? One more feedback that I want you guys to give me here are whatever. I think we're done with two readings now and we're on the third reading already. Guys, is this revision turning out to be effective? क्या आपको लग रहा है कि मेरे रिवाइज करवाने से कुछ हेल्प हो रही है? गिव मी योर फीडबैक गाइस, क्विकली. यस नो में मत बोलना प्लीज. हाउ इज इट हेल्पिंग यू, प्लीज टेल मी. हेल्पफुल हेल्पफुल, ओके. चलो ठीक है. एंड आई एम लुकिंग गाइस, सिटिंग कैपेसिटी बढ़ तो गई है, अच्छी बात है. जहाँ हमारा 15 मिनट कंसंट्रेशन नहीं होता था, 2 घंटे से हम लोग लगे रहे. नाइस. भाई हम मतलब आई एम नॉट ट्राइंग टू, मैं तुम्हारी कैटेगरी में नहीं आता ऑफ कोर्स, मेरा काफी ज्यादा है। एनीवे, okay, the difference between base rate neglect and sample size neglect. Okay, base rate neglect is basically what? I ignore an industry-wide trend. Sample size with respect to just that particular, specifics with respect to that particular stock. So in the example that we took, टेक कंपनी जिसका खुद का रेवेन्यू वो क्वार्टर में गिर गया था और ओवरऑल इंडस्ट्री रेवेन्यू भी स्टैग्नेंट हो गया था, तो एनालिस्ट इज डिस्प्लेइंग सैम्पल साइज निगलेक्ट बाय रिलाइंग ऑन शॉर्ट टर्म परफॉर्मेंस ऑफ दैट पर्टिकुलर पीरियड। सो मैंने 3 साल की परफॉर्मेंस पे रिलाई किया और बोला कि कंपनी अच्छी है, मैंने इग्नोर किया कि उसके क्वार्टर के रिटर्न्स तो एक्चुअली गिर गए, यह स्टेबल है। दैट इज व्हाट इज सैम्पल साइज निगलेक्ट। बेस रेट निगलेक्ट इज आई इग्नोर द ब्रॉडर इंडस्ट्री पैटर्न, राइट, which was that the industry revenue is sort of stagnant or probably declining. That is the difference. All right, fair enough. Let's move ahead, guys. Let's go forward. Let's go to our next type of cognitive error, which is information processing error. They arise from individual processing information in a flawed manner, which can lead to a flawed judgment, suboptimal financial decisions. Right. They can be because of logical errors, statistical errors, whatever that may be. The first one is your anchoring or adjustment bias. First one is anchoring and adjustment bias. Perfect. Okay. Thank you so much, guys, for all the feedback. All right. Let's move forward. Anchoring and adjustment bias. What is that? Let us take an example. An investor values a stock at rupees 800 based on an analyst report. उसने एक analyst report देखी, उसके basis पे उसने उस stock की value 800 लगा दी. What happened later on was that the company reported poor earnings. Later on, the company reported certain poor earnings. Because of that, the market price has dropped to rupees 600. But the investor is still considering 800 as true value. He is delaying selling that particular stock. He believes that the price will recover. He's ignoring the new fundamental. This is called as anchoring bias. Sir, how come this is anchoring bias? We don't know what anchoring bias is. Can we first read that? This is the bias when individual base their decisions on an initial value. That initial value is called as anchor. Your decision to buy that particular stock, which is was based on the analyst report where you valued the stock at rupees 800. But you're failing to adjust sufficiently when new information becomes available. When the new information comes to light, you sort of fail to adjust that. This adjustment is insufficient, right? When the earnings were poor, the market price declined to 600. You still did not revise your estimate. You still did not revise your decision. This leads to persistent reliance on outdated or irrelevant data. Sir, what are the examples of anchors past stock price? Analyst estimates. Past stock price that you sort of estimated was rupees 800 was on the basis of an analyst report. It can be a personal forecast as well, right? So whatever adjustment eventually you do also is typically biased towards the anchor. It doesn't reflect the new realities. So let's say, for example, tomorrow you wanted to revise your estimate. What do? You say that rupees 800 was the stock. I sort of have a buy rating to it. Okay, sir, new reality is coming to light. I'll only selectively try to make sure that the new reality is going in this direction, which is my initial estimate. I'll not like to reflect the whole reality fully. Right? And this is very common during valuation processes. Impact area, investors may cling to outdated price estimates, analysts underreact to new earnings guidance, suboptimal buy sell timing due to fixed expectations. Right? Your buying and selling timing might be off because you think that currently the stock is still a buy stock and you would not end up selling the stock. Uh, and ultimately, you would not exit at the right time and probably end up making more losses. Right? That is what this is. Now, a common question that would arise is that, sir, ये तो थोड़ा थोड़ा कंजर्वेटिज्म और कंफर्मेशन जैसा लग रहा है। हाँ या ना गाइस? यस और नो? एंकरिंग थोड़ा कंजर्वेटिज्म और कंफर्मेशन जैसा लग रहा है, यस और नो? कैन somebody in the chat box point out the difference between them? चलो, आई वांट टू मेक इट अ लिटिल मोर इंटरैक्टिव बिकॉज अब थोड़े टाइम से हम लोग पढ़ रहे हैं, तो आई वांट योर ओपिनियन एज वेल। गाइस, एनीवन इन द चैट बॉक्स कैन पॉइंट आउट द डिफरेंस। आपको मैंने कंफर्मेशन और कंजर्वेटिज्म का डिफरेंस पक्का बताया है। दैट वी हैव पॉइंटेड आउट। द डिफरेंस बिटवीन एंकरिंग इन दिस केस, व्हाट इज द डिफरेंस? एनीवन? नो। गाइस, इफ यू कुड सी यहाँ पे एंकरिंग में the initial view was a numerical estimate that you made, rupees 800, right? This was a numerical estimate. But अगर आप ऊपर जाओगे, when you go ऊपर and when you look at conservatism, that was more to do with a non-numerical point of view. यहाँ पे जो आपको पॉइंट ऑफ व्यू दिखेगा, इन कंजर्वेटिज्म, इन कंफर्मेशन, इट वाज अ नॉन न्यूमेरिकल पॉइंट ऑफ व्यू। इसमें ईवी का पॉइंट ऑफ व्यू था, इसमें कंज्यूमर डिस्क्रिशनरी का पॉइंट ऑफ व्यू था। बट यहाँ पे क्या है? यहाँ पे एक प्राइस का पॉइंट ऑफ व्यू है। क्या एट मतलब न्यूमेरिकल एस्टिमेट है, इनिशियल एस्टिमेट जो है। राइट? बाकी तो मोटा मोटा सब सेम ही है। आई होप यू गाइस आर अंडरस्टैंडिंग दिस। एब्सोल्युटली वेरी वेल समराइज्ड बाय संजय, क्वालिटेटिव वर्सेस क्वांटिटेटिव। परफेक्ट। चले क्या आगे चले नाउ? आई होप एवरीवन हैज अंडरस्टूड द डिफरेंस, लेट्स मूव फॉरवर्ड। ऑलराइट गाइस, मेंटल अकाउंटिंग बायस, ट्रीटिंग मनी डिफरेंटली फ्रॉम डिफरेंट सोर्सेस। मीनिंग, सर अगर सैलरी से आया है तो आई विल इन्वेस्ट इन सेफर इंस्ट्रूमेंट, बट इफ बोनस से आया है पैसा, तो आई कैन गैम्बल विद इट, आई कैन टेक रिस्क विद इट। सो व्हाट एम आई डूइंग? सर एट द एंड ऑफ द डे सैलरी इज ऑल्सो मनी, बोनस is also money, but I'm treating these two types of money, the I mean these the money, I mean the sources of money differently. That's what I'm doing, right? One, sir, the source of money in first case was salary. I am trying to make sure that I invest salary in a responsible way and I take safer bets with it. I don't take a lot of risk with it. But sir, the in the other case, the source of the money was bonus, so I'm taking more risk with it. Okay, but ideally both of them at the end of the day is giving me money, and the investment of that money should be based on my circumstance and not the source of the money. Just because it is salary, I should not be taking or investing in safer bets. Just because it is from bonus, I should not be taking extreme risk and gamble with it. Both of them ultimately puts money in my bank account. I should be making sure that I invest it in a manner that is as per my circumstance. So it is very important that I don't segregate money on the basis of different accounts, right? So what is mental accounting? I, segregate the money on the basis of different accounts. It is based on subjective criteria rather than viewing all the money as a part of holistic portfolio, right? So you treat salary different from bonus. You invest your inheritance conservatively due to emotional attachment. At the end of the day, that is also money, right? Allocating assets to different goals. Let's say, for example, retirement, vacation, without considering the total risk and return. Right. So ultimately, at the end of the day, your goals have to be in tandem with whatever your total risk and return is. Right. That is what this is. Consequence, it may lead to inefficient asset allocation, risk level not balanced across entire portfolio, speculative behavior with fun money or emotional attachment to funds. Right? Whatever bonus is coming, you're taking a lot of risk with it. So fun money. Or inheritance money that is coming, you're being very emotionally attached to it and not investing as per your risk profile. That is what the problem is. Example, Ravi receives rupees 1 lakh as bonus, invested entirely in speculative crypto coin. Says it is extra money. अरे भाई कौन सा extra money? पैसा पैसा है. Meanwhile, he avoids rebalancing his retirement portfolio even though it's underperforming. His behavior demonstrates mental accounting. Right. That is what this is. Now let's go to the next bias, which is framing bias, which is what? Framing bias. Guys. Be very honest. Be very honest. Be very honest. Out of program A, where 200 people will be saved, or program B, where one third chance that all 600 will be saved, and two-third chance that none of them would be saved, what program would you choose? A program or B program? Quickly. A, B, A, A, A. Guys, I would be indifferent because the outcome of both of them is the same. Here, 200 people are saved. Here, there is one third chance of 600 will be saved. That means 33% into 600. What is the outcome of this entire program be? So 33% of 600 plus 2 by third of 0. This is going to be what? 200 only. इसका भी outcome 200 है, इसका भी outcome 200 है. But what happened? The moment this was framed as a gain, that means 200 people will be saved. A lot of people went for surety that at the end of the day, 200 people will be saved. This was framed as a gain to you, was framed in a positive manner to you, and that's why you chose program A. Majority here chose program A. It was clearly very, very evident. Why? Because the information was presented to you in a positive manner, in a gain way, in a manner where you're going to get a gain. But the moment I put it as, you know, this, where 400 people will die. This is program A, guys. And this is program B. One third chance that none of them will die, and two-third chance where all of them will die. What would you choose, guys? Come on, be honest. What would you choose? A or B? Be very honest. B. The moment I framed this as as a loss, what happened? People started choosing B. Why? Because people are saying, यार यहाँ तो 400 sure shot मरने वाले हैं. 400 is 400 people are going to die for sure. Here at least there's a chance. There's a one third chance that none of them die. But at the end of the day, guys, the outcome of both of them is same. Here it is 400. Here it is one third, none of them dies. That is one third of zero plus two third that all of them die. That is 600. The entire outcome is 400. At the end of the day, you should be indifferent between A and B. But what happened? The moment information was presented to you as a loss, you went for an outcome where there is at least some probability that some of them will be saved. This is what framing bias is. The way things are framed influences your decision. So you made a different choice based on how information is presented rather than on actual content itself. The framing of situation as a gain or loss can significantly influence the preferences and risk tolerance. Right. Whenever it is framed as a gain, you are risk averse and you went for short gain, right? When it was presented as a gain, you went for gain because 200 to I want for sure, Baba. That is for sure. But the moment it was framed as a loss, you became a risk seeking investor. You wanted to take a risk. What risk? This. Because the moment probability kicks in, there's some sort of risk that is there, right? You sort of went for that. This makes you an irrational. Obviously, it makes you an irrational investor, right? What is the impact on this one? Because of portfolio, you are overly focused on short-term losses and you abandon long-term strategies. You know that equity is very, very beneficial in the long term. But the moment you see a lot of losses in the short term, sort of think that no, equity is not for me. Your risk tolerance assessment can be wrong, right? That is there. So it is very important as an advisor that when I'm trying to find out what is the willingness to take risk, what is the ability to take risk, the kind of questions that I ask are properly framed. Otherwise, the kind of answers that I can get is can be very off and can lead to a wrong assessment. Example, a wealth advisor presents two investment options to a client. There are two investment options that are presented to a client, right? Option A, there's a 100% chance that you get 10 lakh rupees investment. Wait, hold on for a second. Okay, yeah, yes, let's continue. All right. A wealth advisor has presented to you with two investment options. Option A is there's a 100% chance that your 10 lakh rupee investment will be worth 10.5 lakhs in 1 year. 100% chance. Option B, 50% chance that it will go to 12 lakhs and 50% chance that it will drop to 9 lakhs. Obviously, you will choose again option number A. Right? But at the end of the day, sir, we also know that the outcome of both of them is the same. Right? Again, same thing is repeated. Option A, you will definitely lose 50,000 on your 10 lakh investment. Option B, there's a 50% chance that you will lose 1 lakh and 50% chance that you will lose nothing. You will choose this. Same thing. And that is what your next bias was, which was framing bias, which influences your decision on the basis of how things are framed and not how the actual outcome is. Right. The next is availability bias. Now, what do you mean by availability bias? Let us take an example. All right. Ravi, there's an investor called Ravi. He has recently watched several news segments about tech stock rallies. बहुत सारी segment देखी where he sort of saw seen that tech stocks are rallying. So recently he was watching some news and he sort of has gone over this fact that okay, tech stock is rallying. He read an article, tech stocks are rallying. He saw WhatsApp forward, tech stocks are rallying. Okay. So for sure, sir, this information is easily recallable for him. That the tech stocks have been surging for over and it has surged over 15% in that 1 week. Right? But what is the reality? This is despite the fact that only a few large cap tech stocks firm drove the rally and broader market was flat. That means out of all the large cap tech stocks, whatever they're not large cap actually, all the tech stocks, only a few of them actually went up, which were large cap. The rest of them more or less remained stagnant. Now, because of this recently available information, recently recallable information, easily recallable information, what is the point of view that is set in his head? What is the decision that is set in? I mean, what is the what do you call point of view that is set in his head with respect to tech stocks? That they will continue to outperform. That's why he shifts all his portfolio to tech stocks, and he ignores the diversification. Right? You're supposed to be diversified. You're supposed to take everything else. But what's happening? You are because of an easily available information that is recently that has happened and that is very easily recallable. You move all your money to tech stocks. Okay, sir, fair enough. That's what you do. But that is going to ultimately result in what? Under diversification. A lot of other things as well. Right? A lot of consequences of it. I'm not going to get into that. But why is this an availability bias? Because his decision was based on vivid and recent media coverage. He did not do an objective analysis. Right? His memory of the headlines made the tech outperformance seem more likely than statistically it is. He's easily, whatever, because it was easily recallable, he sort of now thought that it is going to outperform. He has ignored the other long-term market data and diversification principles. He was like, I don't want to diversify. Tech is going to outperform. Let me invest. Long-term market data, I did not see that in the longer term, what happens? None of that. Right? So what is availability bias? When you judge the likelihood of an event based on how easily examples come to mind. The likelihood of tech stocks outperforming is coming to my mind, is that is my opinion, and that has been formed because of an easily recallable information, which is what? That because of, I mean, which is that the tech stocks have outperformed in the past 1 week. And all of this is because of extensive media coverage. And I ignore the actual statistical probability. I'm giving more weight to recent, vivid, memorable information. Right. Key characteristics: events that are recent, frequently occurred, or emotionally charged are easy to recall. Investors may overestimate the probability of events that they have seen in the news or experienced personally. The bias is skewed. This results in skewed risk assessment and improper diversification. Right. This can result in, you overweighting, your portfolio into popular stocks. Now a lot of times you see AI people talking about AI. So you sort of, invest in AI stocks. Tech IPOs, you sort of see, whatever is happening in the news, you sort of invest because of that. You might avoid assets like bonds or foreign stocks if they have little exposure or recollection. It encourages changing recent performance while ignoring long-term fundamental or historical data. Again, very simple and straightforward. And that is what your availability bias is. And these were your cognitive errors. There were two types: the perseverance, and the other one was information. Right? These were the two types, and we have completely discussed them. Let's go to our next type of bias, which is emotional bias. इमोशनल बायस बहुत सिंपल है, 6 टाइप के होते हैं. पहला, लॉस अवर्जन बायस. What is loss aversion bias? Let's say, for example, the kind of happiness that I'm going to derive from a rupee 5 gain, right? From a rupee 5 gain, the kind of happiness that I'm going to derive. Let's say, for example, I can quantify happiness. Let's say I'm going to get 100 happiness out of rupees 5 gain. You know what? From that same amount of loss, the pain that is going to come to me is going to be a lot more. So let's say for example, the happiness that I have is minus 200. I hope you guys understand minus 200 happiness is ultimately, you're sad. But like, I'm just trying to write in the same terms. So the kind of happiness that that I sort of have is minus 200 for an equal amount of loss. Ideally, sir, the happiness that I derived from gain was 100. So the happiness that I should derive from the same amount of loss should be minus 100. But why is this more? Because we all are risk averse investors. Because we all are what? Risk averse investors. Majorly. Right. So what is loss aversion bias? It refers to human tendency to feel the pain of a financial loss more intensely than to enjoy an equivalent financial gain. The pain was minus 200 for a $5 loss, for a 5 rupee loss, and for an equal 5 rupee loss, the happiness was only 100. This emotional reaction leads individual to make irrational decisions. Right. Key characteristics: people tend to avoid risk when they're facing potential gains, right? Because whenever you're facing gains, then the moment you start to have profits, you sort of avoid taking risks. Why? Because you think that, I don't want to take more risk. I prefer uncertainty. They tend to embrace risk when they're facing potential losses. When I'm facing losses, then I'll start to take more risk. Why? Because I want to get out of this trough. I want to get out of losses. Are you want to get out of losses, so you're taking more risk, but that doesn't allow your risk profile. That is not allowed by a risk profile. What are you doing, man? Or no, yeah, I'm suffering from losses. I need to get out of this. You didn't react the same way when you were reacting when you were facing a gain. When you were facing a gain, you became comfortable. You stopped taking risk. But when you're facing losses, you took more risk. Why? Because of loss aversion. So you did not do justice to your risk profile. Emotional impact of losing 1,000 is greater than satisfaction of gaining 1,000. right? As humans in general, because we all usually are drawn more by negative emotions, they impact us more. We are loss averse. That's everyone. That's just not me. That's just not, very few people are not loss averse, right? Let's take an example. Let's take scenario number A. You are given rupees 1,000. This is for sure, right? You are given rupees 1,000, and apart from being given rupees 1,000, you're offered two options. What are those two options? First option, receive an additional rupees 500 for sure. So if you receive in option number one, you will receive additional rupees 500, so you'll end up rupees 1,500. That's option number one. Sir, the option number two is rupees 1,000. You get that. Apart from that, option number two, you flip a coin. If there's heads, you get rupees 1,000 more. Okay. If there's tails, you get nothing. So, sir, if heads, I get rupees 1,000, that means I can end up at 2,000 or zero if it is tails. You know what? The probability weighted outcome of this is the same. It is 50%, it is 500, it is 50%, it is zero. Ultimately, if I add the two, it is 1,500. Overall outcome is 1,500 only. But what happened? You chose option one. Usually everyone will choose option one. Now it's the same thing. I don't want to repeat again and again. You will choose option one. Why? Because 500 rupee gain is something which is a short thing for you, and always choose that because we all are risk averse. So you lock in that 500 rupees gain because they are risk averse in the domain of gains. Sir, loss framing, you are given rupees 2,000. Example. Now we'll take again an example. You are given rupees 2,000. Apart from that, you are given two options. First, you have a for sure loss of 500. So if a loss of 500, this is for sure loss, you will end up with 1,500. That is option number one. Option number two, which is what you are given rupees 2,000. Apart from that, if you flip a coin, if it's heads, you lose 1,000, and if it's tails, you lose nothing. So ultimately, the probability weighted outcome of this is going to be 1,500 only. But just because it was framed as a loss, you will choose what? Option number two. Because the moment you faced with losses, you are willing to take more risk so that you get out of it. So as a risk averse investor, as somebody who's loss averse, my decision making would be changing the moment I'm faced with gain and losses. So if I'm facing losses, I would try to take more risk. If I'm facing gains, I'll try to take lesser risk. Right. It is because of how things are framed to you, gain versus loss, right? Because you fear losses more than you value gains. All right. So what is risk aversion versus loss aversion? This is also very important to understand. You would have seen in your portfolio risk and return chapter one, there are three types of investor. First is risk averse investor. Second is risk taking. Third is risk neutral, right? And so right now we are studying loss aversion. What is the difference between risk aversion and loss aversion? Sir, risk averse investor avoids risk in general. Even if there is potential for a gain, he dislikes risks in general. A loss averse investor may take excessive risk only to avoid losses, even if such decisions are irrational. Understand the difference, guys. A loss averse investor is willing to take more risk because he's suffering from losses. There's a difference. Risk averse investor doesn't want to take any risk at all. This person wants to take more risk when he's suffering from losses and lesser risk when he's suffering from not suffering when he's having gains. That's the difference. Understand this. And these are the practical implications. You sell winners too early, you lock in into stocks hoping that they sort of go up in value. The investments basically that are suffering losses, you keep holding on to them so that you think that they are going to go up. Loss aversion can lead to excessive trading, poor timing, emotional investing. Your portfolio construction may be distorted. All of those things that are there. All right, pretty simple and straightforward. Guys, are you guys with me so far, understanding everything? Yes or no in the chat box. 15 more minutes, we are done with this chapter again. ये भी हो जाएगा अपना पूरा पूरा. Also, one thing that I think, and I think I'll address that quickly. I think we will only be done with portfolio risk and return part one. We'll only be done till there, I think, today. Portfolio risk and return part two will be left. I think I'll be covering that. I'll again take a live, not this week for sure, next week again, because this week you have your mocks. I'll again take one more live and I'll explain. I'll revise that chapter with you guys. Portfolio risk and return part two, which is a major pain point for a lot of students. All right, guys. Next is overconfidence bias. What is overconfidence bias? Overconfidence is bias is where I'm overestimating my own knowledge, prediction ability, reasoning skills. Right? It comes from illusion of knowledge. It comes from self-attribution. I am the one. I have overconfidence on my skill. All of these things. That is what your overconfidence bias is. Right? It can be prediction overconfidence. You underestimate uncertainty, volatility. It can be certainty overconfidence. You are overestimating the probability that one's prediction is correct. Right. So prediction overconfidence is underestimating volatility. Certainty overconfidence is overestimating the probability that it is correct. Right. That's what the difference is. Nothing else. Simple, straightforward. Right. What are the effects on investment decision? Underestimating risk, overestimating expected returns, trading too frequently, assuming market timing skill. You can time the market. That's what you assume. Your so portfolio diversification is insufficient. You can mitigate this. How come? You can use data-driven risk models. You can, you can have external challenge. You can have validation to your personal investment beliefs. You can do stress testing. All of those things can ultimately mitigate it. But that's what overconfidence is. Right. Overconfidence is where you overestimate your knowledge, your prediction ability, your reasoning skills. Right. It comes from illusion of knowledge. It comes from self attribution. Right. You actually know more than what you sort of you actually do. Self attribution, attributing success, where you're attributing a lot of success to your own skill. Right. So a lot of people are like that, where you take credit of your successes, but you don't take responsibility of your losses. Exactly like that self attribution is. Right. One thing that I've seen a lot of times with students being very confused is what is the difference between overconfidence bias and what is the difference between overconfidence bias and illusion of control? Right, guys? Can somebody point out this difference to me quickly in the chat box? Guys, they are almost the same. The difference is you identify via a question. All right. You sort of identify that what exactly are they trying to say. Illusion of control is a cognitive error because there's a lot of market data that is suggesting otherwise, but you still believe that the outcome is something that is controlled by you. That's what illusion of control is, where you'll see a lot of data being thrown at you. Overconfidence is something which is more emotional, right? Where you will see more things that are to do with, things are being pointed out in an emotional direction as opposed to more data driven, you know, mm, questions. So that is what this is. That's the only difference. That's how you identify. Otherwise, you will see that they are almost the same, and they are actually, right? Now, the next is self-control bias. What do you mean by a self-control bias, right? Guys, we all are suffering from this bias. None of us have self-control. We always chase that short-term gratification over our long-term goals. Long-term goals currently is to clear CFA level 1. Short-term gratification, 10 मिनट रील देख लेता हूँ. Let me just watch that favorite episode of let me just watch the episode of my favorite probably TV show, right? So you sort of chase the short-term gratification over long-term financial goals, right? So in the longer term, my financial goal is to have a good corpus in retirement. Short term, I want to own a BMW. Tomorrow I get a bonus, I sort of just blow it up on the BMW, right? So you avoid your short-term sacrifices for the future benefits, right? It can be hyperbolic discounting where you smaller reward, you sort of, prefer a smaller reward today over a larger reward in the future. This can result in you not having enough money for retirement, right? You can probably invest in a lot of high yield or income producing investment to meet the short term needs, right? You avoid long term asset allocation plans. So for that, what do you do, sir? You build a disciplined savings plan, right? Example, investor cashes out a portion of the retirement fund to buy a new car rather than leaving it invested for future compounding. Regularly review investment goals and budgets. It's very important. That's how you can mitigate it, right? Introducing long-term indicative alignment through planning tools, incentive alignment through planning tools, right? Like you sort of, in the longer term, what is the incentive that you have? You sort of keep reminding yourself that, you will have a lot of planning tools with respect to that, right? A lot of them can be like, it consistently reminds you that this is the kind of corpus that you would have if you let this money, if you keep this money invested. The other one is a status quo bias. What is status quo bias? Uh, yes. What is status quo bias? This bias leads to prefer existing conditions and resist making changes even when change may be beneficial. Basically, lying in your comfort zone. Remember this like this. We all know that if we go beyond our comfort zone, there's progress and we can do very well in our life. But what happens? We are so comfortable in our existing condition that we resist to make changes, even when the changes are beneficial to us. This is do nothing. Even when the better option exists. You hold legacy assets or allocations without reassessment. Because of that, what happens now? Because you have inherited a lot of properties and you have a lot of real estate, that is not a very good yielding asset for you. It is not, there's not a lot of capital appreciation and you can take a lot of risk, but you're very comfortable because rent is coming to you, regular income is coming to you, even though you know that if you sell this and create a portfolio that's more allocated into equity and stuff, you can have longer term returns, but you're very comfortable in it. So you constantly avoid these rebalancing decision, right? Uh, you end up holding these legacy assets, which is real estate. You avoid switching fund provides, that is provided due to, you know, fund providers due to inertia because you're very used to one sort of fund provider. You sort of skip switching because even though it is beneficial for you, what happens? What are the fail your implications of it? You don't adapt to new life circumstances or risk profiles. Ideally, as you have so much inheritance, a lot of them you have inherited so much money, so you can take more risk, but you don't end up because you're very comfortable with the current real estate investments. Your portfolios become very outdated. You have suboptimal performance, right? How do you mitigate this? You do your periodic portfolio, you review your portfolio periodically. You have scheduled rebalancing. You educate the investors. All of those things can be the case, and that's how you can fight it. The next one is endowment bias. Now, what exactly is endowment bias? Example. Yeah, I think I have already taken example of this. Uh, but let us quickly go over that. An investor in it shares of an underperforming company from a parent. So I have inherited, one of the company's shares that are underperforming. I took an example of wife. Here you're inheriting that from parent. Parent is no more, and you've inherited that. Although the stock no longer aligns with their financial plan, as an investor, as an individual investor, even when I've inherited something, and that stock that I've inherited that does not align with my current goals, with my plans, they are reluctant to sell it. Why? Because there's sentimental attachment, and there's a belief that it is special. So you sort of ascribe more value to an asset simply because you own it. It reflects an emotional attachment that leads to irrational behavior such as holding on to inherited, gifted, or long-term investments, such as, even when the better alternative exists, such as the example that we just took. Right. Sir, how can you mitigate this particular thing? How can you mitigate? Ask this honest question to the person or to yourself who currently holds these assets. Would I buy something like this in the market today? The stocks that I've inherited from my parent who's no more, and I've inherited that, and there's a sentimental value attached to it, and I'm very, very emotional about it. But will I go out in the market and buy something like this? That will answer my question. So you ask, would you buy this asset today at its current price? You frame decisions from a clean slate portfolio perspective. It's very important, right? What is the insight? Behavioral insight. In studies, people often state higher prices to sell an item they own than they're willing to pay to acquire the same item. So let's say I currently own an item, and whenever I want to sell it, I will obviously quote a higher price because I own it. But if I were to go and buy the same asset in the market, I will buy it at a cheaper price. If I'm sitting in this flat today, I would want to sell this flat at 5 crores. But what mentality is, this is called as endowment effect. Your ownership reflects the perceived value. If I'm owning this, perceived value is more. If I don't own it and if I'm willing to buy it, the perceived value is much lesser. This results in holding on to poor performing or unsuitable assets. Your emotional bias is, distorted, and your rebalance, and this ultimately your emotional bias distorts your rebalancing and asset replacement decision, and you miss the opportunity cost due to emotional anchoring. There's a lot of opportunity cost that's out there that you're missing out on because of this. Right, and the last one is your regret aversion bias, and then I think we are done with all the with the entire chapter. What is regret aversion bias? The regret aversion bias is what, guys? The regret of, or let me just read it out for you guys. The regret aversion, which is with respect to avoid making a decision due to fear of future regret, either from a bad decision or from not taking an action, is massive, and that is what regret aversion bias is. So, what have you just said? We don't get it. The pain of regret from taking a wrong action is usually felt more intensely. Again, please, can you summarize the whole thing? Regret aversion bias is basically of two forms. Let me just now summarize the whole thing. Sir, it is error of commission and it is error of omission. Now, what is error of commission? What is error of omission? Regret of taking a bad action. That tomorrow, what if I buy this stock and it falls down? Right? That's the first type of regret aversion bias. Second type, regret of omission. Right? So the stock is rising. Oh, I should buy this. There's a FOMO. So there's a regret that is coming from inaction. So, sir, I can have regret from what? From taking an action, or I can have a regret from having or not acting. Okay, so that is called as error of commission, error of omission. Okay, we get it. Is that what regret aversion bias is? Yes. Where I avoid making a decision because of a future regret, or I don't take a decision because of what? Because of, I avoid taking a decision because of future regret, or I I end up taking a decision because of FOMO. That is what regret aversion bias is, right? Sir, regret aversion bias can result in what, sir? It can result in herding behavior. I am currently scared of the inaction. There's a stock that is rising, and if I don't buy the stock, I will regret my inaction. And if I will regret my inaction, you know, I'll not feel well emotionally. So let me just get onto the stock which everyone is buying because it is rising in price, and I don't want to have that FOMO. That will result in herding behavior. Sir, fair enough. So what is regret aversion to summarize? Sir, regret aversion is either being scared of taking an action because tomorrow this action can turn out to be wrong, or sir, fearing to not taking an inaction, or to not take an action, basically inaction, fearing that tomorrow if the stock price goes up or this investment actually rises in value, I will lose out on the potential profit. That is what regret aversion bias is, right? All right, sir. Sir, the regret of not taking an inaction because I don't want to lose out on the potential profit results in what? Herding behavior, because it comes from FOMO. So you will follow the crowd. Because tomorrow, if everyone fails, you can say that, okay, everyone failed, I failed as well. That's fine. You avoid bold or continent decision that could attract regret if they particularly go wrong, right? What is the impact? It leads to excessive conservatism in asset allocation. Whatever asset allocation you're making, it can lead to either excessive conservatism because you're fearing your action. You might avoid high risk, high return investments because you're fearing action. Or you can missed opportunities because of underperforming or embarrassment. All of the same thing, right? Example, an investor chooses a low yield bond fund over an emerging market equity fund, not because it aligns better with their goals, but because they want to avoid feeling regret if the equity fund underperforms. How can you mitigate this? Use scenario analysis. You focus on long term goals. You reinforce decision making based on disciplined process rather than outcome. So, have a disciplined process rather than an outcome based investment. Have a disciplined process. So, I don't care about the outcome. My process has to be right. Right? That's important. My long-term goals matter to me. I don't care about my short-term emotional reactions. I'm going to analyze the entire scenario and I'm going to plan every potential outcome that is there. And I'm not going to uh, just invest in something because it is rising or, not take an action because, sort of I might lose out. So that is what your regret aversion bias is. And that wraps up our chapter completely with respect to behavioral biases of individual. And we are done with 3 readings so far. With me, yes or no? I think I screwed up regret aversion a little. To be honest, now it's been 3 hours, so I also would need a break now. So, yes. One more thing that I think the part that people are talking about is the last LOS of that particular reading, which is halo effect and everything else, where you see halo effect, home bias, all of those things. I think they are pretty straightforward. That's why I've not included in my summary. Uh, Pretty straightforward, pretty easy to understand. That's why I've not particularly included that in my summary. It's a very simple read. So that's why this has not been included in my revision part. All right. So, yes. One more thing that I think the part that people are talking about is the last LOS of that particular reading, which is halo effect and everything else, where you see halo effect, home bias, all of those things. I think they are pretty straightforward. That's why I've not included in my summary. Uh, Pretty straightforward, pretty easy to understand. That's what आवाज आ रही है सब बराबर है. Okay, guys. Now before we start the next reading, it's 2:33. I'll see you guys at 3. Okay, take a break, have your lunch, eat your food, and then we resume again. The target is to finish off risk management and portfolio risk and return part 1. Okay. This is an exercise that we're doing for the first time. So I anticipated that the whole thing would get over in 5 hours, to be honest. But I don't think that's going to be the case. Anyway, we'll try to finish up how much ever we can. Uh, but yeah, let's try to finish this, and portfolio risk and return part 2 will be continuing on some other day. All right, perfect, guys. See you guys at 3. Hi guys, I hope you guys are back. Let's get started. Yes, Nikhil, the effort is going to be that we try to make sure that as much subjects we can do. No commitment from our side, to be honest, but I'm planning that we do at least for few subjects. So yes. Okay, I hope you guys are back. Let's get started, guys. So what do you mean by the effort is going to be that we try to something audio is okay. Perfect. Okay, guys, risk management. What do you mean by risk management? It is a structured process through which an entity will identify the risk, will measure the risk that it faces, and then ultimately modify and monitor these risks. Right? So identify your tolerance for risk. Then you identify and measure what exactly the specific risks are that you face, and then you ultimately modify and monitor these risks over time. That is what your risk management is. Risk management is a process. Again, I'll repeat. First step, what do? You identify risk tolerance. Second, what do? You identify and measure the risk that you face. And third is you moderate and monitor and modify and monitor whatever risks are there with respect to your organization over time. Right? Obviously, your aim should never be to eliminate all the risks, but you have to make sure that you have to select the kind of risk you face, and you have to make sure that you sort of eliminate, reduce the risk that you don't want to face. Right? That is what it is. What are the principles, guys, with respect to your risk management? Risk tolerance assessment, risk identification, measurement, modification, monitoring. All of the processes, the process that we saw above, all of that has just been described here. Risk tolerance assessment. How much risk an entity is willing and able to bear. In case of individual, how you used to define that what is the risk that I'm willing to bear, what is the risk that is, what is my ability to bear the risk. Exactly like that, from an organization standpoint, you also have to define what is the willingness of an organization to bear the risk, what is the ability of the organization to bear the risk. Then you identify what are the internal and external risks that we are getting affected by as an organization. Right. Then you quantify those risks. Right. What is the magnitude of that risk? What is the likelihood of that risk? You can use qualitative or quantitative tools, and then ultimately modify. You can use hedging, you can use insurance, you can use diversification, whatever that may be, but it's up to you. Whatever you want to do, you can modify. And then obviously, if you're modified, you need to monitor as well, like whether the risks are within the acceptable boundaries or not. And that is what your process looks like. Guys, what exactly do you mean by risk exposure decisions? A firm might increase the risk exposure if it believes that it has the ability to take risk. Right. So if I have ability to take risk, I will increase my risk exposure. I will reduce my risk exposure if I think that I am not equipped to handle risk, right? By ensuring and etc. etc. But it is But risk management as a process is not the fact that I eliminate all the risk. It is that I align my risk tolerance with my risk that I align my risk tolerance with the risk that I'm taking. That is what risk management is. That the risks you are taking is aligned with the risk tolerance that you have so that you have maximum outcome. So it is about aligning the risks of a firm with the ability, with the capacity to bear and respond to them. Right? That is what it is. So ability and willingness is what they tend to talk about. Risk is not inherently bad. Returns about the risk created because of risk. Right. The goal is taken on the right risks, those aligned with the firm's risk tolerance and expected returns. The same thing is repeated again, what I just spoke about. Actually, there has to be a full stop here, by the way, guys. This has to be captured. Risk is not inherently bad. Any returns above the risk-free rate exist because you take risk. That is what it is. Right. In a broader context, guys, what exactly is the application of risk management for a corporation? Align the strategic and operational risk with its business objectives. For an investment portfolio, optimize the asset allocation to achieve the risk-adjusted returns. So, from a corporation point of view, I want to align whatever my strategic and operational risks are, so that I can achieve my business objective. For an investment portfolio, I want to make sure that my asset allocation is such that I am getting good risk-adjusted returns. Right. For an individual, I want to make sure that the risk levels that are there, maximize my utility, the happiness that I derive. Right. Not just returns. I don't want to just maximize my return. Also want to maximize my happiness. My returns might go up. My happiness is not going up. No, I mean, no benefit. I mean, no purpose is served there. I want to make sure that my utility is maximized as well. And that's what this point is. Risk management, a universal framework. The framework of risk management, where I am first defining my risk tolerance, then identifying my risks that I'm currently facing, measuring those risks, and ultimately modifying and monitoring those risks. This entire process, it is universal. You can apply it to a corporation, to an investment portfolio, to an individual. You can apply it to any place you want. All right. Again, pretty simple and straightforward as a topic. Right. Risk management framework, guys. Risk management framework is what? It refers to comprehensive set of processes, procedures, and infrastructure that an organization will use to identify, to measure, to manage, to monitor the risk. And align those risks with the goals and the risk tolerance of an organization. Excuse me. It is that foundation which allows for consistent and disciplined risk making across the risk decision making across the organization. Again, pretty simple, straightforward. Guys, how does this framework work? Sir, we understood risk management process. What is risk management framework? This elaborates the process. This expands on that process. Okay, this confusion constantly I've seen among students that, sir, what is the difference? We are not able to identify. There is no difference. The framework is ultimately what? Framework is expanding on whatever the process is. So what exactly is in the framework, sir? First, establish process and policies, then determine risk tolerance, identify and measure the risk. You will see the same points. Manage and mitigate the risk, monitor risk exposure, communicating across the organization, performing strategic analysis. Simple, straightforward. Let's try to understand each one of them. Establishing process and policies. You need to establish policies so that you can govern the risk. Right, you can govern the fact that how risk will be identified, how it will be assessed, how it will be treated. अरे ये सब करने के पहले policies तो बनाओ boss. Before you start doing all of this, at least make some policies, rules, regulations. They all of that is required. You need to determine the risk tolerance, ability and willingness, guys. Identify and measure all the risks. Determine what kind of risks you're facing. Quantify those risks. Determine their probability. Then manage and mitigate the risk. Right? Implement controls where you can reduce, transfer, or accept risks, depending upon your risk tolerance. Then you monitor, track whether it is within the approved boundaries or not. Communicate. Ensure that stakeholders are informed and aligned on risk-related decisions. They are aware. And then ultimately, what? Evaluate the long-term risk trends and align them with strategic planning. Perform strategic risk analysis. Right? You need to make sure that in the longer term as well, the risk that you're taking is appropriate with your strategic planning, where you see that your organization is heading. That is what this is. That's what your framework is. Right? Now, what do you mean by risk governance? Guys, you saw the first point there. Establish process and policies, design policies that govern how the risk. It's somewhere related to that. What is risk governance? It is the system by which senior management, system guys, system matlab rules and regulations, policies, procedures, right? Which defines the risk, monitors the risk, oversees the risk, tolerance, strategy, and risk structure of the organization. अरे मैंने बोला ना ये सब करने के पहले ये पूरा करने के पहले इट इज वेरी इंपॉर्टेंट दैट यू हैव रूल्स एंड रेगुलेशंस इन प्लेस एंड दैट्स व्हाट गवर्नेंस इज अबाउट राइट what are the elements first to determine risk tolerance define how much risk organization is willing and ability to bear risk exposure outline how risks are chosen avoided mitigated monitored governance structure and oversight you sort of provide organizational oversight to ensure consistency and compliance organization wide guidance communicate what should be pursued what should be avoided what should be limited have a committee in place which does all of that simple. But it is very important that your risk governance aligns your organization's strategic goals and acceptable risk levels. Now, if you would have noticed in your curriculum that this part, risk governance, your risk tolerance, your risk budgeting, all of this is very theoretical, like very heavy, like a lot of text you will see. Especially in this chapter, you will see a lot of text. What I've done is I've tried to summarize the whole thing very well for you guys. जितना जरूरत है उतना बता रहा हूँ, like for example, elements of risk governance is something that you can quickly read and just get off, because it's the same repetition again and again. Example, like for example, a large commercial bank is planning to expand into cryptocurrency trading. They want to enter into cryptocurrency trading. Now the board of directors are obviously concerned because cryptocurrency is volatile. There's regulatory risk as well. So what exactly would a risk governance action would be? What would you do? The first step is risk governance. What would you do? Sir, first chief risk officer will work with senior management and determine by risk tolerance क्या है with respect to the digital asset exposure. Form a risk management committee, right? That is what it is. Then identify acceptable level of activities and high risk, restrictive, high speculative trading. So you understand what are the acceptable levels of activity, and then you have to restrict that, high speculative trading is not allowed. Review this, review this, analyze these scenarios. That is what it is. The banks has entered into crypto space. Those banks have entered into crypto space cautiously, preserving reputation, limiting downside risk, and ultimately demonstrating strong risk governance alignment. And ultimately that is what the result of this activity is. Again, pretty simple. Risk tolerance, guys. What do you mean by risk tolerance? The level of risk that the organization is willing and able to bear, right? In your strategic or whatever strategic objectives and operation objectives are. Risk tolerance influences the types of risk a firm can take, extent to which the risks are accepted, mitigated, and avoided. How much to accept, how much to mitigate, how much to avoid. Right? Mitigate meaning reduce. Avoid मतलब बिल्कुल ही ignore करो. Do not enter that territory. Except इतना मान लिया कि हम इतना face करेंगे. The design of organization's overall risk management strategy, it will also influence that, guys. That is what tolerance is. Tolerance is simple ability and willingness. Budgeting, this is the amount of risk that we are willing to take, right? So whatever my organization's acceptable level of risk is, I sort of do what? I sort of, allocate that across what various investments or asset classes so that my overall risk tolerance and return objectives are met. There, whatever my risk budgeting, whatever my budgeted risk is, I will try to allocate it across different departments. If I'm an organization, if I'm an investment, then across, if I'm an investment company, then across different asset classes, and I will try to make sure that this allocation of my budget of risk is in alignment with my risk, whatever my risk tolerance is and whatever my return objective is. So budgeting is what? First defining this is the amount of risk I'm willing to take, then allocating it. Ultimately, the objective is to always maximize the return depend and keeping your risk within the acceptable limits. Right? Risk budgeting, what are the elements? What is the total risk budget? The total risk that organization is willing to take. Then you allocate that risk. The process of distributing that risk across different assets or strategies. Right? In case of investment company, it can be that there can be other things as well with respect to other type people also trying to adopt as individual companies and stuff like that. What are the different metrics? How do you measure it? Portfolio beta, VAR, volatility, duration, tracking error, all of this we understand, right? I hope you guys remember your tracking error, right? Portfolio risk and return, chapter part 2. Risk aggregation, combining individual risks to estimate an overall portfolio risk, right? So you combine individual risks that you have allocated across different the risks that are currently faced by different departments. Let's say, for example, you aggregate all of that risk. So you determine that this is the risk that I'm facing. This is risk aggregation. This is the risk that I'm facing, not allocating. And then you see aligned whether it is aligned or not. The risk that I'm budgeting and the risk that a particular department is facing or a asset class is facing. So what is budgeting, guys? Budgeting determining this is the risk that I'm willing to take. Then allocating it across various departments or asset classes in case of an investment company, right? I also need to align. Align what, sir? The different risks that are faced by different departments or asset classes in case of an investment company and align that with the risk that I have budgeted, right? That is what it is. So again, pretty simple and straightforward. Risk fair now, an organization typically faces two types of risk. Sir, first is financial risk, other is non-financial risks. Sir, what is financial risk, sir? Something that arises from exposure to financial markets. Example, sir, credit risk. What is credit risk? So let's say, for example, I invested in a bond of a company. Now, tomorrow, if the company doesn't give me the money, My money is gone. That is credit risk, right? The risk that the counterparty will not perform the obligation that it is supposed to perform. That is what this is. Liquidity risk. What is liquidity risk? The risk of not being able to sell the asset at all or selling the asset at lower than its fair value. So let's say, for example, selling a piece of real estate below the fair value because the demand is not there, right? Market risk, the risk that results from fluctuation in asset prices or interest rates. Obviously, if I have an asset which is influenced by market prices, so that is going to which is influenced by the market trends. Ultimately, the price is going to go up and down, and every asset is influenced by market trends. And ultimately, what there's going to be volatility, and the what do you call that? Volatility is the market risk, right? Bond prices might be influenced by changes in interest rates. That's a risk. Equity prices are affected by the volatility. That's a risk, right? So if my asset is I have a stock portfolio, then it becomes a problem. Right? What are the non-financial risks or operational risks? My operations going down. So let's say, for example, I'm a broking firm, and my server, sort of, you know, yeah. So my there was a failure in my server, and some issue arise because of that, and my trading operations were halted. That is an operational risk that I face. It can be because of system breakdown. It can be because of the process failure. My process is something that's wrong. It can be because of human error. It can be because of external disruption. It can be anything, but that's an operational risk, right? Solvency risk, risk of an organization running out of cash and failing to operate, or an organization running out of money, becoming insolvent. A startup that is left with no funding, can't pay suppliers, that's a solvency risk. Regulatory risks, cost or losses due to changes in regulatory environment. Let's say I do a tobacco business. Tomorrow, government coming out and saying that tobacco is banned. Right. A new capital requirement rule for banks affects the lending operations. Bank currently, whatever deposits they accept 100 crores, they are able to lend 80% of it, let's say 80 crores. Tomorrow, RBI comes out with a rule that only 50% of it can be lent. Your lending operations are going to be affected. Government risk, political risk. Government is unstable. Our neighbors, right, is not stable, right? So that's a risk. So political decision, including taxes, changes, and instability, can also cause that. Instability in the government can, sort of create that risk for you, right? So a sudden tax hikes reduces post-tax profit for multinational, because if that's tax hike, they will be paying more taxes and your post-tax profit would go down. Legal risk. I can be exposed to lawsuit or legal penalties. Right, as an organization, tomorrow somebody, because of my product, let's say I'm an FMCG company, and somebody was using one of the the food product that I made, and they suffered a huge damage to their health because of it, and they came and so they sort of filed a lawsuit against me, ex- you know accusing that it was because of my product. That's the risk that I face, right? That's what this is. More different types of non-financial risk, guys. A few more. Model risk. Risk that the model that I'm using for valuing a particular organization, that model is flawed. Let's say, for example, I am valuing a mature company using a relative valuation model. अरे यार model flawed है यार. That's a risk. Tail risk. What is tail? So let's say, for example, I have a normal distribution, right? Majority of my events lie in this, but there are these tail events that are there, right? What if they kick in? What if they happen? Sir, are you talking about extreme events? Yes. 2008, tech bubble, Satyam scam, extreme events. You lose a lot of your money. And trust me, guys, they are more likely than you're expecting them to be. A lot of times we assume that a particular security is following a normal distribution, but that is not the case in real life. They either have excess kurtosis, right, or they have excess cueness. The point is that assuming the returns to be normal, you underestimate the tail risk. But actually, they're either negatively skewed, positively skewed, or they are The kurtosis is a lot. That makes the extreme events or tails more likely to occur than they actually can, than you actually assume. Accounting risk is risk that the accounting policies or estimates are wrong or manipulated. The accounting estimate that you made, the policies that you have in place, the risk that they are wrong. What do you do then? And that is what accounting risk is, right? Sir, from an individual standpoint, we understood from an organization standpoint that we face either financial risk or non-financial risk. Okay, if an organization's accounting goes wrong, operationally something happens, sir, if the tail events happen, sir, if the model that is used to value that particular organization becomes a problem, the legal risk that is faces, government risk, regulatory solvency, sir, we understand all of that. But from an individual standpoint, sir, what are the risks that usually we face? First is mortality risk. I die prematurely than, before providing for my dependents. You hear this a lot these days that people at young age getting heart attacks. What is that mortality risk? How can I counter that? Life insurance. Longevity risk, living more than expected. I anticipated that I will retire at the age of 60 and maximum life expectancy that I will have was 75. So I made my retirement corpus for 15 years. But actually what happened? I ended up living till 90. Arey, what about the rest of the 15 years? That extra that I'm living. What about that? That is longevity risk. So what can I do? I can buy lifetime annuities. An annuity where I pay a lump sum amount and then they will keep on paying me per month till the time I live. Or have pension plans that will protect me till the time I die. Health risk, cost of healthcare or long-term illness. What if I suffer from some deadly disease tomorrow? What if something happens and the cost of healthcare is huge? Get insurance. What is the approach to this risk? You either self-insurer. Basically, you bear the risk. You avoid the risk or you transfer the risk. Obviously, these risks you can't avoid only. But this is usually the way that you deal with any sort of risk. Either you avoid it, पतली गली से निकल जाओ, साइड से निकल जाओ, या तो क्या करो, you transfer it to an insurer, or you bear it. That is what this is. Right. Perfect, guys. Is everyone following so far? We are done with a lot of we are done with a lot of chapter. हम लोगों ने काफी कुछ कवर किया है अभी तक इस चैप्टर में. आई होप यू गाइस आर फॉलोइंग एंड आर विथ मी. Right. Perfect, guys. Is everyone following so far? We are done with a lot of we are done with a lot of chapter. हम लोगों ने काफी कुछ कवर किया है अभी तक इस चैप्टर में. आई होप यू गाइस आर फॉलोइंग एंड आर विथ मी. Perfect. All right, guys, let's proceed now. Now, what are the key risk measurement tools, sir? How do I measure the risk? What are the key tools that are there? Standard deviation, beta, duration. Sir, we understand all three. Standard deviation measures the volatility of asset prices or interest around the mean. Right? If the standard deviation is 15%, what does that mean? That my data is usually 15% away from the mean. Right? But standard deviation is a useful tool for assets that have a normal distribution. The moment you have negatively skewed data or positively skewed data or a data where there's a lot of kurtosis, what do you do in that case? In that case, this as a risk measure is not right. So it is very, very misleading for non-normal distributions. Sir, what is beta? Beta measures the asset sensitivity to the overall market return. So if my beta is 1.5, market, I hope you guys remember all of this. I'm not going to repeat this again and again. I mean, not again and again. Actually, I have not taught you this. I'm just very used to a reflex that comes in from my classes. But the point is that the beta is 1.5. So I hope you guys remember how do you interpret this. If the market is going up by 1, your stock is going to go up by 1.5 times, right? It is a market risk assessment of equity securities in a diversified portfolio. But what are you ignoring when you talk about beta? You're ignoring unsystematic risk. and you assume that there is a linear relationship with the market, meaning if the market goes up by 1, your stock will go up by 1.5. This is a linear relationship. But that is not the case in real life, right? If the market is moving, your security might not move at all. And duration measures the sensitivity of your price sensitivity of your fixed income security to the interest rate changes. Higher the duration, higher the sensitivity, right? It is best used for interest rate risk for bonds and debt securities because higher the duration, higher is the interest rate sensitivity. I hope you guys remember this. In case of derivatives, sir, how do you measure? In case of derivatives, how do you measure the risk? There are four of them. There are four different metrics. There is delta, there is gamma, there is vega, there is rho. Sir, what is delta? Delta measures the sensitivity of change in the derivatives value to the change in the price of the underlying. Right? Higher the delta, higher the sensitivity. Meaning a delta of zero point 0.6 means that tomorrow the option price will rise by zero point 0.6 if the stock rises by $1. That is what delta is. Delta measures the change in the price of the derivative with respect to the change in the underlying, right? This talks about the price risk. Sir, gamma measures the sensitivity of delta to the changes in the price of the underlying, meaning how sensitive the delta is, right? How sensitive the delta is, meaning, delta is tracking the change in the price of the underlying. Gamma is tracking the change in the delta to the change in the price of the underlying. So basically, it is tracking the delta's sensitivity to the change in the price of the underlying. Delta is tracking the derivatives sensitivity to the changes in the price of the underlying. Very important. Understand this hierarchy. I'll again repeat. Guys, delta is tracking the changes in the price of the derivative to the changes in the price of the underlying. Gamma is tracking the changes in the price of the delta with respect to the changes in the price of the underlying. Very important. That's why it is second order. Higher the gamma, higher the gamma, delta will change as rapidly as the price changes. Right? Vega is what, sir? It measures the changes in the derivative's value to the changes in the volatility. Right? That is what it is. It talks about volatility risk. If my vega is zero point 0.2, what does that mean? My option value will increase by 0.2 if the volatility increase by 1%. And I hope you guys remember the price of the options value is directly related to the volatility of the underlying. Higher the volatility, higher the options value because there's a direct relationship. So if the volatility goes up by 1%, if my vega is zero point 0.2, that means my vega is zero point 0.2, that means my derivatives is going to go up in value by 0.2. Right? Rho, sensitivity of derivatives value to the changes in the interest rates. How sensitive my derivatives value is to the changes in the interest rate. So if my rho is 0.1, the option prices will increase by 0.1 if the interest rate raises by 1%. Right? This is true for what type of option? Call option. All right. That is what your rho is. Now, let us understand what you mean by tail risk. This is your downside risk. Tail risk meaning the extreme negative events that can happen. This is what your tail is. Right? This is what your tail looks like. The extreme event that can happen, that is what tail risk is, also known as downside risk. Extreme negative outcomes, that is in the tails of the distribution. It is common in non-normal distribution with a negative skew or fat tails. Normal distribution, not very common. These extreme events will not happen a lot. Why? Because in normal distribution, majority of the data is here only. Right? But in case of what? Negatively skewed. In case of negatively skewed data, you will see a lot of your data is towards the negative side. So negative events, extreme events happening, the probability is more high. Or when you have fatter tails, what happens? When you have fatter tails, a lot of your data is in the tails as compared to normal. Right? Obviously, then in this case, you cannot use standard deviation because it may understate your true risk. Because standard deviation is not an ideal metric for measuring risk with respect to non-normal distributions. Right? I hope you guys remember this from cons. Guys, how do you measure this tail risk, sir? There are two ways. One is VAR and the other one is conditional VAR. What? One is VAR and the other one is conditional VAR. Sir, what do you mean by VAR? VAR is value at risk. Minimum loss expected over a given period of time at a specified probability. That is what VAR is. What? The minimum loss that is expected over a given period of time for a specified probability. Sir, meaning a 1 month VAR of 1 million at 5%. What does that mean? This has been given to you. This has been given to you that my VAR for 1 month is 1 million at 5% probability. What does this mean? That there is a 5% chance that the firm will lose at least 1 million. I'll again repeat, carefully look at the word, guys. At least 1 million. Are we stopping at 1 million? No, sir. We are saying at least 1 million. So what does VAR point out, sir? VAR points out that what is the minimum loss that I'm expecting over a period of time for a given probability. अच्छे से समझो इसको, very important. क्या at least यहाँ पे क्या लिखा है guys? At least. And why am I pointing this out again and again? Because students are very confused between, sir, what is VAR, what is conditional VAR? We don't get it. Don't worry. What are the key features of it? First, time horizon. There is a time horizon. There's 1 day, 10 day. VAR is typically over a time horizon. It can be 1 day, 10 day, 1 month. There's a confidence level that is given. Here it is 95%. That means I'm 95% confident that this will not happen. But still there's a 5% chance that it will happen. When I'm saying there's a 5% chance, that means I'm saying a 95% chance that it will not happen. Right? Which implies a 5% or a 1% tail. Meaning that a loss is an extreme outcome, which is a tail event. So if I'm 95% confidence, that means that 5% chance is there, that which is a tail event. Limitation, but it is only telling me what is the loss, which is minimum loss. It is not telling me what is the maximum possible loss. It is just telling me that this is the kind of loss that I am expecting at least. And it also assumes that the distribution is normal. And obviously, whatever VAR you calculate is sensitive to the inputs that you have used to calculate that VAR. If bank's 1 month VAR 1 million at 5% means in 5% of the time, that is every 20 months, the loss will be at least 1 million. Right. Sir, what is conditional VAR? Remember what was the drawback of VAR? VAR, it didn't tell us what is the maximum loss. Conditional VAR tells me that. If I reach VAR, what? If I reach VAR, then what is the loss that I can expect? Because VAR tells me this is at least, this is the minimum that will happen. But where am I going to go? At least 1 million. Okay, I get it. But where will I stop? Will I stop at 5 million, 10 million, 15 million? Arey, where will I stop, Baba? I don't know. That where will I stop is told to me by conditional VAR, which tells me the moment a negative outcome is kicked in, what happens. Conditional VAR is the expected average loss given the loss exceeded the VAR threshold. That if my loss exceeds the VAR threshold, then what is the loss that I'm expecting? And how is that calculated? How is that calculated? Multiple extreme events are taken. That if the loss is exceeding 1 million, multiple events are taken. That around that time when the loss exceeded 1 million, my loss was 5 million. When it exceeded 1 million, it was 4 million. When it exceeded, it was 10 million. It was 4 million. All of this, I take a weighted average and I arrive at something which is called as conditional VAR. And I arrive at something which is called as what? Conditional VAR. So VAR is minimum loss in worst case. Conditional VAR is average of all worst case losses beyond VAR. Ignores what happens beyond the threshold. VAR focuses only on those tail outcomes. It is very good for setting capital buffers. Better for stress testing and tail risk assessment. All right. That is what this is. And how much are we left with respect to this chapter? Okay. Hold on for a second, guys. Let me just get the charger. All right. Subjective and market-based estimates of risk, supplementary risk assessment tools. Apart from you assessing risk via VAR, via conditional VAR, all of them are quantitative. We need some methods that are subjective, that are market-based. What where I don't have enough data. So basically, okay, let me just put it this way. VAR and conditional VAR is based on whatever has happened in the past. What about I have a security whose past is very limited? I want to quantify, I want to measure this, uh, you know, in a very subjective manner. What do I do in the case where there is no data? Simple. रखते हैं, वैसा करते हैं. What do I do, sir? I use stress testing, where multiple risk factors that are impacting a particular security, I alter only one of them and I see what is the outcome. Example, a 300 basis point rise in interest rate. Interest rate risk, a lot of portfolio suffers from that. I only sort of change in that factor and see what happens and what is the outcome of that. So you're talking about only single factor shock. You don't change all the factors. What is scenario analysis? You change all the factors together. So what if method, it is a method where you involve multiple variable changes. What if interest rate spikes and oil prices fall simultaneously? Right. So then you can understand how multiple factors affect the portfolio. But why are these subjective estimates needed, sir? We did quantitative. Right now, we are understanding subjective estimates that are market based, which are typically used for your securities whose past data is not available. Why are they needed? It is for infrequent but severe events. These events which are infrequent, basically stress events. When you want to understand what the outcome of them would be, you use it for that. Where data may be insufficient, right? And where that is why and therefore subjective judgment is required, right? Sir, why do you call these subjective estimates? We don't get it. We are trying to find out na ultimately what happens, what is the outcome. That is quantitative only na. But how the factors will change, that is your subjective assessment na. You are saying that let me just do stress testing and let me pick out one factor. That one factor is on the basis of your assessment. Subjective. How much will that one factor change by? That is on the basis of subjective assessment. Up to you. Again, 300 basis point in this case. Scenario analysis. You are changing multiple factors. That is subjective. That is completely up to you. That is what this is. What are the different risks that are difficult to quantify? Operational risk, guys. Operational risk is completely what? Non-quantitative. It can be because of human error, system malfunction, failed processes. Very unpredictable and very firm specific. And a company might not face it a lot of times. For me to have significant data for future reference, basically very few past events are there in this case. So I can't, it's very difficult for me. I don't have a baseline. I don't know how to predict. Recommended approach, use large sample of firms to determine this. Because one firm would not have faced it a lot of times. Let us just do one thing. I want to predict this. Let me just go over large amount of firms. What is the probability when I'm looking at large amount of funds? What is the probability of significant loss from all of these events? What is the average magnitude of these losses? So bank may use industry-wide data from 100 plus institution to estimate how often system outages result in more than 10 million losses. So basically system failure here. Let me just put it this way. So, because I don't have enough data on one bank about this problem, that if there's a system failure, what is the kind of loss the bank will face, because it's an operational risk. And I don't have enough data to sort of see what will be the outcome of it. What I do is I go across multiple banks and try to find out what should the loss be. Political and regulatory change, again, very difficult to predict. There can be sudden tax law changes, regulatory restrictions, it can be anything. The challenge remains that, it is politically driven. So how do I model that? Occurs with little to no warning. Demonetization. Again, approach is subjective expert judgment, where quantitative data is not available. Obviously, when it is not available, you have to estimate that tomorrow an event like demonetization happens, what will happen, stuff like that. I mean, of course, there's a past data here available, but something else only happens tomorrow. What are you going to do? You don't have like a past reference for it. You have to rely on subjective judgments. And obviously, it is better to rely on these kind of assessments rather than ignoring this risk at all. You can't say that, a political risk and operational risk is very difficult to estimate. Let me just do one thing. Let me just not estimate it. Arey, just because it is difficult, there's no past. That doesn't mean that you can't have a judgment. You have to have. It is better than ignoring it altogether, right? That is what this is. How do you modify these risk exposures? Obviously, guys, objective of risk management is not to eliminate all the risk, but to make sure that you achieve an optimal mix of risk. Meaning, you take the risks that you have the ability and capability to bear. You ignore the risk, avoid the risk that you cannot bear. You modify the risk that you think that you want to transfer to somebody else. Modify, basically transfer and stuff. So you increase the exposure, you decrease or avoid others, you eliminate a few risks, right? What is avoiding the risk? Do not engage in activities where the risk is unacceptable. भाई जाना ही नहीं है. For example, not investing in Pakistan at all. High political risk. Prevent the risk. Invest in systems or processes that eliminate or reduce the risks. That is what preventing the risk is. अब मेरे को पता है कि बहुत सारा डेटा ब्रीच हो रहा है मेरे यहाँ, तो लेट मी जस्ट डू वन थिंग, इन्वेस्ट इन साइबर सिक्योरिटी, तो डेटा ब्रीच रुक जाएगा. दिस इज प्रिवेंटिंग दैट रिस्क. एक्सेप्ट द रिस्क. You decide to deliberately accept the risk, to deliberately take the risk. Market is very volatile currently. The prices of that particular, let's say for example, I'm into steel business and currently market is very volatile and the steel prices are going, up and down very, like, constantly. And there's a lot of volatility in my balance sheet and my P&L currently. What do I do? I'll continue because that is the risk that I can take. I can continue my operations that I've decided to accept or take. No, not I can take. I've decided to accept or take. Diversify, spread exposures to reduce the risk impact of any one risk. Holding a broad portfolio of unrelated assets. Diversify. I hope you guys understand this. Transfer, shift the risk to another party. Insurance, derivatives. I have a currency risk. Enter into forward contract on the basis of currency. Life risk, buy life insurance. Fire risk, buy fire insurance. Shift, similar to transfer, involves using contracts or third parties to absorb the risk. It is more or less the same, right? In transfer is more formal, this is more informal, right? So this can be derivatives that are exchange traded. This can be derivatives that are more counterparty, that is more over the counter. Point is that it's more informal, this is more formal, nothing else. Self-insurance refers to decision to retain and bear the risk internally. That is what self-insurance is, right? Internally, you are deciding to bear the risk. That is what self-insurance is. You're not going out there and buying insurance. You decided that you're going to retain and you're going to bear that risk. It can be intentional or it can be result of inaction. अरे मेरे को पता ही नहीं था कि ये रिस्क है भी और मुझे इसमें एक्शन लेना भी था. It can be that also. It can be intentional. अरे I know this is what it is, but I have decided to self-insure. How do you protect yourself from, tomorrow you said that I want to self-insure. What do? You just sit idly that I've decided to self-insure, I'll take the risk. Arey, make some reserve fund so that tomorrow if certain losses happens because of this, you can make up for those losses. Right? That is what this is. What are some additional risk management tools? What other things you can do? Get a surety bond, where it's a contract with an insurance company which agrees to make a payment where third party fails to fulfill the obligation. Example, CDS, credit default swap, guys. Enter into a swap with a dealer. Ultimately, tomorrow, what will happen? Tomorrow, if that particular bond on which the credit default swap is based, there's a default in that bond, uh, you get the payment. Protects the firms from causes by non-performance of third parties. Right. Common in industries is project delays or supplier dependencies. A lot of times in a lot of industries where there is supplier dependency, you depend a lot on the supplier, and if it doesn't perform, you're screwed. Or where there are a lot of project delays, what do? You get a third party in between, and you sort of get a surety bond from the third party. Fidelity bond, guys. Fidelity bond is what? You know, you sort of have a fidelity bond. It's sort of an insurance which is going to be, which is going to protect you from any employee theft, fraud, or misconduct. Tomorrow, an employee did a misconduct and it led to a big case on your organization. Fidelity bond will protect you from that. It helps build trust in internal operations, right? Because tomorrow you have a fidelity bond, any investor will be very relaxed. Why? Because you have a fidelity bond, he will say that his internal operations, even if tomorrow something happens, his employee commits a fraud, theft, misconduct, I'm okay. Why? Because he will be compensated for the loss of it. Often used for financial services and sensitive industries, right? Where there's sensitive and there's financial services, it is used because money management requires a lot of trust, right? Risk shifting, guys. What is risk shifting? Involves changing the distribution of possible outcomes, typically using derivative contracts, right? So whatever the distribution is, you sort of, whatever the possible outcome is, essentially you transfer it. Forward contract, futures contract, options, swaps, whatever that may be, right? So whatever like forward contract you have entered, because you sort of think that if you entered a long forward contract position example, you sort of think that the asset is going to become expensive and you want to buy this in the future. So why not enter into a long forward contract right now? That is ultimately what? That is ultimately you locking in a particular price. That is changing the distribution of the possible outcome. Tomorrow, if you would not have entered into this and directly bought the asset, you would have bought it at an expensive price. So you are changing how the possible outcome would look like, right? And these are the few examples: buying a put option, selling call options, and stuff like that. Simple, straightforward. But guys, it is very important that tomorrow, if you decide to modify the risk, basically buy insurance, do all of that, it is very important that your decision has to be based on a few criteria. First, cost benefit. अरे कॉस्ट लग रहा है इंश्योरेंस का बट बेनिफिट मिल रहा है क्या उतना? Compare the cost of mitigation with the potential benefit. Whatever is the cost that is related with respect to that mitigation, compare with the benefit that you're getting out of that. Diversification, spread exposure when possible and economical. Very important. जब पॉसिबल है, जब इकोनॉमिकल है तभी करो. उसके पहले कैसे करोगे? यूज ऑफ इंश्योरेंस, ट्रांसफर रिस्क व्हेन इट इज इंश्योरेबल एंड अफोर्डेबल. अगर वो रिस्क ही इंश्योरेबल नहीं है, उसके प्रीमियम्स ही बहुत हाई है, देन हाउ आर यू गोइंग टू यूज द इंश्योरेंस? यूज ऑफ डेरिवेटिव्स, मॉडिफाई रिस्क डिस्ट्रीब्यूशन वेरेवर नेसेसरी. Only wherever necessary, not everywhere. I'm getting into derivatives unnecessarily. Yeah. For example, I'm TCS. I'm going to get money in the future with respect to in the dollar form, and the risk that I have currently is that what if rupee appreciate? Arey, but next 6 months doesn't look like rupee appreciating at all. There's no scenario for it. There's no necessary. It is not necessary that I enter into this derivative. Of course, I have to be very sure that that is going to happen. There has to be a higher probability of it. But that's what I'm trying to make you guys understand. And self-insurance, yeah, accept the risks. If other methods are not practical, the cost that is required to ensure this risk, the benefit that it is going to give is very less than as opposed to when you compare it with cost. Self-insure. What is the goal? The goal is ultimately, I mean, risk tolerance. Let me just finish this point first. Risk tolerance of the organization established by the management ultimately drives the choice of the method. What is your risk tolerance? What is, that is established by the organization will drive the kind of, method that you're going to choose. Whether you want to go for derivatives, self-insurance, whatever that may be, depends. The goal is ultimately to match what risk modification strategy, whatever your strategy is, whether you decide to self-insure, whether you decide to get into derivatives, get an insurance, whatever that may be, will ultimately be defined by risk tolerance, of course. But you have to make sure that you match whatever your risk modification is with the nature of the risk, the cost, and the return objectives. This is very important. That you do this, okay, this is fine. That your risk tolerance defines this, but it is very important that whatever you decide as a modification strategy is in tandem, is what do you call, matches all of these three factors. Otherwise, what's the point? And that wraps up our reading risk management completely. I hope you guys have understood everything in the chat box. Yes or no, quickly tell me. We will move on to our last reading for today, which is portfolio risk and return part 1. Wait, there's a doubt. Hold on. Yes, Nikhil, what is the doubt? Sir, in shifting you said that it is over the counter, but in book it is written shifting is done with both forward and future. यार उसका मतलब मेरे हिसाब से वो है ऑनेस्टली दैट्स व्हाई आई टोल्ड यू गाइस दैट इज द सेम दैट्स द ओनली डिफरेंस कौन गया where was that part I don't remember now hold on hmm. So you are saying that in book it is saying that shifting is done with both forward and futures. That's what I'm saying that I think that it is OTC because that is how you sort of make a demarcation and not because of that I think conceptually also something that's debatable. I feel that you follow what I've said. For some reference saying var is what? A maximum loss. No, var is not a maximum loss. All right. Okay, guys, let's proceed and let's go to the main reading, which is portfolio risk and return part number one. All right. Initially, if you see of that reading, there's an LOS which talks about, risk and return trade-off. That more risk you take, more return you sort of get, right? It sort of shows that there's a positive relationship between risk and return. Higher the risk you take, higher the return you get, right? Uh, so basically, you would have seen historically that asset classes that have offered higher average returns have sort of, higher volatility and higher standard deviation as well. So if you can clearly see, if you take out small cap stocks, they have the maximum return, but they have the most amount of volatility as well. Volatility is measured by standard deviation, right? So observation is small cap stock has the highest return and risk. T-bills have the lowest return and risk. Global relevance, similar pattern are observed globally. High return asset classes have a higher greater volatility as well. Like other places also you can see this was an example of US. Other places also you can see the same pattern is observed. Right. So risk return trade-off is a universal principle. What do you mean by risk return trade-off? Higher the risk, higher the return. Right. That is what this is trying to sort of identify. Nominal return minus inflation is going to be what your real return. So real return is 10%, inflation is 6%, real return that you earn is 4%. Anything above inflation that you earn is real return. Right. Real return based on inflation levels, of course. T-bill return 3.4%, inflation 2.5, 0.5 real return. Large cap stock return 10.2, inflation 2.9, real return 7.3. Anything above inflation is your real return. Right. What are non-normal distribution? The returns that the asset does not follow perfect bell curve. Negative skew tendency for more extreme downside than upside. A data that is negatively skewed, obviously there is going to be more downside than upside. Right? Positive excess kurtosis, there is going to be a fatter tail, right? We have understood and we have discussed this, then the normal distribution. It is very important to understand that the mean variance analysis in an oversimplification in case of non-normal distribution. What is non-normal distribution and what is mean variance analysis? First, let me define non-normal distribution, what we just discussed. Negatively skewed data, positive kurtosis, etc., etc. For this type of data, you should not use mean variance analysis. What is that? Mean variance analysis is standard deviation. Standard deviation is not an appropriate metric to calculate the risk of these type of distribution. It will always, in most of the cases, not always, always is not the right way to put it. In most of the cases, it will try to underestimate the return. So in the real world, when you're trying to estimate the risk, you should make sure that you consider the skewness, you also consider the kurtosis. And it is very important to understand that diversification helps to balance the risk and achieve the desired return objectives. Right? Diversification is important. And also, whenever you're investing in any asset class, liquidity is also very important. We understand what liquidity is. And you've seen that emerging market stocks, an economy where the stock markets are not that popular, uh, you would see that the trading volume is very low. Market depth is very low. Bid ask spreads are very wide. That ultimately makes the securities very less liquid. Right? If something is liquid, is not liquid, the is not very liquid, obviously bid ask spread is going to be very high. What is bid ask spread? Bid ask spread is something that you buy up, let's say for example, bid ask spread is 40, 43. So dealer will buy the security at 40 and sell the security at 43. So 3 rupees is his profit. Now, if the security is not very liquid, it is very less liquid, it is very difficult for him to source. Obviously, he will charge more margin in that. So that case, he will be buying that particular asset at 35 and probably selling it at 43 rupees 8 is what his margin is. Why? The margin is more because the security is not that liquid. And you would have seen this a lot in emerging markets. Right. Sir, we understood what risk aversion is. Risk aversion is basically somebody who doesn't like to take risk. Right. And even if he's taking more risk, he would want to be compensated by more return. So risk averse investor is somebody who prefers lesser risk, right? When the expected returns are equal. So if I'm taking 10% risk and my return is 8%, and here I am taking my return is equal, but I'm taking more risk, that is 12%, a risk averse investor will always prefer this. Right. When the expected returns are equal, he will obviously go for lesser risk because he's risk averse, he doesn't like risk. And in modern portfolio theory, you would have seen that standard deviation is used to measure the risk. Whatever financial model you take, CAPM, mean variance optimization, which we're going to study, all of this assume that the investor is risk averse. So whatever theory you're going to study apart from this, away, whatever we're going to discuss now for the next half an hour, we have to assume that the investor is what? Risk averse investor. Is what? A risk averse investor. A person who dislike risks. But of course, he's just not the one type of investor. There are different types of investor. One is risk averse, who doesn't like the risk, which we were just discussing. There is risk neutral, who is indifferent to risk, and risk seeking, who prefers risk. So, a person who's risk seeking would choose what? Would choose this. Would say that, okay, I'm going to get same amount of returns. I will always prefer more risk because he likes to take risk. He doesn't want to be compensated by more risk, sorry, by more return for taking extra risk. He's okay with taking that extra risk because he likes to take risk. Risk averse investor dislikes risks. Risk neutral would be indifferent. He would say that either out of one or two, I'm okay with anything, I'm indifferent to them. All right. Let us take an example of a coin flip game. Heads, you win $100. Tail, you win zero. Expected payoff is 50. Sir, we understand. Risk averse investor will always prefer the guaranteed 50 rather than playing the game. Meaning, if you flip the coin, this happens. So you're given an option. This is option number one, and the other option is take a guaranteed 50. What? There are two options in front of you. Let us give, actually, I need to do not structure the example well for you. Hold on, let me just sort of put this way. This is option number one, where the payoff is 50. Option number two, take a guaranteed 50. Obviously, the risk averse investor will prefer this. At the end of the day, the outcome of both of them is the same, but the way things are structured will impact the outcome, will impact the choice that an investor makes. A risk averse investor prefer this. Risk seeking investor would want to go for gamble. Risk neutral, indifferent. Right. Imagine you're offered two job contracts. Job A, tech startup. Expected annual salary 80,000. Volatility high because it's a startup, the risk is very high. You might have a job, not have a job, might get that same salary, might not get that same salary, might get a raise, might not get a raise. But the other one is government job, which is a secure job, low job, stable job, where the salary is the same. What would you prefer? As a risk averse investor, obviously I'll prefer job number two, where there is more stability. As a risk neutral, I would say I'm indifferent. As a risk seeking investor, I would obviously go for job A because what? There is more upside potential that is there because risk is high. That is what the difference in all three of them is. Right? But anyway, whatever we are going to study from now on, assumes that you are a risk averse investor. Right? For example, when comparing two portfolios where the return is equal, a risk averse investor will always choose the one with lower volatility. We have sort of understood this. If a portfolio has higher expected return but also has a higher risk, right? The risk averse investor will only invest in that portfolio if extra return is justified about if extra risk is justified by the extra return, right? So there's a portfolio, another portfolio with a higher risk. But if higher risk is compensated by appropriate amount of return, risk averse investor would not have a problem. He would say, okay, you're giving me more risk. Okay, that's fine. I'm willing to take that risk if you give me appropriate return. And what do you mean by utility theory? Risk averse investor will always derive lesser satisfaction from gains that discomfort, from the gains than the discomfort from losses. We understood this in loss aversion bias. Portfolio A, expected return 8%, standard deviation 6, portfolio B 8, 12. Obviously, risk averse investor will choose portfolio A, and we have gone over this example. If there's another portfolio B, where the expected return is 11%, risk averse investor might consider only if the additional return of 3% is worth the risk that is increased because of additional return in portfolio B. Right? That is what this is. Guys, so far with me, is everyone following or is the pace too fast for you guys? Is everyone with me so far? Come on, guys, everyone. There are 26 people. Quickly. Sare, aa jao. Last half an hour, guys, to go. All right, guys. Let's get started. Let us understand what do you mean by standard deviation. What is standard deviation? It talks about variability of data from mean, right? How do you find out standard deviation? Sir, from variance. So let's say, for example, I take a data of 5 observations. Those observations are 4, 8, 6, 5, 7. What is the mean of that observation? Sir, sum total of all the observation divided by the number of observation, 30 divided by 5 is equal to 6. Right? Sir, what is the variance of that observation? Sir, the variance of that observation is going to be standard deviation x minus x bar the whole square, the whole divided by n minus 1. You see how far every organization is, sorry, not every organization, every value, every data point is from the mean. How far 4 is from the mean? How far 8 is from the mean? 6, 5, 7. Take the square of it. Add all of them. 4 plus 4, 8 plus 0 plus 1 plus 1, that comes to 10. Divide it by n minus 1, which is 4, comes to 2.5. This is going to be your variance. How much your data varies from the mean. What is standard deviation? Square root of variance. Standard deviation is standardizing the variance. Is standardizing the variance. So the moment you standardize this variance, you get 1.58, which is the square root of 2.5. Right. And obviously, whenever you are studying data, you would never study the entire population. You always study the sample from the population. And because you're studying the sample, you do n minus 1. But if you were studying if you were calculating mean and standard deviation and variance for the entire population, you would have taken n and not n minus 1. You do minus 1 only for sample because always you study a sample. and not a population. Now, sir, okay, we understand this, but we are studying CFA, we are talking about equity markets, we are talking about different types of securities. In our case, how is standard deviation found then? You take historical data of returns. Let's say over the last 10 year, every year, 1 year return was 5, then 6, then 7, then 8, then 10, etc. etc. You take their average. Then you find out what standard deviation of that. But I hope you guys are understanding what is the relevance of this and what are we trying to find out. Okay, sir. Fair enough. Sir, what is covariance and correlation? Covariance is relationship between two datas. There's data X. There's data of security X and there's data of security Y. You are trying to find out what is the relation between them. How do you do that? You find out something which is called as covariance and ultimately correlation. First, calculate the mean of each data set. Of X, you calculate the mean. Of Y, you calculate the mean. Okay, sir, fair enough. That's what you do. So X, this is your data. Y, this is your data. You find out the how far the data X is from its mean, how far the data Y is from its mean. You multiply X minus X bar into Y minus Y bar. And then you take total X minus X bar into Y minus Y bar. So basically total of this, which is 36, right? And you try to find out something which is called as covariance. The formula for covariance between two securities is equal to summation X minus X bar into Y minus Y bar, the whole divided by N minus 1. Guys, remember, covariance. What is variance? What was the formula for variance? Summation X minus X bar the whole square. What is covariance between two securities? You multiply here. How far X is from its mean? How far Y is from its mean? Multiply both of them. Here it was square. Here it is multiplication. At the end of the day, this is 1, this is 1. Ultimately, you are multiplying, so it is 2 only. Divided by N minus 1. So that is what the formula looks like. Covariance. Covariance is 9. Now you want to standardize this covariance. What do you want to do, guys? Standardize this covariance. How do you standardize covariance, guys? You find out correlation. What is the formula for correlation? It is covariance between X and Y divided by standard deviation of X into standard deviation of Y. Good luck. Good luck. Sorry, guys. Good thing is that we have already found out the standard deviation of X minus X bar, basically standard deviation of X and standard deviation of Y, right? We have already laid down the foundation for it and we have found that out. So it is X minus X bar is this is what it is. Then you can find out standard deviation via this and you're up. And then you can use this entire thing to find out correlation, which is covariance X comma Y divided by standard deviation of X into standard deviation of Y. Sorry for I sort of lost the tune in the middle for a minute, but हाँ. तो सर क्या एक बार वापस बता दो ना सर. कोवेरियंस इज व्हाट रिलेशनशिप बिटवीन टू डेटा सेट्स. ऑलराइट नाउ okay sir, we are trying to find out relationship between two data sets. Okay sir, what is the formula for a standard deviation X minus X bar into Y minus Y bar divided by N minus 1? That is what the formula is. Okay sir, for that we need X bar, for that we need Y bar, for that we need to find out X minus X bar, Y minus Y bar, multiply both of them. Okay sir, done. Sir, I want to standardize this covariance. What do I do? Find out correlation. What is the formula for correlation, sir? It is covariance X comma Y divided by standard deviation of X, standard deviation of Y. How do I find out standard deviation of X and Y, sir? I have to find out variance of X and variance of Y. How do I find out variance of X and variance of Y? Variance of X is X minus X bar the whole square divided by N minus 1. Good thing we already have laid down the foundation for it right here. X minus X bar done, Y minus Y bar done. All of that calculated. Right. Okay, sir. How do I interpret covariance? How do I not correlation? Interpret covariance. If it is positive, that means they are moving in the same direction. That means their relationship is positive. That means they are moving in the same direction. If covariance is positive, relationship is positive, moving in the same direction. Sir, negative, moving in the opposite direction. One going up, other one going down. Sir, zero, there is no relationship at all. That means one of the securities, let's say security X, if it moves, it doesn't have any impact on Y. Y, if it moves, doesn't have any impact on X. Right. The magnitude of covariance obviously depends upon the magnitude of individual stocks standard deviation and the relationship between their co-movements. So if the cove movements, the relationship between that is strong, covariance is high. Covariance is absolute measure and measured in return units squared. We've just calculated that. Covariance of two securities can be standardized by dividing the product of the standard deviation of the two securities. That is correlation. That's what I was talking about. All right. Now, sir, correlation, sir. Okay, sir, correlation to be calculated, which is covariance x comma y divided by standard deviation x into standard deviation of y. That is what correlation is. Sir, how do you interpret correlation? Correlation is usually within the range of -1 to 1. If it is +1, then it is perfect positive correlation. That means if x goes up by 1%, y will also go up by 1% because it is a perfect positive correlation. If stock A goes up by 2%, stock B will also will go up by 2% because of perfect positive correlation. Perfect negative correlation, that means if stock A rises by 1, stock B will fall by 1. So that is exact opposite movements. And no linear relationship is what? Or no linear correlation is what? Uh, Basically, if your correlation is 0, that means the movement of one doesn't have any impact on the other one. So if stock A goes up by 5, stock B probably might stay flat, might go up, might go down. There is no pattern. You can't predict it. Right? And that is what your correlation is. Okay, sir, we get that as well. Sir, let's say for example, we understood how do you find out the standard deviation of a security X? How do you find out the variance of security X? Okay, sir, but what if I make a portfolio? What if I make a portfolio of security X and Y? Can I find out the standard deviation of that portfolio? Yes, I can. For that, I will need the variance of the portfolio, and that is given by this formula. And remember, from a CFA level 1 perspective, only thing that is relevant to you is a two asset portfolio. There is nothing more than two asset for you that is relevant right now. So if it's a three asset, four asset, five asset, doesn't matter. It is not a part of your syllabus. Obviously, it will lead to more diversification. That's a different thing. But the point is that it is not relevant to you right now. So only thing, two asset portfolio. How do you find out the portfolio standard deviation? First, you find out the variance. And what is the variance? How does variance calculated? Weight of security 1 into variance of security 1. Sorry. Into variance of security 1 plus weight of security 2 into variance of security 2 plus 2 into weight of 1, weight of 2, covariance between 1 and 2. This is a formula for variance. The moment I put a square root on this will become what? Standard deviation. Can I expand the formula, guys? 100%, sir. How come? I know this, that the formula for correlation is what? Sir, it is covariance between x and y, or in our case 1 and 2, divided by standard deviation of 1 into standard deviation of 2. And covariance between 1 and 2 is equal to, if I take this here, it is correlation between 1 and 2 into what? Standard deviation of 1, standard deviation of 2. So can I expand this? Yes, sir. I can write this covariance 1 and 2 as what? Correlation between 1 and 2 into standard deviation of 1, standard deviation of 2. Right? And that is what these people are trying to expand on. Right? And I think this is all continuation of the same. Okay. Guys, I have a too risky asset portfolio. That is what my portfolio is, right? That is what my portfolio is, a two asset portfolio. Okay, sir, it is a two asset portfolio. You know what? If the correlation between security 1 and 2, you do have to learn the formulas. You have to learn the formulas. It's a simple formulas है यार, 5-6 तो formulas है. Why do you not want to learn those formulas? Simple है यार. Two asset portfolio guys. Correlation between one and two. Two asset portfolio guys. Correlation between one and two. If it is one that is perfectly positive, then you know what? The standard deviation of portfolio is simply weight of security 1 into standard deviation of security 1 plus weight of security 2 into standard deviation of security 2. सर ये कैसे आया? उसी को सिंप्लीफाई करके आया. वी विल टेक एन एग्जांपल, वी विल ट्राई टू कैलकुलेट दिस. आपको समझ में आएगा कि यही होता है. बट रिमेंबर दिस इज अ स्पेशल केस. Right? For example, if 25% is invested in asset A, 75% in asset 2, and the portfolio, what do you call, the correlation between the securities in the portfolio is positive 1, then your standard deviation of portfolio is simply the weighted average, which is 25% of asset 1 plus 75% of asset 2. So what is asset 1, asset 2? Standard deviation, right? Obviously. I hope you guys, चलो लिख ही देता हूँ यहाँ पे. All right. Guys, one more thing. Sir, ideally, we want to find out portfolio standard deviation. Okay. Sir, why this whole formula? Why shouldn't it simply be weighted average? Like in case of positive correlation, perfect positive correlation, it was simply weighted average. Why not that? अरे diversification benefit का क्या? You ignore diversification if you direct diversification benefit, it will directly take the weighted average, right? हाँ, except for positive, perfect positive, उसमें direct weighted average है, but when you simplify the formula completely आप यही पहुंचोगे. सर तो वो जो फॉर्मूला है ना ऊपर जो मैंने देखा, if the correlation is perfectly positive, which is +1, ये फॉर्मूला अल्टीमेटली इसी में आके ये हो जाएगा, सिंप्लीफाई हो जाएगा. ऑलराइट. And obviously, if a perfectly positive I think, wait, hold on. This insight I want to hold on for a minute. I want to hold on this insight for a minute, guys. All right, I want to take an example with you guys. I'm constructing a portfolio with two risky assets. Asset number A has this particular variance, hence standard deviation is 20%. Asset B has this variance, and hence standard deviation is 10%. You have made a equal weighted portfolio. That means 50% is allocated here, 50% is allocated here. Right, guys? What I want from you guys is you guys have to tell me the variance and ultimately standard deviation of what? Of the portfolio. If the correlation is perfectly positive, that is 1. It is positive, but not exactly 1. Basically, it is 0.5, it is 0, it is minus 0.5. In all four scenarios, what I want you guys to tell me quickly is what exactly the variance would be and what exactly the standard deviation would be. In fact, for that matter, chuck variance, I only want to know standard deviation. I don't even want to know variance. It's fine. Don't tell me the variance. Just tell me what the standard deviation should be quickly in the chat box. I'm getting an answer. First one is 15%. Come on, guys, quickly. I'm waiting, guys. I hope you guys are calculating. I'm not using the calculator. Guys, why is it that only Sanjay has answered? Come on, guys. 5 घंटे का एग्जाम देना है. So we have to be very attentive throughout. Come on. Anyway, you can clearly see that as the correlation goes from positive to negative, the risk of the portfolio keeps on declining. You can clearly see when it was perfectly positive, it was the most risky portfolio. The moment correlation declined, it went to 1.75. So the correlation, the moment it went to zero, it went to 1.25. That's even lower. And the moment it went to negative, it became actually 0.75. So what does that say? What does that tell us, guys? That the highest portfolio risk occurs when the correlation between the two securities in the portfolio is perfectly positive. If it is less than perfectly positive, that it is zero point 0.5, the portfolio risk reduces. If risk reduces, variance reduces. If it is zero, then it is ultimately the risk will reduce further, excuse me. And if it is less than zero, it goes to negative, then your standard deviation becomes negative. Right. That means lower the correlation between between assets, greater the diversification benefit or risk reduction benefit. Right. And if the assets were perfectly negatively correlated, the portfolio risk can be eliminated altogether for a specific set of weights. Basically, if they are perfectly negatively correlated, matlab The correlation is -1. So there exists a weight that I can put in asset number one and asset number two. For that weight, for that specific weight of asset number one and two, risk of portfolio will be zero. Obviously, that is not known to us. We'll have to do a back calculation, but what I'm trying to make you guys understand that portfolio, there's a particular weight where particular, where your portfolio weight is going to be, where your portfolio risk is going to be zero. My bad. So there exists a particular weight which you can allocate to one and two. If your correlation is perfectly negative, you will have a zero standard deviation of the portfolio. All right. And it is highlighted by this particular diagram as well. On y-axis, if you mark the expected return of the portfolio, and here if you mark the standard deviation of the portfolio. This is the point where you're 100% invested in asset B. This is the point where you're invested 100% in asset A. And we are discussing a two asset portfolio, if you guys remember correctly. Right. At this point, you're 100% at B. At this point, you're 100% at B. 100% in A. Guys, one more thing. The standard deviation that I took was relying on Sanjay's answer. I don't know if it is wrong or right. I have relied on those because none of you guys answered. But the point is that here you're 100% invested in asset B. Here you're 100% invested in asset A. Right? Along this line, let's say for example, I'm at this line. So at this line, I'm 80% invested in asset A and 20% invested in asset B. At this line, again, I'm 80% invested in asset B and 20% invested in asset A. So this line represents various weights. What? Various weights that I have assigned to asset A or B. Right. But one thing is very clear to us, sir, that at this point, let's say, for example, this point represents 80% of asset B and 20% of asset A. It is very clear that as the correlation declines, currently, what is the risk of this portfolio, sir? This is what the risk is, and this is what the expected return is. I hope you guys understand expected return will always remain constant. The expected return of asset B is, let's say, 10%. Of asset A is going to be what? Sir, it is, let's say, it is um, what do you call 8%. So, sir, overall, sir, what is the expected return on the portfolio? Simply weighted average. So 80% into 10 is 8%. 20% into 8 is 0.8, 0.8, 1.6. So overall return comes to 9.6%. Overall return comes to what? 9.6%. So expected return is going to be the same, irrespective of the correlation. तो सर again to repeat, sir, एक बार समझा दो सर, बहुत सारी चीजें आपने एक साथ बोल दी, वापस समझा दो सर. You said a lot of things. Let us quickly go back to what we were discussing right from the start. Guys, this point represents 100% in asset B. This point represents 100% in asset A. X-axis represents standard deviation of that portfolio. Y-axis represents expected return of that portfolio. Right, guys? This is the point example represents 80% in asset B, 20% in asset A. Right? Expected return on the portfolio will be calculated as simply the weighted average. So if the expected return is 10%, expected return is 8%, overall portfolio return is simply going to be the weighted average, that is 9.6%. So we are standing somewhere around this, which is 9.6%. And expected return remains the same irrespective of correlation between securities. If the correlation security between securities +1, if is plus 0.5, it is 0, it is minus 0.5, it can be anything. The expected return is going to be the same. But what changes? Sir, risk changes. As the correlation goes from +1 to 0.5, you can clearly see earlier your risk was here. Now your risk will reduce. The risk has reduced. And we have already seen that. As the correlation declines, the risk reduces. Again, if it goes from 0.5 to 0, the risk further reduces. The risk what? Further reduces. As it goes from 0.5 to minus 0.5, the risk further reduces, guys. Oh, why it's automatically taking shapes? I need to turn that off. Anyway, yeah. So the risk further reduces. But expected return remains the same, guys. Right? So this line represents various points of different weights. Right? This might be 50% of A, 50% of B. At that point, this is what the risk is for positive one correlation, for negative for positive zero point 0.5, for negative for 0, for negative 0.5. That is what it is. But the return remains constant. अब वो exactly सीधा नहीं आ रहा है, थोड़ा सा प्रॉब्लम है मेरी इसमें, but हाँ, I hope you guys are able to understand this. And there is exist a weight. What did I tell you guys? There exists a weight. What weight? At that weight, sir, the risk is zero for perfectly negative correlation. For what? Perfectly negative correlation. Here the correlation is perfectly negative, and here the risk is zero. You can clearly see it is zero. This is that weight. So that weight is this. Now, this is not what point it is exactly in terms of weight. That is not relevant to you guys. I'm just trying to tell you guys that this is the case. Right. So that is how your risk is reduced as the correlation goes from positive to negative. Right. Guys, is everyone with me so far? I am not sure if I have told you guys the right values with respect to the standard deviation. Whatever was answered, I sort of took that. But I hope you guys understood the point. Even if it's wrong, the risk was anyway going to be reduced. Now let's go to the next part, which is your efficient frontier and minimum variance frontier. Nice. I'm getting a yes. Okay. All right, guys. Let's go to the next topic, which is efficient frontier and minimum variance frontier. Sir, what is that? First, let us understand this one thing. First, let us understand this one thing, that what are we trying to do here? We are trying to first plot all the different portfolio combinations, basically universe that is there with respect to investment portfolios. So again, on I take standard deviation and I plot different combinations of portfolios that are possible. Just hold on for a second, guys. Yes, guys, sorry. Yeah. So I plot multiple portfolio options that are available, right? So these are other options that have been pointed out. Now you will see I'm able to make a line right here, which has been actually given, but this is actually, let me just do one thing. Let me just plot different portfolio combinations that are possible. This is what my expected return is on the portfolio, and this is the standard deviation of the portfolio. Now you would notice that I can make a curve with respect to this entire universe of investment portfolio that is available. Okay, sir. Sir, the curve represents some portfolios that are there, but what is the speciality of the portfolios that are on the curve? What is the speciality of portfolios on that curve? They are minimum variance portfolios for a given level of return. Let's say, for example, I talk about this level of return. This is the level of return, right? This is the level of return. For this level of return, this is the standard deviation that is there. You know what? For the same level of return, there exists another portfolio with the least amount of risk. And that portfolio lies on this curve that I have just made. Let's say I talk about this level of return. This is the level of risk that I have to take for that. You know what? There's an exact similar expected return portfolio that is available with lesser amount of risk. Again, that portfolio lies on my curve. So again, sir, if I talk about this level of return, if I talk about this level of return, sir, there exists a portfolio on this frontier, which is going to give me the exact same level of return with lesser amount of risk, as you can clearly. I guess I lost network in the middle. I hope I'm back and you guys can hear me and see. Quickly, guys, tell me yes or no. Okay, perfect. So what have I done? I have made a list of portfolios. I have, dotted, I mean, I have sort of, okay. Yeah, perfect, perfect. So I have sort of what I have sort of pointed down. I have sort of, plotted different portfolios, possibilities that are there. Basically, I've plotted a universe of portfolios. Okay, sir. For okay. Uh, uh, so there exist certain portfolios allocated, all right, fine. But there's another part of this curve we have not yet. Sir, if I talk about this level of risk, okay, fair enough. This is there on minimum variance frontier, which is giving me this level of return. Okay, sir, fair enough. But there exists another portfolio on the same frontier with the same amount of risk, but gives me more return. Oh, sir, if I talk about this portfolio, which is on minimum variance frontier, which I have to take this amount of risk, for which I have to take this amount of risk. Okay, sir, fair enough. There exists another portfolio on the same minimum variance, gives me more return. Similarly, sir, this is a portfolio that I am taking this amount of risk, which exists in minimum variance frontier. okay, sir, there exists a portfolio on the minimum variance frontier which gives me more return for the same amount of risk. That means, sir, the upper part of the minimum variance frontier, the upper part of minimum variance frontier, is they are giving me more return. For same level of risk, they are giving me more return. All right, voice is lagging. Okay, hold on. Don't worry. I hope now there should not be any problem. I'll continue now. Just quickly tell me if there's any problem or not in the chat box. Okay. All right, guys. So what were we doing? Guys, we were trying to understand the concept which is called as efficient frontier and minimum variance frontier. Right? Fine. Perfect. It is fine now. All right. So now we plotted multiple universe of portfolios that are possible. Okay. Sir, for every level of return, there existed a portfolio that was giving the same return but at a lesser risk. Okay, sir, fair enough. When I plotted all of those portfolios, I got a C-shaped curved, and that C-shaped curve is called as minimum variance frontier. Okay, sir, fair enough. We get that as well. That's good. Okay. But you know what? On minimum variance frontier also, sir, the upper part of that are basically consist of portfolios that are better than the lower part of that. Sir, how come? If you see, for this level of risk, I have a portfolio on efficient frontier on the lower side, which is giving me this return. For that same level of risk, there's a portfolio on the upper side giving me more return. That means this part of the curve represents efficient frontier consisting of efficient portfolios. You take another example, this portfolio, taking this level of risk, you're getting this level of return. For that same level of return, you can have a portfolio on upper part of the curve, which is giving you more return. Exactly like that. And this portfolio, this is the level of risk that you take for this level of return. On the upper part of the portfolio, you have, sorry, upper part of the curve, you have a portfolio that gives you what? That gives you more return. And when you combine all of these portfolios, which are on the upper side of the curve, these portfolios, the black part is called as efficient frontier portfolios, and this entire bit is called as efficient frontier, right? And that is what your efficient frontier is. So that is this is the theory. This is what efficient frontier is. Now the only part that is left discussing with respect to this is global minimum variance portfolio. What is that? On the entire curve, there exists a point. This is the point where you will have, where you will have, this is that point, guys. This is that point where for this level of risk, there is just one portfolio. There is no portfolio on the upper. There is no portfolio. No, no. There's just one portfolio. Now, obviously, with curve, it is very difficult to represent, but I hope you guys understand that portfolio is called as global minimum variance portfolio, the portfolio that has least amount of standard deviation or variance. For this level of risk, there exists only one portfolio right here, and that portfolio is called as global minimum variance portfolio, the one that consists of least amount of risk, that is the lowest standard deviation. It is the starting point of efficient frontier. From here, efficient frontier starts. Beyond this, efficient frontier exists. Beyond this, the inefficient part of what? Of the minimum variance frontier exists. Right. An efficient frontier is the upper portion of the minimum variance frontier that we have already discussed. Right? And that completely summarizes our discussion on efficient frontier and minimum variance frontier. Are you guys with me so far? I hope audio and video is better now. Perfect. All right, guys, let's move forward. Let's move forward and let's talk about a concept which is called as indifference curve. Again, we plot expected return on what? On y-axis, and standard deviation on what? On x-axis. And we draw three curves. These are called as indifference curves. These are called as what? Indifference curves. What do you mean by indifference curves? And what are indifference curves? These are the curves on which the utility of an investor is the same. So on indifference curve 1, whatever point you pick out, the utility of the investor is going to be the same. He's going to have same utility here, 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 same utility here. The point being that along the indifference curve, his utility is going to remain the same. So on indifference curve 1, his utility is going to be the same. कोई भी point उठा लो same होगी. Indifference curve 2, कोई भी point उठा लो same होगी. Indifference curve 3, कोई भी point उठा लो same होगी. What do you mean by utility, sir? Utility is the amount of happiness an investor derives. So utility functions represents investor preferences when it comes to risk and return. It represents the level of risk aversion. Indifference curve is used to plot the combination of expected risk and return that investor views as equally desirable. So here his utility is going to be the same along the entire indifference curve 1. And portfolios are obviously defined only by their expected return and standard deviation. Right? The portfolios what are the criteria that you are using? Let's say, for example, this is a portfolio. This is on indifference curve 1. This is one of the portfolios. For this is the expected return. This is the standard deviation. Obviously, that is how you're defining it. You're assuming that there are only two characteristics, which is standard deviation and what? And the expected return that is defining the portfolio. That is what it is. Simple, straightforward assumption. Right. All the points on a single indifference curve, let's say, for example, indifference curve 1 will have same utility to the investor. And higher the indifference curve, higher the utility. That means indifference curve 1 has more utility than indifference curve 2 has more utility than indifference curve 3. Right? Here the utility is more, here the utility is more than utility on indifference curve 2, more utility than 2, more utility than 3. Right. All right, sir. That means most preferred is indifference curve 1 because your utility is maximum. Less preferred is indifference curve 2, less than 1 because you have lesser utility here, and least preferred is 3 amongst all three. Sir, how do you calculate the utility? Sir, we understand that in difference curve 1, our utility is going to be more, 2 it is than 2, 2 it is going to be more than 3. Okay, sir, but how do you calculate this utility? And it is also very important. Remember, along the entire indifference curve, my utility is going to be the same. How do you calculate this utility? It is calculated by expected return minus half into what? The risk aversion coefficient into variance. So A is the risk aversion coefficient. Sir, what is risk aversion coefficient? Measures my risk aversion. There are three types of investor: risk averse, risk neutral, and risk seeking. Higher the risk aversion, higher will be A, which measures that. And utility is happiness. I hope you guys understand. If I'm trying to find out utility, which is given by this equation, if expected return is high, utility will be high because expected return here is the part of my utility equation. Right? If risk is high, then utility will come down, right? If risk is high, utility will come down. How come, sir? If risk is high, variance will be high. If variance will be high, you're subtracting variance, your overall utility number will be low because you're subtracting variance. If risk aversion is high, utility will come down. Obviously, sir. If risk aversion is high, which is A, measured by A, if A goes up, your equation here, you're subtracting it, so that will also that will go down, which is your utility will go down, right? So if risk aversion is high because you're subtracting it to calculate utility, it will go down. If variance is high because you're you're subtracting it in the equation, your utility will go down. Expected return high, it is ultimately being added in the equation. Sir, the utility will go up if expected return is high. And you always calculate in this equation in decimals, remember. So indifference curve is a tool in economics, again, very, very simple, straightforward, right? Along the points, same. I1 is preferred to I2, I2 is preferred to I3, right? And remember, indifference curve slope upwards for risk averse investor because they will only take risk when they get more return. Right? I'm at this point on my indifference curve. I'm at this point on my indifference curve. If I want the same level of happiness as a risk averse investor, what will happen? For more risk, I would obviously want to be compensated by more return. Otherwise, I will not take that extra risk. For my utility, for my happiness to remain the same, I need to be compensated for that extra risk in the form of extra return. Exactly like that here. Exactly like that here. Right. That is what your indifference curve represents. Now you tell me, if the risk aversion is higher, your risk aversion is higher. Investor is more risk averse. That means he dislike risk. He dislikes risk more. What will happen, sir? My indifference curve will be more steep, will be more upward sloping, will be more steep. Reason? Because I would want to be compensated. If, let's say, for example, I compare it with this investor whose risk aversion is, I don't know how much, but it is there. Let's say this risk aversion is less, this risk aversion is more. So this is an indifference curve. Here risk aversion is high, here risk aversion is low. So for extra risk, he needs to be compensated with this much extra return. He needs to be compensated with this much extra return, this much extra return. For that same extra risk, because this investor's risk aversion is high, he needs to be compensated with much more extra return. See, way more extra return. Because his risk aversion is high. His disliking to the risk is high. That means his indifference curve is more upward sloping. Right. Sir, so far we were talking about a two asset portfolio. Sir, in a two asset portfolio, we were taking both the assets that we were taking was what? Were risky assets. Were what? Risky assets. But what if I combine a risky asset portfolio, which consists of risky assets, the two assets that I was talking about, I combine that for risk seeking and risk neutral will be flat. No, for risk seeking it will be, uh, in fact, downward sloping, and for neutral it will be flat. Doesn't matter. But I told you ना कि आपको जो भी आपका assumption करना है यहाँ से will always be for a what kind of investor? Risk averse investor. All right. Sir, what if my portfolio is risky asset portfolio and risk-free asset? Is a risky asset portfolio and a risk-free asset. How do I calculate the standard deviation of a portfolio? Sir, how do I calculate the standard deviation of a portfolio? Sir, my portfolio consists of two assets here. How come? Sir, one asset is risky asset portfolio, other is risk-free asset. How can I calculate the standard deviation of portfolio? Sir, simply use that formula. Sir, in that formula, sir, first part we will understand, sir, which is weight of security 1 square into standard deviation of security square. Sir, weight of security 2 into standard deviation of security square plus 2 into weight of 1, weight of 2, covariance between 1 and 2. Sir, you know what? This will become 0 because your second security is risk-free asset and risk-free asset has no standard deviation. The standard deviation is 0. This is going to be 0. This whole term becomes 0. Covariance of any security with the risk-free asset is 0. Again, this will be 0. These two terms will become 0 and the standard deviation of portfolio would look something like this. This theory of combining a risky asset portfolio and what? And a risk-free asset is called as a two-fund separation theorem, which tells us that an investor's optimal portfolio will be made up in some or the other way of risk-free asset. So what does two fund separation theorem tell us? They tell us that listen, your optimal portfolio should include a little bit of risk-free asset as well. So your optimal portfolio will be made up of some combination of optimal portfolio of risky assets and the risk-free assets. So you want a risky asset portfolio and a risk-free asset. I mean, you want, as in when you combine the risky asset portfolio and a risk-free asset, you get something which is called as an optimal portfolio. As per whom? As per your two fund separation theorem. Sir, what is that weight? All of that different. What do you call different debate? Right. And you know what? This line that represents what? This line that represents different combinations of a risky asset portfolio and a risk-free asset, that is called as what? That is called as a capital allocation line. Remember, we were making a line, we made a line, if you guys remember. Hold on for a second. Remember, at this point, I was 100% invested in asset B. At this point, I was 100% invested in asset A. Exactly like that. Exactly like that. At this point, I am 100% invested in what? Risky asset portfolio. At this point, I am 100% invested where? In risk-free asset. सर क्या बोल रहे हो सर वापस एक बार बताओ ना प्लीज समझाओ ना क्या है I am trying to combine a risky asset portfolio with a risk-free asset together that will give me an optimal portfolio. That is what is told to us by two fund separation theorem. Okay. Sir, we can calculate the standard deviation of such portfolio? Yes. This is the equation that we just used. Okay, sir, fair enough. Sir, if we make a line which plots the combination of what? Of a portfolio. Of a portfolio that consists of what? Risky asset and what? Risk-free asset. We get a capital allocation line which plots the combination that of obviously of weights. I hope you understand when I say combination, I'm talking about combination of weights in risky asset portfolio and risk-free asset. So let's say, for example, at this point, I might be invested 80% in a risky asset portfolio, which consists of two assets, and 20% in risk-free asset. At this point, I'm 100% invested in risk-free asset. At this point, probably 50-50. At this point, probably 17 risk-free asset, 30% in risky asset portfolio. 30% in risk-free asset, 70% risk asset portfolio at this point. At this point, probably 60-40, whatever that may be. But when you plot this different combination of weights in risky asset portfolio and risk-free asset, you get something which is called as CAL, also known as capital allocation line. All right, sir, fair enough. And you know what? When I combine CAL with what? Indifference curve, the point of intersection is going to be what? Is going to be an optimal portfolio for me to invest. Sir, what do you mean by optimal portfolio? Array, this is that point where, let's say for example, 70% is invested in risky asset portfolio. एग्जाम्पल ले रहा हूँ, ऊपर मैंने थोड़ा ज्यादा बोला है बट हाँ भी समझा रहा हूँ. 30% is invested in risk free asset. How did I point out this? How did I find out this is an optimal portfolio for me in terms of weights that I should be allocated to risky asset portfolio and risk free asset? I combined capital allocation line with my indifference curves, with my indifference curves. When I combined the two, I saw a point that was tangent to my indifference curve. That becomes my optimal portfolio. All right. Okay, sir, fair enough. And the portfolio on the indifference curve too will be the optimal portfolio for an investor, as any portfolio that is lying on I2 will be preferred to all the portfolios that lie on I3. Right. But sir, the portfolios that lie on I1 are preferred to I2. So why would I not choose any portfolio on I1 and why would I choose portfolio on I2? Are because it is not on capital allocation line. The portfolios on I1 are not on capital allocation line. And two fund separation theorem tells us what? Are two fund separation theorem tells us that you have to combine risk-free asset and risky asset portfolio to get an optimal portfolio. So this line represents the different permutation combination of the weights of risky asset portfolio and risk-free asset. Okay, sir, fair enough. This line represents those combination. Indifference curve doesn't lie anywhere on that line. So, sir, if I select a portfolio in indifference curve 1, that would ultimately violate two fund separation theorem rule. Okay, so sir, this is definitely not the case. Okay, sir, I too, okay, we should prefer for sure. Sir, why only this point? Why not any other point on I2? Why not this? Why not this? Why not this? Because this is the point that is tangent to the capital allocation line. And capital allocation is the line that represents different weights that are possible with respect to risky asset portfolio and risk-free asset portfolio. And this is that point. Because at this point, I would not be invested anywhere in a risk-free asset because it is not on cal. I would not be making combination of risk-free asset and a risky asset portfolio, right? At this point, same. At this point, same. At this point, possibly same. So I am not making any combination of a risky asset portfolio and a risk-free asset if I'm on any other point other than the point that is tangent to the capital allocation line. And if I select this portfolio or this, I will be violating the two fund separation theorem. Right? And that is what this is trying to tell us. Portfolios on I1 are preferred to those on I2, but none of the portfolios that lie on I1 are available in the market. They are not practical portfolios. That's also one of the justifications to it. Right. And this talks about the tangency point. Now we talk about two investors. This is investor number A. This is investor number B. He has more risk aversion. You can clearly see this is the point. Okay, let me just not take this point. Let me just take a higher point so that you guys understand this very well. Now, let's say, for example, I'm talking about this investor, investor A. Okay, sir. Investor A, if the risk increases, demands how much extra return, sir? Demands how much extra return? Sir, if risk increases, he demands this much extra return. Okay, fair enough. All right. Sir, if I talk about investor B, he was somewhere here at that amount of risk. For that same increase in risk, what is the return that he's demanding? Sir, very less. Okay. ऑल्सो वन मोर थिंग, मैंने शायद ऐसा बोल दिया था कि इन्वेस्टर बी इज मोर रिस्क कवर्स. प्लीज हाँ, सॉरी, मैंने गलती से बोल दिया हो. आई थिंक मैंने वो बोला. मैंने गलत बोला है ये. ओके गाइस, इन्वेस्टर एज रिस्क अवर्जन इज हायर and investor B's risk aversion is lower. That's why investor A for the amount of this amount of risk is demanding this amount of return because his risk aversion is higher. He dislikes risk. For that same increase in risk, investor B doesn't demand that same amount of return. He is okay with even lesser amount of return. So obviously, sir, A is more risk averse and B is less risk averse. Sorry, मैंने उल्टा बोल दिया आप लोगों को, but हाँ, I hope you guys understand this. ओके, बट सर कैपिटल एलोकेशन लाइन तो एक ही है ना सर, वो ड्रॉ की, कैपिटल एलोकेशन ड्रॉ की ऑब्वियसली फॉर अ इन्वेस्टर हुज रिस्क अवर्जन इज लोअर, ऑप्टिमल पोर्टफोलियो यहाँ पे आया, एंड फॉर इन्वेस्टर हुज रिस्क अवर्जन इज हायर, ऑप्टिमल पोर्टफोलियो यहाँ पे आया. Because obviously optimal portfolio is a portfolio that exists on the capital allocation line, and obviously indifference curve and capital allocation line are tangent at this point. For investor A, for at this point, for investor B at this point, they become optimal portfolio as per two fund separation theorem. And that wraps up completely our discussion on portfolio risk and return part 1. I hope you guys have understood everything. All right, guys. Any doubts, anything that you have not understood, please ask in the chat box. Also, guys, one more thing, please do leave your feedback in the comment section. How was it? Did you like it? Did you not like it? Any feedback that you have for me? Please go ahead. Please write in the chat box. How did you like the whole thing? Should we do it more often? And one more thing, guys. I'll be continuing and I'll be taking chapter number 2, which is risk and return part 2 pretty soon. Don't worry. I'll let you guys, I'll keep you guys posted. I'll keep you guys updated with that. And yeah, what if two fund separation theorem didn't hold risk-free rate is equal to zero, then optimum portfolio will be or indifference? I don't get you. The entire point is that it holds true. That's where I'm able to draw the theory. If it doesn't hold true, तो फिर I don't know. Sir, the difference between covariance and correlation is just the range, right? The correlation is, yes, it's just the range. Absolutely. Sir, less risk averse means the one who likes risk, right? Yes. Less risk averse means the one who likes risk. I mean, allocation to risk-free asset is zero. Yeah, then it is zero. Yeah, true. True. What you're saying is true then. Can you do this for fixed income and FSA? Fixed income, will try FSA, I'm not sure. Please continue this for all subject. Yes. And is correlation coefficient, are the correlation and correlation coefficient the same or different? No, correlation coefficient is different. I think Krusha is asking that out. Krusha, text me on WhatsApp. We'll explain that to you. All right. Okay. I'll end the stream, guys. Um, on our, what do you call? Also, in our WhatsApp groups, please do let us know how was the overall experience and everything else, if not here. Thank you so much for joining in. I'll see you guys soon with part portfolio risk and return part 2. And that's it for today. Bye bye.